Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
The ECB's classic note tells Bloomberg that markets may be underestimating the chances of a rate hike at next week's meeting. The renewed advance in the US dollar is causing concern with officials in Japan and China threatening FX intervention. Plus, oil is near the highest level since November after Saudi Arabia and Russia extend cuts through the end of the year. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the global insurance sector faces a number of headwinds, with insurers having to navigate persistent inflation, the impact of extreme weather, and, of course, an uncertain economic outlook. Now, to discuss the pressures facing the industry, I'm very pleased to be joined for an exclusive conversation by the Chief Executive of Zurich Insurance Group. He's Mario Greco. As always, thank you so much for joining us. Mario, first of all, when you look at the outlook for the rest of the year for insurance, finance income, and expenses, what's it looking like?
It's looking better. I understand all the challenges we face, but we've been preparing for these challenges for a number of years. We especially, but the whole market has. And so the inflationary situation is actually helping us going from negative rates to positive rates. Climate can be managed, and there are a lot of services that we can provide to customers to prevent and to mitigate the consequences of climate. And yes, there are new risks. Cyber, the most important one. But we're prepared, and so I'm looking with optimism to the end of this year and then the next years.
What's your biggest concern? And I mean, you beautifully laid out some of the challenges, but also some of the opportunities. Is there one thing that keeps you up at night?
Yeah, these are all the things that we haven't been preparing yet. What we experienced over the past years is that there is always something new that it's coming as a surprise. I mean, with the pandemic and then with the recession, the inflation, the war, risk of recession again. You can really anticipate for these things. And so you need to react very quickly. You need to keep your organization very alert and reactive. And if you do that, then you can thrive and you can keep growing and you can really do your service to the economy and to the customers.
As you beautifully said, I mean, higher interest rates is not necessarily a bad thing, right, for your sector. Yep. But is there a limit to, I don't know if you have a sweet spot for when, if interest rates are too high, then it also could kill demand?
I think the limit is the GDP growth. It is recession. If by driving the rates high, the central bankers drive the economies down into a recession, this is clearly not healthy at all, and we will suffer. But we're used to work in even high inflation situation. We've been working for years in Argentina. We're working for years in countries which have high inflation. We know how to do and how to deal with that, as long as the GDP keeps growing.
Mario, when you look at the weather patterns, I mean, they're absolutely unbelievable, and especially in the last 8 months. Are they just going to get worse and worse, and what does it mean for insurance premiums?
Yeah, I'm afraid to say so, but I think we're at the beginning. I think we have initiated a path that will be hard to stop now, and we can only prevent and mitigate along this path and help the people managing this. But yes, I do think this is going to get worse even quickly, and we need to be used to that. And there are different ways in which you can look at. I mean, warm weather will become very hot weather. Rainy days will become flooding days, and cold days will become icing days. And so there is a lot to do to help the society preventing and preparing for that, and then mitigating the consequences.
But how do you mitigate something as big and as formidable as some of the fires that we've seen over the summer?
Prepare. I mean, once the fires start, you just have to, put water on it. But it's late. You have to prepare. You have to anticipate. We've been, working even with cities in Europe to prevent the effect of warming on these cities. This is the things you have to prepare and do, many years before they happen, or many months before they happen. When they happen, you just it's emergency care, and you do whatever you can.
But does it mean, Mario, that there are some things that you won't insure anymore?
I don't think climate will ever become uninsurable. It can become expensive, but no, I think we will continue to provide, and the customers need that. And both our retail customers, the individuals, and the companies need that. So we will continue to provide coverage, but the coverage will become expensive. Yeah.
You also withdrew from the Net Zero Climate Alliance. Is it because this was flawed?
No. I think the issue there was that this was born to be a global alliance, and it ended up being just a European one. Yeah. And then the second point is that I believe that we have already passed the point at which we need all these alliances. We are in a situation today where the political support and even the societal support to climate is dubious, right? And so you need to stand by yourself on what you believe for. You can't hide behind alliances. You need to take your own decisions, and you need to represent yourself in front of the customers, shareholders, stakeholders, and say what you believe in. And this is what we're doing, and we will progressively do it also for other kind of alliances, because more and more we feel an individual responsibility to that.
But does it make it more likely for competitors to follow you, or is it also easier for companies to just drop off and no one ever hears from them again?
I don't know that. We need to see it. I mean, for sure, what I feel today is that there is much less political and government support on these issues. And so you need to learn how to walk by yourself and speak to your customers and to your stakeholders with your own voice, and present the things you believe on. I mean, and just take your responsibilities for that.
Mario, when you look at the catastrophe-linked losses, how are you expecting those to do actually in the second half of the year?
That's
impossible to say?
Yeah, that's a billion question. I don't know. I mean, what I know is that over the past years, we had many more events with pretty much an average severity. So that's all I know about it. If I look past, I would expect many more events that we would like to have with an average severity of them. Is this going to be the case over the next months? I don't know. I mean, predicting weather is almost impossible.
It's impossible. How does it change, though, your industry in 3 to 4 years? Are we underestimating the deep impact of actually what some of your companies will become?
Yeah, I think the industry needs to have a very strong capital position, as we do have. The industry has to accept that there will be more and more volatility because of these weather events, and we need to prepare and react to that. And this more and more becomes a job for big shoulders, for big companies, which again, we are prepared for that. But I don't think we are optimistic on what's going to be the weather-like impact over the next years. I think we're prepared for what that's going to be, and we've been preparing now for years.
Mario, when you look at Zurich, is there anything more that you want to sell? I know you sold a couple of small things to Viridium.
Yeah.
Are you now looking to buy? Is there going to be any more adjustments that we should be looking at?
Yeah, I mean, the live sale actually have a story, because it all started in the first months of pandemic, where we saw our capital ratios moving downwards because of this very old closed books of life, which still had the capacity to impact our solvency ratio. And in those days, we said, no more of this. We want to protect in a tail event situation, and bad things happen. We don't want to be in the same situation as we are. I think we've done everything we planned to do in those years. Now our tail risks are very well mitigated. I think our shareholders can feel safe with that. Our capital is very well protected, even in tail events, and that's all we wanted to do. But it took us 3 years to get to what we wanted to achieve.
Mario, when you look at life insurance in general, I don't know whether that contract, right, has changed at the margins because of COVID. Have you seen any patterns or shifts or changing behaviors?
Yes, I think all of us are much more aware of our health and how thin is our life on this planet than we were before COVID. And we see that, I mean, in the interest for protection policies, for health coverages, for well-being coverages. Yes, I mean, it's a remarkable shift in customer preferences. Before COVID, you needed to convince the people. After COVID, they come and ask, how can I better protect myself, and what else can I do? Also, they search for advice. And it's a good sign for us.
Mario, as always, thank you so much for joining us. That was Mario Greco, the Chief Executive Officer of Zurich Insurance Group. Now, coming up, we'll also be speaking to the acclaimed economist, Mariana Mazzucato, on why she believes putting growth at the center of economic policy is a mistake. That's next, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
The conversations that matter, the insights you need. This is a pulse. I'm Francine Lacqua here in London. Now, my next guest is the author of 4 highly acclaimed books. She advises policymakers around the world, and she's, of course, a leading academic. This week sees the publication of a 10th anniversary edition of her book, The Entrepreneurial State, Debunking Public versus Private Sector Myths. Now, here's a spoiler alert. It contains a new preface looking at what's changed a decade on. Well, Mariana Mazzucato, thank you for joining us, and welcome to Bloomberg. It's a great book. It's a controversial book, not a book that a lot of governments, or some governments, want to take to heart. Not a lot of CEOs want to take to heart. What's changed in the last 10 years?
Well, the reason I wrote it 10 years ago was that after the financial crisis, which in my view was caused by private debt, not public debt, we went on this massive wave of austerity, which we're still bearing the consequences of that, right? Because there was a lack of investment and all the things that actually drive stronger
Especially
social
in the
fabric.
UK.
In the UK, but actually across Europe. Across Europe, a lot of the loans and the recovery funds back then were conditional on countries obsessing about their deficits, right? You're right, though, less in the US, which is interesting, right? That goes against some of the stereotypes that we think the US is more market-driven. Actually, it was Europe and the UK that really embarked on that. And my point of writing it was that if we actually want to recover, all these words about recovery, of course, are very much used now, but they were used back then, and doing so by cutting public budgets kind of doesn't then pay respect to what we know about long-term growth, especially innovation-led growth, right? Because that's what we care about. We care about investment-led growth, innovation-led growth. In the UK, for example, even pre-kind of COVID, most of the growth happened through consumption-led growth, mainly fueled by private debt. So the ratio, even today, of a private debt over disposable income continues to be way too high. And when that bursts, we'll have another financial crisis. So the book said, invest, 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 but take care on how to do that. We need to invest in research and development. We need to invest in the capacity.
So through the government, right? Your premise is that the government can do more, whereas at the moment, it's just kind of given it to private companies to get on with it.
Exactly. I mean, it's always about public and private. The book also really talked about going beyond the ideology, that it's either state or the private sector. It's about how do we work together? How do we get to the moon? That, of course, was my other book also called Mission Economy. But already in the entrepreneurial state, I said, we need partnerships, but we need symbiotic partnerships, not parasitic partnerships. We don't need state funds just giving guarantees and subsidies to the private sector. We need conditions, for example, on what that means. So instead of just giving money today, for example, to the semiconductor industry through the CHIPS Act in the US, I've been talking to the US government on the lessons of the entrepreneurial state, on what would it mean to actually embed within the CHIPS Act conditions on making sure that workers are paid well, working conditions are good, green procurement is used, and also that the profits generated are reinvested.
You advised, right? The Commerce Secretary.
Gina Raimondo, the Secretary of Commerce.
So what does that, are we getting in a place where you think is more comfortable than it was 10 years ago?
Look, there's so much variety, right? There's different ways to do capitalism. There's not one way. So think about what happened during COVID in France. All the bailout money that went to companies like Air France and Renault were conditional on those companies investing and reducing their carbon emissions. What do we do in the UK? 600 million to EasyJet, no conditions attached. In the US, we have the Inflation Reduction Act, the CHIPS Act, we have the coronavirus recovery program. And if you look at how much money is actually being put into the economy, it's huge. It's $4 trillion, over $4 trillion. But that's not enough. We shouldn't just have helicopter money. We need to make sure it lands on capable structures that can govern the solutions to the biggest problems we have: climate, health, digital divide. That requires governance structures.
Why are some governments then, doing it right in your eyes, and others not, without any conditions attached?
Well, leadership matters. I'm currently working also, for example, with the Prime Minister of Barbados, Mia Mottley, who personally I think is one of the most inspirational leaders today. But I'm also talking to Lula, of course. I just came back from Brazil. And the question there is, when you have a leader who has a progressive agenda, and progressive versus regressive, and actually steering growth, because growth has not just a rate, but a direction. How do we get inclusive growth? How do we get sustainable growth? How can we transform the 17 sustainable development goals that every country has signed up to into what I call moonshots?
Actionable.
Concrete moonshots with an investment trajectory.
How's the UK doing?
Well, what's really interesting in the UK is just the inertia, not just in the economy, so productivity is lagging, but in the discourse. And unfortunately, even the opposition, so the Labour Party, which everyone's saying is going to win, they seem to be kind of knee-jerking, reacting to what the Tories are doing and what the Tories are saying. And instead of both of these parties saying, okay, how are we going to have a dynamic economy? How are we going to work well with business? How can we actually turn the challenges of the UK into investment opportunities, innovation opportunities? They're almost competing on who sounds more kind of, stable and rational about the finances, which, of course, we have to care about the finances. But the irony is, when you obsess about the finance, when you obsess about the deficit, what ends up happening? Your debt to GDP rises. Why? Because you're not actually making those investments that are long-run drivers of the denominator of the ratio,
But
GDP.
Mariana, why is that? Is it because they're going from crisis to crisis, i.e. the schools and the concrete that has had to shut them down? Or is it they're remembered about what happened a year ago with the very brief Liz Truss government and say, actually, we want to be on the market side?
Yeah, but we had already experienced that before, right? I mean, if you think of what happened in the previous election and how the narrative almost just didn't talk about, again, the big problems of our time. So yes, Liz Truss made it much, much worse because now the cost of living is worse than in other places because of what happened to interest rates and so on. But the fact that we're not investing in public education and public transport and public health, schools are crumbling, town halls are crumbling, is depressing. I mean, it's not only bad for the economy, it just makes everything quite negative. And, what drives business investment, if we just think of the business side, not just the humanity and citizenship side, is expectations about future growth opportunities. And what happened with Brexit is the market size of the country fell drastically. So forget what we think about it politically, economically, reduce the size of the market. And many businesses stopped investing, foreign businesses, but even national businesses in this country.
Who's to blame for all these crises?
Definitely the lack of leadership. But also, the media, to be honest, I think is also often just nitpicking on numbers. Oh, today growth went up, growth went down, as opposed to what do we know about the social fabric? What do we know about the long-term growth? So both the politicians, but the narrative and, holding the media accountable to not kind of keep repeating the myths of kind of bad economics and actually making sure that politicians, when they are on an electoral campaign, are actually talking about what matters to people and planet, I think is going to be very important for this country in the next months.
Mariana, thank you. Coming up, we'll continue the conversation with author and acclaimed economist Mariana Mazzucato. It's also a fantastic book. You agree or disagree, but everyone should read it. We'll be right back, and this is Bloomberg.
For a young person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
We've all been there. You get invited to go to Kyrgyzstan, where you're turned into a YouTube kids show star. build a satellite, and play a game with a goat. The point is, Hello World is back, and you should watch it. Thursdays on Bloomberg Originals and Bloomberg TV.
Still with me, author, policy advisor, and professor in economics, Mariana Mazzucato. Mariana, so your book, The Entrepreneurial State, came out 10 years ago. It has a new preface, and it's coming out again this week. Talk to me a little bit about Apple. You dedicate a whole chapter in basically dissecting how Apple was formed, and what does that tell us about the entrepreneurial state?
Yeah, so the reason I had the chapter on Apple is that when people think of the United States, they think of free market, and yet all the kind of big innovation that occurred in the US was actually co-funded, if not actually financed early on by the state. So everything that makes our smartphones smart, not just the iPhone, is the internet, GPS, touchscreen, Siri, all government financed. Now that's a nice part of the story. That's business and government working together. What's not so nice is when we end up socializing the risks and then privatizing the rewards. So how much of the profits that have been generated from the internet revolution or today from big tech have been reinvested back into the economy, making sure public schools are strong, et cetera. So that's where the idea of conditionality comes in. When you have an ultra-financialized business sector where over $7 trillion have been used in the last decade on just buying back shares to boost stock prices, stock options, and executive pay, that's a bad deal. Right,
So
the
Mariana,
deal, the negotiation between public and private.
So concretely, what do you need? Do you need more people in government who can negotiate contracts with privates?
You need two things. First of all, you need an innovation system. That's the bit the U.S. did quite well. We had the Defense Advanced Innovation Agency called DARPA. They were, in fact, responsible for investing in the internet. We have the National Science Foundation. We have public venture capital funds. The CIA has one, by the way, InQtel. We have downstream, bold, outcomes-oriented procurement. So that's one part of the story that the world needs to learn. Dynamic innovation systems with public institutions distributed across the whole innovation chain, working with the private sector. But the second part of the story is where it goes wrong. What does it mean along the way to negotiate? What does it mean to actually invest also within our public administration so they also know how to negotiate, but also know their worth? I often say that I walk in as an economist and I come out as a life coach. I'm like, come on, man.
Okay, but who's doing it right?
Well, first of all, there's no one country that's perfect, but if we look at, for example, what happened recently in Germany, where because they had a very clear energy strategy, they made sure that the loans going to a sector like steel, which globally is asking for bailouts, was conditional on that sector reducing its material content of production. That's why we have green steel in Germany and in Sweden. So what I'm interested in is examples where a particular public institution, whether it's an innovation agency or a public venture capital fund or a public bank, doesn't just subsidize and guarantee, but actually negotiates. And by the way, the reason we ended up with Bell Labs in the US, which was critical to the IT revolution, was the government actually forced AT&T at the time to reinvest its profits back into a big innovation agency. And that's where we got Bell Labs.
Mariana, thank you so much. Mariana is also joining us on the podcast, author and professor in the economics of innovation and public value at UCL, Mariana Mazzucato. Up next, Bloomberg Surveillance Early Edition with Sonali Basak in New York and Danny Berger here in London. And this is Bloomberg.
They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point! From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. The renewed advance in the U.S. dollar is raising alarm bells with officials in Japan and China threatening FX intervention. A flurry of fresh bond supply. U.S. corporate borrowers flood the market with debt sales while the Fed offloads about $1 trillion of bonds. And the ECB's Class Connaught exclusively tells Bloomberg that markets may be underestimating the chance of a rate hike at next week's meeting. Welcome to Bloomberg Surveillance. You're watching the early edition. I am Danny Berger in London alongside Shonali Bassick in New York. Shonali, it's that bully of a dollar taking a bit of a break. We're getting some more retail sales data also just coming through for the euro area. July retail sales, those fall 1% year over year. The estimate was for 1.2%, better than expected. So maybe the euro can finally fight back against that greenback.
Yes, we'll see about that. And let's take a look at the U.S. markets here. Speaking of that dollar, the S&P futures down another day, Danny. We are looking at a little bit of weakness, about 0.2% lower starting the day. Tough week here in the United States. We're looking at the two-year yield also cooling off just a little bit after a sharp leg higher just yesterday. We're looking at it down about 1 basis point, sitting at a 494 handle. The dollar index, to your point, cooling off just a little bit. But remember, it did rise to the highest levels here since March. It has significant ramifications for global currencies. We'll talk about that later in the show, but still just about flat from yesterday's levels. Now, we're also looking at Brent crude. We're going to talk about that OPEC supply extension, the curve here. We're looking at 89 on Brent crude as well. It is down about 0.9% so far, but we'll keep an eye on that as well.
Yeah, when I woke up this morning, that was up and it was at $90 a barrel. So some of that running out of steam. So again, Shonali, here in Europe, we just had that euro area July retail sales data. It was a drop of 1%. The estimate was for 1.2%, so down but better than expected. Retail sales month over month, bang in line with estimates, a drop of 0.2%. Again, estimate 0.2% drop. Now, that's not having too much of an impact on markets as much as I was hyping up the euro finally making a comeback. Euro stocks having a tough day, down about 0.7%, trading more based on bad data. on Germany factory orders, which fell pretty significantly. But the only thing that's really saving us from having a weak euro at the moment and 2-year yields not dropping is an interview from our Jana Randau speaking with Klaus Knot. That's, of course, the Dutch ECB member. We'll be speaking with Jana later in the show. But Knot saying that the market is underestimating the probability that we'll get a rate hike in September. Now, he is a more hawkish member, so yes, we did trade up on the euro and up on 2-year yields, but the reason, Sonali, we're not running away with this, again, is because he's a guy who already has that kind of hawkish lean.
Now, when we're talking about the strength of the dollar, raising alarm in Japan and China, remember both are stepping up defense of its exchange rates. We're going to get to this with Eddie Vanderwalt of Bloomberg Markets Live because we are looking at finally some plateauing of the dollar. We are finally looking at other countries looking to respond to the dollar. And so we are looking at a very significant move here in global currency markets. Eddie, this is certainly our top story of the day.
Yeah, absolutely. Look, it does feel like an FX day, and it is because we've seen the dollar rally something like 4.5% from the middle of July, right? And the dollar strength really coming back. That will reverberate across markets. It usually means that people are looking for some sort of haven. I think at the moment, though, what the driving force behind the narrative is that we're starting to see the risk of inflation coming back, you know, with oil prices and so on. And that's feeding through into Asian currencies in particular. And it's forced the Bank of Japan to talk up the risks of, you know, the potential for intervention, and it's forced in China, you know, a lower fixing than people had expected, or a higher fixing from the dollar perspective. And I think all of these things, you know, it just shows that this will reverberate across markets. It's going to matter for EM currencies. It's going to fuel inflation elsewhere.
On China specifically, why, and I realize this is probably just an absolute amateur question, Eddie, but why would the PBOC want to step in? Doesn't a weaker yuan help them because they need more growth right now?
Yeah, they do need more growth, but also they like to control their currency. They like to be in control of things. They do not want this to be out of their hands. And I think, you know, just the scale of moves and the pace at which they're happening, I think that is a worry for China. So I think, yes, they would like to see probably inflation coming back a little bit. They would like to see stronger growth. Therefore, you know, a stronger domestic currency or a weaker domestic currency helps them. But at the same time, I think, you know, they would just like to be much more in control of the narrative.
That's our thanks to Eddie Vanderwalt. Now remember, as September kicks off, global debt markets are bursting with new deals, with investment-grade companies rushing to lock in borrowing costs. That's before the central bankers can raise those interest rates further. Bloomberg Markets correspondent Valerie Teitel joins us with the latest.
Sonali, it was a busy day for those debt syndicate desks yesterday. The busiest day of the year for U.S. investment-grade bond sales, and actually the busiest day we've seen in over 3 years. It just wasn't the U.S., also in Europe and Asia. September is a busy month for these debt deals, and with a lot of risk events on the horizon, with that CPI print next week, and then the Fed the week after, there is a reason for these corporates to rush out of the gates in September and get these debt deals done while markets are still quiet. It did have quite an impact on the Treasury market yesterday, as you commented, Sonali. We did see long end weakness rear its head yet again. This long end steepening that we have seen is continuing because of this deluge of supply. Now, it's very funny because last year and the beginning of this year, you know, the rise in U.S. yields was really spurred by stronger U.S. economic data. And recently, it's all been spurred by supply reasons, by the Treasury increasing its auction sizes, by the Fed's QT still rolling on, and by these corporate bond issuance. So it's really a story about supply heading the bond direction in the wrong direction.
A blessing and a curse here, Valerie, because you kind of just answered the question I wanted to ask, but also speaks to how you're basically a mind reader. But who is buying all these bonds? I mean, as you say, QT is rolling on, and we just passed that threshold of $1 trillion. How significant is it to have all of that sloshing around in this market?
Well, it is significant, Danny, that $1 trillion worth of bonds are now out there available in the market that used to be on the Fed's balance sheet. But the Fed is still sitting on about $8 trillion more. So there's still a long way to go when it comes to the Fed's QT if it does exactly continue, even though the Fed could cut rates next year. But this is all about the deluge of supply, whether it's coming from the Fed, whether it's coming from the corporate bond market, or whether it's coming from those Treasury auctions being increased in size. And then we also had a comment from the FDIC yesterday. They are going to be auctioning off yet more debt, the failed Signature Bank loans that totaled around $33 billion. They're also going to be auctioning those to the market. So we're just really getting hit with a lot of debt supply from various parts of the market, which is causing more pain for the Treasury market.
Valerie, thank you so much for that. That is Bloomberg's Valerie Teitel. Now, we're also keeping a close eye on oil this morning. OPEC Plus leaders, Saudi Arabia and Russia, announced that they would extend their supply curbs through the end of the year. Joining us now is Bloomberg's Dan Murtaugh. Dan, you and I spoke, 4 or 5 hours ago? NYMEX crude was at $90 a barrel. It's come down since then. I was really ready to be all bullish oil, saying, where are we going? We're going to $100 next. If we're falling now, have we kind of reached the peak oil price that we'll see in reaction to these cuts?
Yeah, I think it's too early to say that, Danny. I think the oil market responded yesterday with a big jump in prices because they were expecting the size of these cuts, but they weren't expecting the length of them, for them to last through the end of the year. And what that's doing is it's resetting the market to expect a much bigger deficit. So we're going to draw oil out of stockpiles. That's going to make a tighter balance, and any kind of unforeseen supply disruption that hits the market, that could really cause prices to spike. But at the same time, you have a worsening economic picture. Things here in China have not recovered at the speed that people want to after COVID. The U.S. and Europe are facing possible recessions. And so that demand picture is sort of pulling prices back a little bit. And I think we're going to see that sort of that balance between the supply tightness and whether the economy is going to need enough oil to push prices higher. That's going to be the story we're going to be tracking for the rest of the year with oil prices.
When you're thinking about the supply-demand picture, how are the troubles at refineries contributing to higher prices for drivers?
Yeah, that's a really big and underreported issue. But in Europe this year, we've seen refinery outages almost every week. And in the U.S., the big refining hubs of Texas and Louisiana, they've had a record heat that's kind of slowed operations down. And so you're seeing gasoline prices shooting up. In the U.S. now, we have gasoline prices that's the highest for this time of year in more than a decade. And in Japan, compounding the refinery issues, the oil price is the weak yen. And so Japanese people are paying record amounts for gasoline. And so that's something governments are going to have to keep track of as they make sure that their people are able to afford these higher energy prices.
Right, and it's not like in the U.S. we could have more SPR releases. That fodder was more or less already used up. Dan, thank you so much for your coverage throughout the day. Bloomberg's Dan Murtaugh in Beijing. Now, coming up, we are just over a week away from an ECB rate decision. We're going to have more from Bloomberg's exclusive interview with Governing Council member Klaus Knot. That's next. Then we're going to be hearing from Union Investment Christian Kampf on why he expects another hike from the ECB next week, and get his take on some of these FX moves. Plus, SoftBank's ARM is looking at a downsized IPO of nearly $4.9 billion. All of that still ahead. This is Bloomberg.
The hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Thursday, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Shanali Pasik is in New York. ECB Governing Council member Klaus Knot says investors betting against a rate increase from the European Central Bank may be underestimating the chance of a September hike. Knot spoke exclusively with our Jana Randau, and she joins us now from Amsterdam. Jana, a really great interview. We saw the euro strengthen off the back. We saw yields push higher. I love how he emphasized that it's maybe underestimating the rate hike and it's a close call. So he seemed hesitant to say one way or the other. Taking Knot's view then in hand, how likely is a hike next week?
Well, reading between the lines and knowing him really well, I would say there's an ever so slightly bigger chance for a rate hike than a pause. But yes, he said it was a close call. The decision is not hasn't been made yet, and will in fact depend on the one thing that we don't know yet, and that is how the inflation outlook develops, how the economy develops. So the economic projections the ECB staff is currently putting together, we haven't seen them yet. Neither have the policymakers. What they expect and what Klaus Knot expects is a weakening in the growth outlook and a more or less confirmation of the inflation outlook from 3 months ago. And that is essentially what is crucial, because those forecasts from June showed inflation above the ECB's target all the way through the end of 2025. And he said reaching the target by that time, by the end of 25, is the bare minimum the ECB needs to achieve. Push it out into 26, and that is not satisfactory to him. So that is what's going to sway the debate in one direction or the other. We don't know what the forecasts will show. He doesn't know that yet, hence no clear commitment. But everything else I heard makes me believe that the chances are slightly higher for a hike than a hike.
The other thing he said about the inflation target, 2% end of 2025 bare minimum, but he also told you he wouldn't mind so much if that target shifted forward a little bit. How popular or unpopular is that view?
Yeah, I mean, I think every policymaker at the ECB, hawk or dove, will agree to the fact that inflation has been above target and much too much above target for way too long already. So the sooner inflation comes back to that 2% target, the better. Now, clearly that is complicated. It's not something that happens from one day to the next. Wage deals, for example, play an important role. Those have been really strong. They will continue to be strong. and thus boost demand and keep price pressures high. And we're still seeing that in the economy. The economy itself is slowing, but as Klaus Knot said, it's a feature, not a bug. So that slowdown is welcome, is anticipated. Whether it will be enough to bring down inflation, we'll have to see. And that is the complicated thing. Reading the economy at the moment is really, really difficult. So as you get closer to the end of the cycle where we are at the moment, it's difficult to say the right or wrong. At the start, it's easy. This time, it's very difficult to figure out how much tightening or what that tightening that's already in the pipeline will have what kind of impact that will have.
Bloomberg's Yana Rando, thank you so very much for that exclusive interview. This year, India surpassed China as the world's most populous nation and now says it's on a mission to build, energize, and connect its vast nation. Ahead of the G20 summit being held in Delhi, Bloomberg takes a look at India's infrastructure landscape.
India's longest sea bridge has been some 20 years in the making. It's expected to open to
further down, and it's sort of, I'm not willing to commit to a rate hike. I'm not sure. So at a certain point, is he just trying to dress up the same message with a bit more of a hawkish wrapper?
Well, if the hawks can't be hawkish right now, what does that say about the decision?
Exactly. I think
a week
that's what
away?
people are.
The data was terrible in Germany.
It was terrible.
Factory orders were brutal, and for people who follow factory orders in Germany, you know it can be very, very volatile month on month. So this is going back to something like July, but still, terrible read of the German economy right now. And that data point hardly isolated or unique, is it? It's been pretty poor across the board over the last few quarters.
Well, that's exactly where I was going to go. It's been not just for factory orders, but also now you're seeing services start to also really soften to a sub-expansionary level, raising some real questions.
Let's get to the conversation. I started this morning with Laurie Cavacina, head of US equity strategy over at RBC Capital Markets. Laurie, good morning to you. Let's start with that move in crude. Is that a wrinkle in the soft landing dream? Crude getting back to 90 again?
Well, thanks for having me as always, John. I think there are so many wrinkles right now. I think you can add this to a conflicting cross-current list. On the one hand, I think the last thing consumers need at this point in time, especially as we're heading into the student lending issue, which is engendering a lot of uncertainty on the street, is a spike in oil prices and gas prices. On the other hand, if we get the energy sector working, and I think that happens as oil prices move up, that does potentially spark a shift out of growth and back into value in more cyclical parts of the market. So I think wrinkle is definitely a good way to describe it.
Well, United Airlines might have a problem. Look at these numbers. Jet fuel prices climbing over 20% since the middle of July, seeing third quarter all-in fuel price from $2.95 to $3.05 a gallon. Bramo, this is going to hurt individual companies, particularly the airlines.
Well, and not just hurt, but also raise a question of, are they going to try to pass it along to consumers, right? These are sort of the knock-on effects of higher oil prices that could percolate into inflation more than just higher crude prices. Lori, do you see any challenge to the soft landing thesis and the price action, whether on the heels of higher crude prices or just because there is such acceptance of this beautiful Goldilocks scenario?
Well, one of the things we've been talking to clients about, the last few weeks, and got into a deep discussion about this with someone yesterday, is the buffers for consumers, I think, are far greater than people have anticipated. So I'm still in the soft landing kind of Goldilocks camp. One of the things we've talked about a lot with people is if you look at the effective rate on mortgage debt outstanding, at the end of the second quarter, it was still about 3.6%. So everyone talks about the savings rate, right, which got, pulled down. Now it's actually creeping back up again. But I've been telling people that's not the only buffer out there. We're still really benefiting as consumers from this era of low interest rates. And yes, things are starting to shift in a different direction. But I think that buffer has been underappreciated, to be honest.
An update from Alaska Air as well, Laurie, not just United Airlines. This headline crossing in the last minute or so. Fuel prices have increased considerably in the past few weeks. They now see third quarter fuel costs per gallon of about $3.15 to $3.25. So clearly a problem for the airlines, Laurie, but maybe in your mind not a problem for the consumer. Now, some people pointing to that positive real wage growth we might start to get going into year end and perhaps into 2024 as well. Consumer discretionary has been a big theme for a lot of people, Laurie, in certain parts of that sector. I'm thinking of the airlines, I'm thinking of the cruise lines as well. Is that kind of spending, Laurie, in your mind set to last into year end?
So I would say let's separate the airlines somewhat from the consumers generally. If you look at airline earnings revision trends, they've actually been pretty peaky, suggesting that maybe sentiment from an earnings perspective had gotten a little bit stretched on that side. So I would maybe put those into a separate category. I did notice in our weekly, we are still tracking the TSA data, a couple of COVID high frequency indicator holdovers, and we've started to see some weakness on that. So I think that is something to keep an eye on here. But I do think generally this idea that consumers are tired of all these goods, they have too much stuff in their houses and basements, and they want to get out and live their lives again. I do think that there are still some tailwinds there. Now, is that going to slow down? We are definitely seeing, if you look through a variety of earnings calls, companies saying consumers are becoming more cost conscious. They are pushing back. They are adapting to this intense price environment around them. So I would say expect some moderation. From my seat, I wouldn't see that as reason to panic, though. I see that as evidence of rationality, to be honest.
But Lori, just to build on that, there is a question, especially as we see Alaska Air and as we see United Air talk about higher fuel prices, how much they can pass that along to the consumer. You're saying there is price sensitivity increasingly showing itself. Is this just going to end up showing itself in margin compression?
I think that's a great point, Lisa. That's another hot topic we've been having with clients in our conversations lately is what's going to happen to margins next year. I've got a tiny bit of margin contraction baked into my earnings forecast, and that stands in contrast to the street numbers, which are anticipating a bit of expansion. One of the things we've told people is that as inflation comes down, companies are going to lose the sort of justification for passing through these price increases, and that ends up impacting revenues. The flow through to margins in my back testing, at least, is not completely clear. I think there are soft offsets like management ability to kind of manage through, cut costs in various places. The margin data is very, very messy to forecast, but I will tell you that I really see in my model evidence that as pricing comes down, as inflation comes down, it is a bigger hit to revenue growth than most people understand. And I think that's one of the new narratives people are going to have to be discussing as we start to formulate 2024 outlooks.
Laurie, I've got to squeeze this in. The headline of your piece overnight, there are tactical problems with the growth trade. What are those tactical problems?
Crowding, overvaluation, earnings dominance is eroding. It's that simple. It has been outperforming for very good reason. We're staring down the barrel of what's probably a sluggish economy for quite some time, but that is priced in. It's just a plain old-fashioned, overvalued, crowded trade right now.
Laurie Calvasina of RBC Capital Markets. Laurie, thanks for the update from the RBC desk. The update on the equity market. We need the update on the airlines. Alaska and United Airlines in the space of a couple of minutes. Lisa, dropping the truth on what's happening with fuel prices, and they're going up, they're getting higher.
Which is not entirely surprising given what we're seeing in the crude market. I'm just looking at the AAA diesel index right now, and you are seeing it climb some of the highest levels, certainly going back to late last year at $4.45. Here's a question, just to underscore what Laurie was saying. Do they pass it along? Or can they not do that anymore at a time where the Wall Street Journal just had a big takeout and how discount airfares are coming back in the fall because people aren't traveling enough, especially from places like Cincinnati to Birmingham? I mean, this is like some of the sort of pressures on the prices that you start to see.
That's a big question for this Federal Reserve. Do they eat it or do they pass it on? And if they can pass it on, then maybe that inflation story's not over. Maybe it's not over, and maybe this story is going to be a bit stickier than they'd like it to be.
They've been able to pass it along, and everyone has just dismissed that by saying, yeah, but everything's still strong. And you mentioned real wage growth. If that continues, then at what point do you see that strength also continue in a meaningful way?
How many times have we been told the savings are going to run out?
Exactly.
We're being told that this quarter, the savings are going to run out. The latest on this story, Anne Milletti of Allspring Global Investments in the next hour. Looking forward to that conversation a little bit later. Equity futures on the S&P 500 this morning, slightly negative. Good morning. Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Thursday, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
We want to connect this inflation story. The thing we're watching is the oil market. The reason that is important is because that is one of the indicators, at least when we've seen inflation data down the pipeline. Brent crude has been one, for example, in 2022, that tends to be something to follow as a catalyst into where you start to see inflation numbers tick up later in the year.
What a move in crude. That was Katie Kaminsky, the chief research strategist at Alpha Simplex. Your move in crude this morning, a little bit lower. We're down 0.6% on Brent crude. WTI softer by 0.5%. The prices this morning of Brent, 89.50, of WTI, 86.24. In the equity market, slightly softer, negative by 0.2% on the S&P 500. A couple of updates for you in the last 15 minutes from two airlines. One, United Airlines, the other, Alaska Air. They put some prices on fuel, jet fuel specifically. Jet fuel prices climbing over 20% since the middle of July. That's the guidance from United Airlines. They now see third quarter all-in fuel prices of $2.95 to $3.05. Alaska Air going further on fuel costs for the third quarter, Lisa, per gallon of about $3.15 to $3.25. And the question we'll be asking all morning, can they pass that on, or have they got to eat it in the third quarter?
Especially because a lot of airlines are not hedging anymore. So they used to hedge some of these oil prices. Now, not so much, and you have to think that this is a significant part of their expenses. How much does this challenge the story that everyone's going out and traveling at a time where we're actually starting to see softness, reportedly, in airline tickets?
Yesterday, gains have been phenomenal. If we can get that board back up and have a look at where the likes of United, Delta, American have been. Yesterday, Delta's up by 27%. United's up by 28%. I know the gains were bigger earlier in the year, and those gains have faded over the last few months. But this speaks to that discretionary spending, which has held up so well through the summer.
Particularly international, particularly because business travel hasn't rebounded to the same level. Does that start to shift if prices don't come down in response to maybe people actually having to go back to work? I'm just saying, did you see the articles about how airline prices are softening, particularly domestically? You know, we've talked about, you buy that?
I'm told it repeatedly, and I don't feel it.
Because it's not international. If you look at the international, but also it's any city that you actually want to go to, they're not.
Oh, please list the cities that we don't want to go to. I'm here for it.
Sorry.
I've got a drink ready.
No, please.
Tell us the cities we don't want to go to.
I was looking at, some of these reports yesterday, and then I started to look up different destinations.
You cited Birmingham, Alabama.
Well, I think that, the game is big. Look, this Wall Street Journal story, I'm going down in flames. I think that there was a mention of Cincinnati.
Cincinnati?
Yeah.
Never been. You're telling me I shouldn't go there?
And there was also Cincinnati to Cleveland, I think, was a route that was
Cleveland,
cited
Ohio.
as like $20 fares.
$20 fares?
Are
you suggesting that's because people don't want to go there?
I'm just saying that less popular routes are being discounted dramatically. Let's move on.
Sure. Will Kennedy joins us now. Remember, I just did you a favor, all right? Senior Executive Editor for Energy and Commodities. Well, great to catch up. It's been too long. We were saying in the commercial break, it took a $90 crude barrel to get us to talk again. So, Will, let's talk now. I want to understand from your perspective, Will, when the Saudis and the Russians pull back and they say, we're going to do this until year end, but we'll review it monthly. What should I read into that, Will?
Well, I think they always like to give themselves room for manoeuvre and to maintain flexibility, but I think the expectation is that they will keep this in place into the end of the year. And clearly the oil market did react yesterday. We saw it's come off a bit today, but we saw a decent bump in the first $90 barrel since November last year. And I think the consensus is, and we've been talking to a lot of oil traders in Singapore this week, where there's a big industry get-together, is that the market already looked fairly strong, that people are optimistic about further demand growth, that yes, there are concerns about the Chinese economy, but there are also big pockets of strength in the Chinese economy and oil demand. Gasoline demand this summer has been incredibly strong as Chinese people catch up on the trips they weren't able to do during the very extended COVID lockdowns that they had. And people are pretty optimistic. So you put this on top, the Saudi pledge to keep 1 million barrels a day out of the market for the rest of the year. And to many people, it looks like a pretty bullish brew.
And well, this is happening at a time where US oil production is near all-time highs, isn't it?
Yeah, that's right. We have seen quite a lot of supply come into the market from different places. The US is one. Iran, very notably, really strong exports. Venezuela, Brazil's added quite a lot of barrels, but I think a lot of that flow is done now, and we won't see those gains in supply from those regions that we have seen. They will taper off. So again, you set that against this extended policy action from Saudi Arabia, and it does indicate strength in the market.
This sets up some really awkward conversations this weekend at G20. When you think about President Biden, who unleashed the SPR to try to reduce prices, not really having that lever anymore, what kind of potential outcomes could come from some of the, I would guess, fraught conversations, particularly through Saudi Arabia's leader and President Biden, who I believe are supposed to meet this weekend?
Yeah, I mean, it's awkward for Washington. It complicates life for the world's central bankers, that's true. But I don't think that the Saudis will feel that many qualms. From their perspective, there has been a huge surge in inflation over the last years, and that's not really been reflected in the oil price. I mean, go back to the years after the financial crisis, and oil traded above $100 a barrel for several years, and no one got terribly excited about it. They don't see this as a terribly high oil price. And I think they would say, well, you know, we're not that sympathetic, quite frankly. The other thing I would point out about this move is that it was coordinated from the Russians, and from a political perspective, that really underscores that on oil, Riyadh and Moscow continue to work very closely together, which again, I think is a bullish sign for the market.
What is the potential offset to this? If it isn't the Strategic Petroleum Reserve, is it just a global recession? In other words, what could counter the move up that seems to have legs, at least since the middle of July?
Yeah, I mean, clearly the economic backdrop will key, and, you know, while I said that there was a general sense of optimism that Chinese demand was holding up fairly well, that is the key unknown for many people in the oil market now, that if the woes we see in the Chinese property market were to spread more broadly and put a dent in demand, and that spilled out into the world, we could see you know, some pullback in prices. There will be a little bit of incremental supply next year from different parts of the world, but I think the expectation is the market looks quite well balanced for next year, so I don't think people expect a big fall off in prices, but there is the supply probably to meet demand. Demand won't grow as fast next year as it grew this year, as people came out finally from COVID in China. So it'll probably be balanced. So not that much downside, but not an expectation there's a huge amount of it. I don't think anyone's expecting this to go a long way above 100, for example.
A 20% move in 2 months is quite something, Will. There's clearly a supply-side story underpinning this move in crude. But then I look to iron ore. Well, it's not just oil. It's iron ore as well. What's happening there?
Again, I mean, I think people are realizing that the Chinese economy is much more nuanced than people think. And yes, clearly steel demand has taken a hit from the slowdown in the property sector, but I was having a conversation with someone at BHP yesterday, the world's biggest miner, and they pointed out that they still suspect to see a little bit of incremental demand in steel production in China this year, and that's driven by the amazing rollout we're seeing in the electricity grid, in wind power, solar power. It's being driven by shipbuilding. There are lots of industries in China that continue to go and drive demand, and for all the correct focus on the key property market, it is a more nuanced story it's emerging than people might have thought.
Too true. Will, thank you, sir. Will Kennedy of Bloomberg. We'll catch up a little bit later, I'm sure. Will Kennedy on the oil market and what we're seeing develop in iron ore as well. Iron ore near 4-month highs, and if you listen to Vale, number 2 producer of iron ore worldwide, the outlook's good. Compare that to some of the doom and gloom around the China story, and you've got a number 2 producer of iron ore on the planet saying the outlook looks pretty good. It's encouraging, to use their word.
It is an incredibly confusing moment. That's all I can say, because on one hand, you do have industrial investment in the U.S. and even in Europe. So at that level, you are seeing potential increased spending there that could overcompensate for something going on in China. But it is confusing. I do want to just bring you this correction.
Sure.
It's an important one. I was looking back at that story about the routes that actually were $20, and it was Cleveland to Orlando and Detroit to Atlanta. It was not Cleveland to Cincinnati. There also were some from Mexico to Central America for $115. That's what I was looking at.
Okay. You just don't like Cincinnati.
No. My father was born there. It's not like I have anything against it.
It's just a name of a city that popped into your head that you might not want to go to.
No, I wasn't making any comments. I was just saying.
Deutsche Bank.
Thank you.
It's coming up a little bit later on the FX market. The dollar stronger for 8 consecutive weeks, and the pushback from Japan, from China. That story up next. entertainment may be. In the FX market, the bond market, and perhaps in here too, crude, testing the highest mark since November after OPEC Plus leadership announced they would extend supply cuts through the end of the year with a monthly review, for whatever that's worth. Brent crude retreating just a little bit this morning, just south of 90 on Brent to 89.62, but this after delivering double-digit gains over the past 2 months. That's a 20% move on WTI in 2 months. On Brent, that's a 17% move.
And we were just talking about the airlines coming out and saying that they are facing some serious increases in diesel costs. Well, diesel prices have climbed more than 40% in the U.S. and Europe since May, just to give you a sense of how much that's been an increase, which raises a question, why now is Saudi Arabia doubling down on production cuts? I think it's 1 million barrels per day that they're cutting production, being bolstered by Russia. Is it just because they can? Is it because they want prices to be $100 a barrel? There is a question. What is the target that they have?
The strategic midterm reserve is not available to drain this time
absolutely
around.
Gone. Yes, exactly.
They're meant to be rebuilding that, aren't they?
That's a big issue.
That's a complicated effort now.
Because they can't. They said that they were going to rebuild it at $70 a barrel. Well, we got to $70 a barrel.
That was a few months ago.
And they did not rebuild. So here we are. And there's a question, especially heading into the election. Forget midterms, the election. How do you handle this? And what are those conversations going to be like over in New Delhi?
I'd go a couple of steps further on this crude move. It's happening at a time where everyone is really, really downbeat on China. Pretty much everyone on this program, with the exception of maybe Jay Poloski over at TPW. And it's also happening at a time where crude output in this country, in the United States, is getting close to record highs again. So crude output close to record highs in America, doom and gloom over in China, and we're back to 90 on Brent. That's quite something, given all of that.
I don't understand the oil market. I didn't understand why it went down as much as it did earlier. People were saying it's partly because of the financialization of the market. I don't understand exactly what Saudi Arabia is doing and why it's reflected in this market. But I think, to your point, the fact that it's not just oil, that it's also in other commodities, tells us that this is more than just supply and demand.
Some warnings from United Airlines and Alaska Air in the last 30 minutes, as Lisa indicated. Lisa also pointed out this story, so let's finish there. Investors betting against an ECB rate hike next week are, quote, maybe underestimating the chances of it happening, according to Governing Council member Klaas Knot. Knot calling a further hike, quote, a possibility, but not a certainty, and adding, I continue to think that hitting our inflation target of 2% at the end of 25 is the bare minimum that we have to deliver. That meeting taking place on September 14th, a week tomorrow. Alan Ruskin joins us now, Chief International Strategist over at Deutsche Bank. Alan, talk is cheap. Japan is talking a lot. Will verbal intervention work?
I think you hit the nail on the head. Talk is cheap. They're really fighting a strong dollar above all else. So they don't really have control over the big dollar story. They do have some control over the yen. If they really want to strengthen the yen, then they do have the tools now. They've effectively freed up the 10-year yield to move above what is now their latest cap at 65 basis points. So they can let the 10-year yield drift up. The equilibrium rate's probably somewhere between 1% and 1.25%. If we did see a 50 basis point increase in the 10-year yield, that would do it, I think. That would do a lot more than intervention is going to do as far as capping dollar yen.
Right now we are seeing that 10-year the 10-year Japanese bond at 65 basis points, which is sort of shocking given where it's coming from, just in terms of how much it's crept up. Alan, what is the line in the sand for the Bank of Japan? It seems to be moving in terms of the yen, and at what point it is too weak.
Yeah, I think it's fortunate that it's moving because lines in the sand are open to market attack. We've consistently seen verbal intervention in this sort of 145 to 150 range. You would think that if the yen is being singled out for weakness and we move above 150, then on those two conditions, really, some intervention could well be seen. But I think it's going to need to see something a little bit different from what we're seeing right now, which is the yen being singled out for weakness. In general, we're seeing a lot of other currencies under the cosh. China, same sort of story in some sense. I don't think the Japanese can say there's a Japan story in particular.
Although in Japan, it's not a positive thing. They don't want to see a currency that's this weak. Over in China, there's a question of maybe they want a weaker currency. Maybe they'll actually help juice growth by increasing exports. At what point Is a weaker yuan a positive for China versus something they want to intervene with?
Well, I think it is a positive. The authorities might, look at it somewhat differently. There are all sorts of things like national pride that get roped into views on the exchange rate. But I think if you looked at the pure economics, you'd say, look, China's facing deflation in its asset markets. It's facing disinflation in its goods market. The exchange rate is a very natural safety valve to allow for policy easing that you can't enact anywhere else. You've got interest rates extremely low at the moment. You've got liquidity on the soft side. So the exchange rate's a natural vehicle, I think, to actually ease up.
Alan, if there are benefits from that, why are they setting such an aggressive reference rate? What do you think that's about? Concerns about the pace of the move?
Yeah, I think at the moment it does seem like the authorities care an awful lot about the levels and, the level vis-a-vis the dollar in particular. I think there are elements there, as I said, where, the weakness that you're seeing, I think they don't really want the exchange rate to be another source of instability. And it is obviously something which the markets can really latch onto. It's very visible in a way in which the property sector problems are much less visible. So I think they, in some ways, trying to control the things that they think they can control for the time being, probably paying for time to some extent, because, if the Fed does eventually cut rates in 2024, you do have the basis then for a somewhat weaker dollar, and it takes some of the pressure off the Chinese authorities.
Do you think that the dollar has appreciated so much, though, Alan, that it is presenting some sort of stability risk more generally? At what point, how much further does it have to go to actually shake things up just because of some of these pressures over in Asia in particular?
No, I don't think it's a stability risk. Honestly, I think disinflation and deflation are the stability risk. I think the Chinese authorities have the capacity to manage some weakness to the extent that the external accounts are still pretty strong. Exports are pretty much doing what the rest of Asia is doing, but they could be stronger. But the current account is in solid surplus, and I think that's going to cushion any particular weakness. I don't think they need to be too afraid that all of a sudden the yuan is going to drop precipitously.
Alan, thank you, sir. On foreign exchange, Alan Ruskin at Deutsche Bank. We need to talk about this right now, just to jump in and get you some more news from the airlines. 3 names to look at in the pre-market: Southwest, Alaska, United. Updates from all 3 in the last 40 minutes or so. Southwest getting hammered, down by close to 6% in the pre-market. An update from them: they had seen third quarter fuel costs at $2.55 to $2.65. They now see third quarter fuel costs at $2.70 to $2.80 per gallon. This after Alaska Air had to come out and basically do the same thing, now seeing fuel costs per gallon of about $3.15 to $3.25. United first out the gate about 40 minutes ago, saying jet fuel prices climbed over 20% since the middle of July. That new range for fuel prices in the current quarter, $2.95 to $3.05. The question we're asking: have they got to eat this, or can they pass it on? Southwest, with this headline, they continue to expect solid profits in the third quarter and a full year, Lisa, for 2023.
And United Airlines, in a similar vein, said that they're going to reiterate their guidance. So they're not lowering their guidance for profits, even on the heels of an increase in fuel prices, which really raises some questions around how much they can pass along versus cut costs in other areas, how much this really points to that stickiness that we keep talking about, especially with increase in real incomes.
I imagine, based on what we've seen in the last 40 minutes, we'll get an update from American and Delta, no?
I guess
in the next couple of minutes.
I was actually just looking as to why we're getting all of these now. What's sort of the impetus and the occasion for everyone to be updating on oil prices, other than oil prices are up, so it's a nice convenient excuse to put out there ahead of earnings season. Nonetheless, yes, we will get others, I'm sure.
Highs for the year, and we've said this repeatedly already this morning, highs for the year, even with what's developing in China. And it's not just crude that's rallying, it's iron ore as well. So just how bad are things in the Chinese economy at the moment? Leland Miller's going to join us next, co-founder and CEO of the China Beige Book. If you're struggling to get clarity on what's happening in that economy right now, this is the man that might give you some visibility. Live from New York City this morning, good morning.
The top names in climate climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
A record year of growth, hand over fist all year.
We're just getting started.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, today on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
So what we've seen in recent months is a substantial slowing in the economic conditions in China. And because our economy is closely intertwined with the Chinese economy, we are not and will not be immune from a slowdown in China.
Just to state the obvious there, the Treasury of Australia facing some headwinds from that slowdown in China. From New York City this morning, good morning. Your equity market looks like this. This Wednesday morning, equity futures just a little bit softer, negative by 0.2%. Yields a little bit lower by a couple of basis points. Your 10-year, 4.2420 after a big move over the last couple of 2 days. On a 10-year yield over the last 2 days, a 16 basis point move. Friday and Tuesday, remember, we took a day off Monday, although it doesn't feel like it, Bramo. That rant, I'll save that for later. 424.20 on a 10-year. In the FX market, a euro 107.39. Just about showing some strength here on the euro side of things. Positive by 0.16% on that currency pair. Some strength in the face of some weak data over in Europe, Germany specifically. At the same time, a hawk on the ECB, umming and ahhing about the possibility of hiking, Lisa, a week tomorrow.
Umming and ahhing is probably the best way to put it, because he didn't really commit to anything but wanted to juice up the expectation that you could get a rate hike. It just is unclear where we are in the monetary policy. And I do think that the Bank of Canada coming out in about 3 hours is going to be interesting. If they hold the new hike, and does that give people confidence in some sort of growth?
We're cutting elsewhere. You see the moves in EM?
Yeah, it's insane.
They're cutting there.
Yeah, but
they're the original front loaders.
Sure.
They are the original front
but
loaders.
But cutting from what, 13% to 9%?
Yeah, like double digits.
So I mean, at a certain point, are we talking really apples to apples?
We're not at all. It's a different beast. It's just EM versus DM. It's certainly not, and never will be, apples to apples. Leland Miller joining us now, co-founder and CEO of China Beige Book. Leland, great to catch up with you, sir. We're all trying to work out what's happening in the Chinese economy. Everyone's saying it's bad, and then we look at iron ore, 4-month high. We look at crude, new highs for the year. Leland, how bad is it?
Well, the discussion in Q2 used to be about, we're going to see a big recovery, we're going to see a mild recovery, we're going to see a tiny recovery. The discussion has moved dramatically to, is China collapsing? And so it's pretty easy to discount that out of hand. We're getting new data in. China's not collapsing. Property's a mess. But most of the rest of the economy is chugging along. Things are not going great, but people like to focus in on one area of the economy, which has particular woes, which is property. And you see the shadow banks wobbling. And so you see problems across the economy right now. But, manufacturing is holding up better than we thought. Consumption is still disappointing, but you've got areas of services that are still doing pretty well. in our revenge spending basket, not doing too bad. So look, this is not an economy that's doing particularly well, but you have to contrast that with market perceptions of how the economy is doing. And there's really no comparison that China is doing far better than what people think.
To your point, Leland, the focus is always on where the drama is, the mess. What's the relationship between the mess, the property market, and consumption more broadly in China? Not just right now, but historically speaking.
Well, look, if we take the big picture on this, it is intertwined because historically 70% or so of Chinese households have had their savings invested in property. So if you see property prices going down, you see, chaos across property, people worried, then they're going to spend less. Maybe they're saving more. So some of this is intertwined. But you have a bigger problem, which is confidence in the economy. And I think that's why the consumption sectors haven't jumped the way a lot of people expected them to this year. But the property thing is still a very different dynamic because it is happening because Beijing is allowing it to happen. For 3 years, we've been talking about the fact that Beijing wants to diminish the role of property as a growth driver in the economy. They're doing that. Everyone said they should do that. But now that they're doing that, the market's saying, oh, no, wait a second. This is scary. Give us stimulus. That's not the way it works. So this is a tough process.
Leland, you said that China is doing far better than people think. Is that in the short term or is that in the long term or both?
Great question, because yes, I am talking about cyclically. Structurally, we are in for a long-term slowdown. I mean, this probably sounds like I have a bumper sticker on it because we do. We've been saying this for years and years when, rates were up at, our growth rates were up at, 8%, 7%, 6%. Say, look, the economy is structurally undergoing a slowdown that is going to take it into the very low single digits. That is not changing. What we are seeing right now, though, is coming off COVID zero. There's a bit of a cyclical bounce back. Things are not great in 2023. They're better than they were in 2022. So look, that as long as you don't have long-term expectations that things are going to get materially better and jump back up to the old rates of growth or revert to the old stimulus playbook, then you can sort of manage this in a relatively sensible way.
But if markets are a discounting mechanism and trying to look forward at something that is subpar growth, at least relative to recent history, and if you're looking at a lot of policy ambiguity as far as where the government's going to step in and push different weights to balance or unbalance different industries, why would you have any conviction to invest in an area, especially at a time where we hear so much about decoupling or people and countries moving away from China?
Well, part of what we've done over the past decade is tell companies, look, be very, very clear on what you want to accomplish in China. If you think you're going there because it's the growth engine of the world, then you've got a very bad China strategy. If you're going there because you want to build up China operations to be able to cater to Chinese consumers, and you're taking care of supply chains that they're not getting intermixed and they're not going to fall victim to geopolitics or to politics, then that's a different story. There is a China growth story. It's just not the one that people have been running on for the past 10 years. So you have to be very careful about, if you're in China as a corporate, why are you in China? What are your goals? Because 5 years ago, people had big goals and they're just not achievable anymore.
In China for China is a phrase we've heard tons of from various guests, Leland, over the last year or so. Leland, I want to talk about what's happening domestically in China and the breakthrough that we saw from Huawei over the past week. Leland, how key is that for Chinese ambitions?
It's tricky. So the Huawei breakthrough is the idea that China can produce advanced chips. There have been U.S. export controls. Are they evading these export controls? Are they beating the export controls? I think that what they have done is created an advanced chip that looks like it's scalable in some fashion. That in alone is a sort of big deal, but the yields on this are reportedly not that high. They're just throwing money at this in order to develop their chip ecosystem. So the lesson is not that export controls are failing. The lesson is probably that export controls have too many Swiss cheese holes in them and need to be bolted up, but also that the Chinese can brute force some of this, but not most of it. And it's a very difficult long-term strategy if their strategy is to brute force all this.
There's so much chatter about that over the weekend, including this story that Xi Jinping won't attend the G20. Leland, what should we read into that? The importance of that, not from our perspective, but from their perspective, from the Chinese Communist Party's perspective?
Well, look, there's all kinds of rumors that, Xi's getting a lot of feedback at home that he needs to shape up. Look, those things are impossible to verify. The lesson here should really be that we can't put ourselves in Xi's head because she makes different decisions than most people in markets would do if they were in charge of China. For the last couple of years, all we've heard is Xi Jinping would never do this because he'd never kill the golden goose. He'd never do that because he wouldn't kill the golden goose. If COVID zero didn't break that mindset, I don't know what will. I think we have to be very humble in trying to guess the intentions of Xi Jinping. What he signals is that he is going to be, focused on slower growth in the economy. He's going to be focused on, building up China from a national security perspective, trying to insulate it as much as possible from U.S. leverage. I think we can, we can invest in those ideas, but I think trying to guess what he thinks from day to day is very, very difficult.
Leland, well said. It's great to get your take. Thank you, sir. Leland Miller there of the China Beige-Book. Lisa, to his point, people who have played that game, tried to get into the business of being in Xi Jinping's head, have found themselves on the wrong side of the story many, many times over the last couple of years.
You can get every kind of narrative that you want around what he's thinking or what he's trying to do, and every single time you're probably going to run up short in terms of different actions that are unexplainable. This is one example we saw yesterday, talking about banning iPhones for certain government officials in certain government practices. This question of, well, they don't want to kill the golden goose, and yet they do have an integral relationship with Apple. Are they willing to sacrifice it in part to really put forward their own industry? These are some of the questions that a lot of people say they would never do that, and yet. And that's some of what's coming to the fore.
Are we surprised by that, given that some government agencies aren't allowed TikTok and all of that stuff? We see that all the time, don't we?
I'm not surprised by that, but I am surprised, given some of the rhetoric that we hear, that they both need each other, that Apple and China work symbiotically. If that's the case, why do you want to, give a slap across the face?
Would you say that Apple needs China more than China needs Apple?
I think it's difficult. I would defer to somebody else. There are a million people who are employed by Apple. Yes, of course, as a company, maybe, but I would have to look at the numbers.
All right.
I'm very diplomatic.
Very diplomatic.
Very diplomatic.
Just wanted your gut instinct on that story, Ramo. And Meleti of Allspring Global Investments is coming up. Your equity market on the S&P, slightly softer here. We're down by 0.2%. From New York, this is Bloomberg.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus. And I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park. And that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit Search Go to find answers now.
The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
We've all been there. You get invited to go to Kyrgyzstan, where you're turned into a YouTube kids show star. Build a satellite and play a game with a goat. The point is, Hello World is back, and you should watch it. Thursdays on Bloomberg Originals and Bloomberg TV.
I think the rally does have legs.
There is a slowdown that's underway, that there's no question, but I don't think people are positioned for it.
I think it's going to take a while before we see a flatter yield curve and before we see a situation where inflation has come down.
There's a little bit of a fear in this higher for longer type environment that yields go even higher.
The risk is that the Fed is prematurely declaring victory.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Your equity market on the S&P negative here by 0.2% on the S&P 500. At the epicenter of the conversation this morning, $90 crude, and the airlines have a bit of an issue here. Lisa, in the past 60 minutes or so, we've heard from United, we've heard from Alaska, we've heard from Southwest.
And all of the comments are the same, which is oil prices are going up and it's causing a significant increase in their costs, which is concerning considering it's one of their biggest costs, and it's unclear how much they can pass along to consumers. And that is what is underpinning this. How sticky can this be in inflation?
Southwest down by 4.5% in the pre-market. They had a line on that, Lisa. They said they continue to expect solid profits in the third quarter and for the full year 2023.
I'm trying to square this with this idea that you're seeing more pushback, the idea of discounted fares increasingly written about, if not seen by anybody who I know. But there is a question going forward about whether there's going to be real margin compression, not just with the airlines, that might be the most obvious candidate, but margin compression as a result of higher commodity prices, which are happening despite some of the warnings that we hear with weakness in other parts of the world.
Plenty of Fed officials that we've heard from, including Patrick Harker, who we spoke to from the Philadelphia Fed over in Jackson Hole a couple of weeks ago, want to put rate hikes on ice. And then you've got this move in crude, and you wonder if that complicates things again, looking ahead to CPI a week from today.
You asked the right question. Is this because of demand? People are just going everywhere and so excited and growth is so robust that you're seeing that increase in prices? Or is it supply? Is it because of the supply cuts that you're seeing out of Saudi Arabia and out of Russia? If it's the supply side, maybe the Fed doesn't have to do anything, because maybe this isn't about growth at all. This is just simply actually disinflationary, because it will take money out of people's ability to spend. If this is driven by ongoing demand and the ability to pass along price increases, that is a different story for the Federal Reserve.
Two very different stories. Now, I want to be really specific here. The Federal Reserve officials there talking about putting rate hikes on ice. The ECB this morning, anything but. Two officials, two speakers in the last couple of hours. Klaas Knot of the Netherlands spoke to us a little bit earlier this morning here at Bloomberg, and he said this. He thinks the markets may underestimate the chances of a hike a week tomorrow from the ECB. And seconds ago, we hear from another ECB official, Lisa, saying September, that hike would be preferable to hiking later on. So the Hawks are going into this meeting, I wouldn't say screaming, beating the drum, banging, going loudly into it and saying, let's hike, but certainly opening the door to that and introducing some two-way risk into that meeting.
And you have seen the probabilities implied in markets creep up. I think it's about a 35% chance now that there's going to be a rate hike next week at the ECB meeting. This raises a question of what they're trying to do. Are they actually considering a rate hike, or is this trying to jawbone a market into being more restrictive so they have to do less? And these are two different things, and we've been playing this game for a while. Are they in a different spot? I think you made a great point earlier. Do they have to address stagflation directly? If they don't, do they have credibility?
Well, let's get someone in that news conference to make them.
Bake them?
Yeah,
Are you
just
planning to take a trip over there?
In the presser. I'm not going. I get invited still.
Let me tell.
I still get the invites.
Why don't you ever? You should show up.
I still get the invites.
Jonathan Ferro from Bloomberg
That's such a TK move.
It would be so good.
I'm going to Frankfurt next week just to sit in the press conference and try and get a question. Absolutely not. Let me look at the FX market just briefly. The euro showing a bit of strength off the back of these headlines, just a bit. We're positive here by 0.2% on that currency pair, 107.45, even with some terrible data out of Germany, factory orders. Incredibly volatile, I know, covering that month to month, but still deeply negative. In the bond market, yields a little bit lower by a couple of basis points on a 10-year 424.20. And equity futures a bit softer here, Lisa. On the S&P 500, we're down by 0.25%.
The ECB hawks are really pushing against a groundswell, and central banks have developed markets around the world, which is let's hold, let's wait, let's see. Bank of Canada is likely to be the next one to do that. 10 a.m. coming out with their rate decision. The expectation is for them to hold at 5% because growth is weakening. You are seeing around the edges, even though inflation is high, some measures of economic prosperity are starting to diminish. At 2 p.m., we get the Fed's beige book. Anecdotal evidence. How important is it at a time where you do see the Atlanta Fed GDP now, GDP forecast come in at near 6%? Is Patrick Harker of the Philadelphia Fed really leading the charge when he says anecdotes might matter more than some of the other hard data indicators? And today, central bank speak, there's lots of it. Bank of England's Andrew Bailey speaking at 9:15 a.m. Boston Fed President Susan Collins and Dallas Fed President Lori Logan speaking later. To me, how much do they want to push on this hawkish tone, if not substance? Does it matter? Does this lead to some sort of move in markets, or are people just basically saying, show me, don't tell me, because I know what you're doing?
I might actually read the beige book later.
I think I will too. I usually do, actually. Tom will not.
No, Tom never does, but I might actually. I know you do every time it comes out, but I might actually read it this time.
I hope that you're starting to appreciate that it actually is interesting and important, because you always say, yes, you always say to me, you're trying so hard to make it interesting, and it's not at all, but
Patrick Harker made it interesting at the Philadelphia Fed.
He did.
Dallas Fed Manufacturing recently, some of the feedback they had from various industries, that makes it interesting too. I'd be surprised if it was strong, based on what we've heard from a couple of Fed officials.
And based on what I've heard from certain friends who are small business owners who say it's going to get a lot harder. They don't have the same leeway without that ability to lever up.
You've got to talk more about these friends and these businesses. Try and get a lead on what's in the beige book. Do they contribute to the beige book?
Moving on. No, they don't. But it's sort of, the restaurant industry and some of the smaller businesses in New York City. And what happens if there is a fall off in certain areas or removal of certain outdoor spaces? How do you compensate and still pay the higher overhead? Very big concerns.
These aren't friends in Cincinnati. Based on what you said.
Honestly, I thought you said you were going to give me a pass.
Is
this where it comes back to hurt?
Head of Equity at Allspring Global Investments. And great to catch up with you. Lisa and I were talking about what's happening with some of the airlines this morning, talking about higher fuel cost moves of something like 20% since the middle of July. And Lisa and I asking the right question, I think, is whether they have to eat it or they can pass it on. And do you think the consumer tolerance is still there to pass on higher prices?
I think it's going to be a little tough, Jonathan. I mean, the consumer really has taken on a lot this year, and they've gotten a little bit of relief, but honestly, there's a lot of consumers that think they really just haven't seen as much relief as they need. And so remember, travel is something you can cut back on, and I think we will tend to see that. Also, remember, we have seen corporate travel start to come back. And corporations do have a limit too with budgets. And if airline prices get too high, you might start to see some corporations pull back on their travel spend as well.
There's a larger question, Ann, about just higher oil prices and what that does more broadly to equities. Is it supportive in the sense that it does drive up the prices of energy equities in particular, or is it depressive because you are going to see more margin compression, more pressure around the edges when people are getting aware of prices?
You hit the nail on the head. I mean, it's a double-edged sword for the energy stocks in particular. It's a positive in the near term. And, look, it's been a tight market, a tight supplied market. That's been good for most of the energy companies this year. Also, we've seen a lot more discipline. This is something that we've talked about before in the U.S. producers. And so that's been good. However, the higher the energy price goes, the more difficult that is on company margins. And it is an input to so many companies. So that will continue to be a challenge. I mean, one of the questions we were asking yesterday is, does energy drive the economy? Or does the economy drive energy? It's like, what comes first, the chicken or the egg? And we know it has a big input into the economy. But because there's fewer suppliers really in the market today, and you and Jonathan were talking about this, just a much tighter supply market, the price is much tighter controlled. I think the only good thing about this is the Saudis really do not want to see prices go above 100 or stay above 100 too long. They know that does damage demand, and they don't want to do that either. So I do think there is this fine balancing act that they're trying to create. Whether or not they're successful, that'll be interesting to see.
So if you put this to the side, if you say that this is a controlled move in response to a very specific price bogey that Saudi Arabia has, what are we looking at in terms of understanding the market action over the past couple of sessions? We've seen yields up, even on some Goldilocks type of information. And we are seeing the real gains still coming from the big tech drivers, which used to be supposedly interest rate sensitive, but now suddenly aren't. Is that going to be just basically the de facto go to those, even if everything else isn't working?
It's a great question. I think it's been a little head scratching for some investors. When you really study it, I think when you take a look at what's happened so far this year, it's been frustrating, I think, for some of our investment teams as well. But earnings growth really has come from some of those big concentrated, tech names in the large cap space. When you look at where earnings growth is going to come from, though, it does start to diversify a lot more, and it goes down cap. And we've been talking, I know on your show I've mentioned small and mid cap, and that is a space to be. We thought the market would diversify. That did start to happen in June, late June and July, pulled back a little bit in August, but we do think that that will continue to happen. Also, as you look across sectors, I do think other sectors will be more attractive when you look at, again, where earnings rebounds will happen. And there is reason to be concerned that you will see a little bit more earnings pressure on some of those large cap tech names.
Small caps got hammered yesterday, down by 2.1%. And thanks for the view. Anne Maletti there of Allspring with their view from their desk. Lisa, from my desk right now, looking at the Russell, that was tough. That was tough for the small caps yesterday.
Did you see the home builders?
They had a tough time of it too, yeah.
Slammed, and a lot of people saying that was because of the rise in real rates. But we've been seeing that all year. I don't really understand. It was the worst day for them since October 2022.
Great line from Richard Bernstein, who I'm going to catch up with a little bit later. This quote here: "The performance of the Magnificent Seven versus the Russell continues to stretch. We should all hope this doesn't continue because the implications for the US economy are dire. We're simply not that bearish." My first question to him today: is that hope or a strategy? Is that hope or a strategy to expect that to close anytime soon?
That's a good question, especially as people say that AI is going to control everything and it's going to cook your meals and clean your home and drive you to practice. I mean, there's a
great career hedge, isn't it? Just allocate some capital to AI.
Well, and that's the reason why people keep going into it, even as you have Rob Arnott coming out yesterday and saying that it's a big bubble and NVIDIA is leading the charge. So at what point do you have some sort of reckoning, especially if the earnings, as we just heard from Anne Maletti, are delivering, even as you're seeing some motley performance in other areas?
That's what I loved about things earlier this year. Certain investors that said, yeah, it's a big bubble, I'm going to have some. I'm going to have some of that.
Ride the bubble.
Totally.
I'm all in on the FOMO trade.
Massive gains.
Yeah, I mean, and they won. I mean, this is the question, though, going forward, can it continue? I thought it was interesting, though. Real yields going up. That used to be a killer for tech. Suddenly, they're the haven. They actually outperform better than everybody. And you have rate-sensitive areas absolutely getting slammed.
If you are just tuning in, welcome to the program. Equity futures here negative by 0.2%. Coming up in about 45 minutes from now, we'll catch up with David Leibovitz of JP Morgan Asset Management. A wonderful quote from Jim Bianco of Bianco Research, who we spoke to yesterday. He said the contrarian play is short bonds on no recession, sticky inflation, no cuts in 2024. And in his view, that move in crude contributing to that story.
How contrarian is that now? We're hearing that from more and more people.
Data, Bianco, they like to be contrarian.
Katie Kaminsky, and it was contrarian maybe a couple months ago. Increasingly, it's not, which is the reason why you haven't seen yields come in dramatically on the long end, even though people are still talking about going back to some sort of low rate reality.
What is consensus? I'm so pleased you asked. This from Jeff Rosenberg of BlackRock to TK on Friday. A Gradual decline in inflation, leaving the Fed to have to cut rates, not because it is a hard landing or because they're overly tight, but because it is avoiding becoming overly tight to maintain restrictiveness. That's consensus apparently in the bond market. Hey, Rosenberg, something like that.
A lot of people are looking for that. But
they say those things, but then they don't like to use the G word.
We'll use it.
Don't like to say it. From New York, good morning.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
Through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
I'm glad to welcome our colleagues back. Now, one particular moment of my time back home has received its fair share of attention in the press over the past week. But I assure you, August was a busy and productive month for me and my staff. Every Kentuckian I met voiced the same message. There's too much government and too little being done to boost the economy.
That was Senate Minority Leader Mitch McConnell returning to the Senate after the summer break, freezing for a moment for the first time in a couple of months, a delicate moment. That note there, I met many Kentuckians who said the same thing. There's too much government, too little being done to boost the economy. At least I have to say, according to most polls, there's too many politicians who are too old down in Washington, D.C. on both sides of the aisle that just won't retire.
And we're going to hear more about that from Mitch McConnell himself today. Probably there's a meeting of Senate Republican leaders, Senate Republican members who are going to come together and maybe ask him about that and give him a chance to respond. What's he going to say? Is it up to him to decide whether or not he steps down ultimately? Or is this something that Senate Republicans can really push?
AMH joins us now. Anne-Marie down in Washington, D.C., our chief Washington correspondent. AMH, let's speak to that. Did he really address the concerns about his health over the last few weeks?
Well, listen, it was an 8-minute floor speech, and he talked about that, quote, particular moment that happened most recently, that happened in August. That was the 30-second freeze, but there was the 20-second freeze as well in July. Very sad, uncomfortable that this was all played out in public for the Senate Minority Leader Mitch McConnell. What we did hear is from the congressional physician who said this has nothing to do with a stroke or this has nothing to do with seizures. Remember, Mitch McConnell fell earlier in the year, suffered a concussion. Potentially that is just him still recovering from that. But it is an elephant in the room that will be discussed likely today, as Lisa mentioned, when Senate Republican members meet. And what we heard from Senator Thune, who is a top contender, part of the leadership structure in the Senate on the Republican side, Senator John Cornyn, another top contender, part of the leadership structure, and he's from Texas, is that this is something Mitch McConnell does want to address and be a bit more transparent about. So maybe behind closed doors with his colleagues, he will be a little bit more transparent about what is going on with his health. We only got really a snippet, I would say, into that window.
Don't believe your lying guys. I think many people find this incredibly frustrating, Anne-Marie. Who are these doctors that say these presidents have clean bills of health when we can all see that there is something wrong here? And it's not just Republicans, it's Democrats as well. Dianne Feinstein, a senator we talk about a lot. Who are these doctors giving these clean bills of health when we can all see something's not right?
Well, this is the congressional physician, Brian Moynihan. I don't personally know him, but he released this statement yesterday via McConnell's office as well. And I do think Senator McConnell's team wants to be as transparent as they can. So I'm not even sure they would have had to have released that doctor's note, but they did. But Jonathan, the point you're bringing up is that obviously anyone who is witnessing these moments, whether it's Dianne Feinstein, senator from California, being told to vote yay. She was obviously very confused where she was in that moment after coming back with a bout of shingles. And then Senator McConnell freezing up twice this summer. The public sees this and they want more answers. And there's also a lot of polling to the upside of individuals and voters who want to see term limits enacted or age limits or mental acuity tests, because there is a concern that America, we're just living in more of a geriocracy than a democracy.
Anne-Marie, there's a real concern here on a policy front, too, in terms of timing. If Mitch McConnell's leadership is questioned in any way, what does that mean for the negotiations having to do with the budget and government shutdowns potentially later this month?
Well, he addressed that yesterday, and there's one key moment before he froze up last month in Kentucky, is right before that episode happened. He said it's going to be a real big mess. So they have a federal spending issue because the government runs out of money September 30th. They need to either vote on a continuing resolution, because it doesn't look like they're going to get all the 12 appropriation bills from House and Senate and then go into a conference done in time. There's just a number of legislative days they have left. On top of that, there's another issue, but potentially it'll be linked together in one bill, is this supplemental funding. And Mitch McConnell spoke about that yesterday, because obviously when you see a divide among some Republican voices about aid to Ukraine, what the White House is asking for in this supplemental funding package is more than $40 billion. Some of that will go to aid to Ukraine, which Mitch McConnell says we need to vote on for national security purposes, but also money for disaster relief, what we saw just take place in Florida, in Maui. So this is going to be a showdown, not just between Republicans and Democrats, but between the House and the Senate. And Mitch McConnell has always been one of those individuals who can really maneuver the Senate and make sure bills that he deems worthy do get passed and over the finish line.
That's where I was going with this. Without his leadership, who takes that role? Does anyone take that role? What does that mean in terms of the likelihood of a government shutdown?
Well, listen, there's potential there's going to be a government shutdown, whether or not Mitch McConnell is going to be the leader. But this vacuum potentially, he does have a succession plan, although it doesn't really talk about out in the open, but there's 3 Johns everyone talks about, Cornyn, Thune, Barroso, that could potentially fill this role. But right now, we should note, no one is publicly, besides maybe a few like Josh Hawley, who voted against him in the past, no one is publicly coming out and saying Mitch McConnell cannot do this job. Actually, the opposite. What you see is that a number of individuals are rushing to his defense and saying, right now, we do have a lot of faith and backing of Mitch McConnell. Potentially, they want to see this through the end of the presidential election. Remember, Mitch McConnell is not just whether you like him or not. He is a very successful legislature in what he does on the Senate. He has immense institutional knowledge. His super PAC is also the biggest when it comes to money. So he is prolific when it comes to raising for the GOP. So right now, there's no out and open calls for him to step down. But potentially, this is something we need to watch, because these are serious health concerns.
4 Johns, potentially. No one needs that. No one needs that
What,
today.
are you making an announcement?
Nobody needs that.
Okay.
Anne-Marie, let's talk about crude. $90 a barrel.
Highlight of the show.
No more nightmares.
Carry on.
AMH crude, $90 a barrel.
The
What's
senator
the White House?
from London.
Yeah, that could work. What's the White House saying about this move in oil? Jet fuel starting to pressure the airlines. Could complicate things.
Well, gasoline prices is something that Jake Sullivan spoke about yesterday. He was on the podium previewing the president's G20 trip, and he was asked about this because you have Saudi Arabia, an ally, and Russia cutting, and the Saudi cut is just more prolonged. And we saw Brent crude go through $90 a barrel. Gasoline prices in America are already inching up towards $4 a gallon. This is a huge concern for the administration because we're already over peak driving season, right? We're post Labor Day, and you see these prices go higher. This is something that's a huge concern because what you see in the polls is Americans are continuously worried about higher inflation and give the Biden administration poor marks when it comes to the economy. So this is something, Jonathan, that has been the bane of existence for the Biden administration last summer, and going into the fall, it's going to be one of those headaches.
AMH, thank you. Anne-Marie, down in Washington, D.C. To AMH's point, it's quite rare to have gasoline prices where they are at this time of the year, coming out of summer, going into fall.
And that's a real concern, especially going into the election season. If they're increasing at a time where people aren't driving, they're supposedly staying at home, then what does that mean to come, say, December, when people travel around for the holidays? What does that mean early next year? And even more importantly, during the election? It's going to be a big issue.
Ever had shingles? Brutal. I've had shingles.
You've had shingles?
Super severe.
Isn't it related
it's
to
horrible.
chickenpox?
I had quite a mild case of shingles, and as you get older, it can be very risky. So brutal, yes, but A, I remembered where I was, and B, I wasn't trying to run the government. And if you don't know where you are because you've had a case of shingles, then are you fit to be in a seat in the Senate?
You know, I've been hearing Nikki Haley talk a lot about this. She's been out front. She's the Republican candidate for president, and she's been talking about the need for competency tests. And there's a lot of research around whether or not it's even constitutional to do that. Will there be a push by a lot of standing ranking members that already are older to instate different measures that could put some sort of check on this?
And once again, Washington, D.C. finding themselves on the wrong side of the mood of the rest of the country. Because the rest of the country would like these kind of things to happen.
Are we looking
based
for
on polling?
Another John leader?
What, Senator?
Yeah.
Yeah, no.
More Johns?
No.
No?
From New York, this is Bloomberg.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody uses my knife, I want them to say, damn! Golly, this is a badass knife.
Viewer writes in, I don't think you're liberal enough to win the seat in New York. It's kind of brutal. I mean, they don't know my politics.
No clue.
No clue.
You were talking about being the fourth John in the Republican Congress.
Yeah.
All right. Well, it's true. Nobody knows you.
No, of course not. Equities right now on the S&P look like this. Futures. Keep it together, Brahma. It's rude.
Carry on.
Futures on the S&P, negative by 0.2% on the S&P 500. On the NASDAQ, we're down here by 0.2% as well. The Russell, tough day yesterday on the Russell. Small caps getting hammered. Not bouncing back this morning. We're down by 0.1%. Tough couple of days for the Treasury market as well. Switch at the board and get to the bond market. 2-year, 10-year, 30-year. 10-year yields lower by a couple of basis points at 423.81. The previous 2 days had a 16 basis point move in 2 sessions on Treasury. I get it. Really busy day for corporate issuance in yesterday's session, pushing yields higher across the curve. And there are days when you see that, Lisa. You start months like September, you get tons of supply from the corporate side and it kicks around the bond market. But it was Friday too, and there was a rally in crude that got everyone's attention, and you wonder what's really taken us here.
Especially if the shift has to do with this increasing, I don't want to say consensus, but less contrarian than it used to be short bet on bonds. If you do think the Fed is going to use every excuse to remain on hold, and you see longer term strength percolating out, well, then all of a sudden real rates start kind of creeping higher in the face of that.
Let's talk about that move in crude. Crude looks like this morning, 390 for the first time since November. Brent crude this morning down by 0.6%, $89.46. Some warnings about how high jet fuel prices have gone over the last couple of months, 20% higher since the middle of July, according to United Airlines. So United with a warning, higher costs, a warning from Southwest, a warning from Alaska Air, all of that later in the last 90 minutes or so.
Would you fly the same routes if the prices were 20% higher? Is it sort of the price sensitivity that's going to drive people's travel, or is it going to be just the desire to still get out there? I don't know the answer to that. And that's sort of one of the key questions underpinning this. Are they going to take that 20% move and just say, actually, that's the reason why we've got to charge you more, sorry. And by the way, reduce the number of flights going in and out so we can jack up prices.
Is business going to make a comeback? One. And is the revenge spend going to continue? Two. On the second one, I do wonder, because we were getting told by domestic airlines, domestically focused airlines through earnings season, that maybe things were flagging a little bit and they had to soften fares domestically here in the United States. The international stuff, I've got no idea. I think a lot of people have seen those things on Instagram, Italy, Greece, what's happening in France.
They saw them 2 years ago.
They want to go on vacation. They want to go on vacation. Didn't we get that in the consumer confidence survey? Didn't they say their intentions to go on vacation
Everybody
were much
wants to go
higher?
on vacation.
I couldn't work out whether that was real. If they're actually going to spend that money on vacation, or they just want to. There have
been stories about how cruise liners are getting pushback from different cities. They're saying that they're just mobbing all of the ports and that it's just getting a little bit out of control. So, which I totally agree with, by the way.
I couldn't agree more. You want to trash cruise lines? Let's go. I'm always ready for that.
I'm not going to trash them. I'm just going to say there are towns that are starting to try to restrict some of the foot traffic just because it has been so high.
As they should. As they should.
Oh, man. You are in campaign mode.
Never doing a cruise. I hate it when the cruise ships rock up. They spoil the view. You ever see that?
Yes,
beautiful port.
Yes.
Great, fantastic view.
Somewhere in particular?
Yeah, beautiful boats in the bay, some of them docking, lovely, gorgeous stuff. And then this massive thing, this tanker with a hotel piled on top of it.
Now the people come out.
pulls
and
up and just
everything.
spoils everything.
You know, I think that if people like cruises, all the more power to you. I think that there's just an issue of how much longer people can keep doing this and whether they can keep jacking up the prices.
How much longer they can keep cruising. I agree. Under surveillance this morning, Japan's government defended the yen verbally after the currency set a new 10-month low. The vice finance minister for international affairs saying, quote, if these moves continue, the government will deal with them appropriately without ruling out any options. Now, Lisa, my question on that would be, okay, what are you going to do about it?
Which is the reason why you didn't really see much of a move. The move was very short-lived. My favorite was this one FX strategist who came out and said, we have jumped from level 4 on our verbal intervention scale straight to level 6 or 7, and a warning of imminent FX intervention, and markets don't care. I just think that that's really telling in terms of where people think the follow-through is going to be.
Pushback not just from Japan, pushback from China as well. A record-setting rally in China's property sector on bets the government is preparing more stimulus. Evergrande closing up 83%. I know it's basically a penny stock, but still, what a move, making it the largest gain since its listing in 2009. China's recent property developers still reeling, however, from deepening financial problems. So this ain't over, but that was quite a squeeze overnight.
Yeah, my favorite part about this is bad news so bad that it's good over in China developers. Is this basically looking at the fact that you could have a defaulter candidate pretty much across the board in the majority of developers in China, and that's being viewed as a positive because there's no way the Chinese authorities are going to let this happen. To me, highlights just how much people believe that China's assets have been beaten up. And just like Leila Miller said, maybe it's not as bad as people expected.
Is China in focus for the Europeans as well? The largest economy continuing to feel the brunt of poor demand from China. More disappointing data out of Germany. Factory orders plummeting nearly 12% to start the third quarter. They dropped far surpassing the 4.3% expected in our survey here at Bloomberg. Difficult day for Germany. So yields higher off the back of some hawkish ECB speak. The DAX lower off the back of some pretty weak data and some concerns over in China as always. Lisa, what to do with all of that?
Germany is in a really tough spot, and I think everybody really would agree with that in the sense that their factory orders are down, probably in part because of China. They're probably the most exposed of the major European economies to China. And at the same time, services also not coming back, actually diminishing. Where is the growth going to come from at a time where Germany still has continued to really push into China? We saw that shift in tone from Mercedes recently, which I thought was interesting, shifting away a bit from China and saying maybe they aren't going to rely as much. That's new. And how much is that coming from the government?
The boom is over, based on that interview with the Mercedes CEO.
Which boom?
The boom in China specifically. I think what they underplayed was the competition domestically in China. You know, when German manufacturers just had it their own way all the time, that seems to have changed a lot.
Well, pretty much for
Where's the leadership been in German manufacturing over the last decade or so?
They are between a rock and a hard place because right now, based on where they are, they can't really change without torpedoing the economy entirely.
Allowing a sports drink manufacturer to dominate Formula One in the way they have. You know?
Is this personal?
No. Sonia Martin joins us now, Head of FX and Monetary Policy at DZ Bank. Sonia, wonderful to have you with us. I want to talk about that hawkish ECB speak from two officials a little bit earlier this morning. Is there truly some two-way risk in that ECB meeting a week tomorrow?
Good morning. Yeah, first of all, let me just quickly state that as a passionate sailor, I agree with you that cruise ships are an abomination.
You're welcome back anytime.
Moving on, but moving on to the ECB, what we have seen is a lot of division in the council. So, you know, for a long time during COVID and the last year, we saw the council, you know, unusually united, but that has changed completely now that we're nearing the end of the rate hike cycle. And you see the hawks and the doves sort of, you know, positioning themselves. And I wouldn't really count too much on what individuals are saying right now, simply because there's a split in the council and they're sort of each talking their book. And that's what we saw this morning. I think the ECB is still very much split on what to do next week. And I think it's a bit of a 50-50, and this is what the market is pricing in, on whether they will actually hike one more time. We don't think they will, but of course there is a risk given that we still have quite high inflation. But as you pointed out, I think earlier on as well, we have a lot of weakness in the economy coming through, and that's something they'll have to keep in mind.
Sonia, how much are they watching and focusing on the euro and the foreign exchange transmission mechanism at a time where you have commodity prices going up, you have a stronger than expected U.S. economy, and suddenly the euro again is struggling to climb out?
Yes, generally speaking, obviously in this sort of environment, you don't necessarily, in terms of the inflation outlook, you do not want a weaker currency. For the export market, it's of course good news. I don't think we have to particularly worry about the level of the exchange rate in the Eurozone at this particular point in time. We have been trading 110 plus minus big figure for quite a long time now. And I don't think it's something that the ECB is overly concerned with. That might change should the euro continue to deteriorate, but it would have to be an aggressive and fast move. And I think we're miles away from this at this point in time.
Why is there such a push toward hawkishness? Is there a sense, or at least hawkish rhetoric, at a time where a lot of people had priced out a rate hike next week? Is there a sense that financial conditions are not tight enough, despite some of the moves that we've seen in yields?
Actually, I think it has to do with something else. I think, figuring out when to stop the rate hike cycle is always a really, really tricky business for central banks. But it's really a lot more difficult right now than it was in the past because of the experience we've had in the last year with this incredibly high inflation. So I think what they're trying to do is strike a balance. On one side, they should signal the end of the rate hike cycle, either that it's already there or it's coming. At the same time, I think they do really want to keep the door open for additional tightening should that be necessary. So they just don't want to shut the door. So the combination, the compromise could be still quite hawkish rhetoric combined with, we'll wait and see what happens. And I think that's the most likely outcome next week.
Sonia, how much can I read into what's developing in Eastern Europe with central banks like Poland potentially reducing interest rates? Sonia, as we know, some of these countries actually led the tightening cycle before places like the ECB, the Federal Reserve, got going. Do you think they're leading the cuts as well?
Well, there are, as you said, a number of countries, also when you look at Latin America, that are already cutting rates, but they did start very early, and this is a different scenario for them. They've already done a lot, and they now have to retrace. I don't think that's a signal for anyone else per se. What it does confirm, however, is that we are seeing really the turning point in global monetary policy. And I have to say, I find it kind of bizarre that we are so incredibly focused on whether or not the ECB or the Fed will tighten one more time, because ultimately that is not going to change anything, is it? So why are we so obsessed with this discussion? Normally at this point in the cycle, what we would be talking about is the potential rate hikes next year, but that doesn't seem to be happening. We're totally focused on the next 2 weeks.
So some people are talking about the potential for that to develop. Citi's Andrew Hollenhorst at the Federal Reserve talking about that. Neil Dutta of Renmark considering the potential that maybe things pick up again. Sonia, is that a conversation in any way, shape or form at the ECB? It feels like things are a little bit more split here at the Federal Reserve. Is it over at the ECB?
That discussion isn't happening right now, but it will happen. And I suspect, and when it does start to happen, it will take some people by surprise. In fact, I would say that is also going to be the case in the US, because while the market is pricing in rate cuts next year, it's not something we're focused on right now. So what's going to happen, once we move past the next few months and we move into the winter, the economic downturn is really going to hit. And I think that's when people are going to start focusing on rate cuts. And I think that's going to create a lot of volatility in the market because, everyone's sort of ignoring that for the time being. So that is still very much in the pipeline for next year. Not early in the year, more towards the middle of next year.
Sonia, thank you for the update and for your love of sailing and your hate of cruising. Sonia Martin there of DC Bank. Sonia, thank you. If you are just tuning in, welcome to the programme. Your S&P 500 negative here by 0.2%. Just a little bit of feedback out there, Bramo. The cruise thing is going to decimate your voter base amongst the seniors.
Well,
I think some people taking this a little bit too seriously.
Are there cruises that are more acceptable than others in your view?
No.
What about to remote places where the small cruises?
One caveat. All right.
Okay,
river cruises, I think, yes.
River cruises are okay.
Smaller boats.
Okay, river cruises.
Smaller boats, more exclusive, more private, less disruptive to the environment and your surroundings.
No, don't even try to make this your environmental pitch.
Yes, absolutely.
You
Why
think
do you
so?
believe that?
Okay,
yeah,
you think that the other ones are not sufficiently environmentally friendly?
I think river cruises are a lot more appropriate.
Is it because you're looking at one river cruise in particular in Alaska?
I would consider doing a river cruise. That would be, but I'd need all of my friends on the boat with me.
All right then, fine.
Exclusive.
Okay, there we go.
That's as far as I'll go.
Okay.
All right. I want to go back to the consensus view on the bond market. Can I do that?
Please
I'm
go
do
for it.
that. Jim Bianco Research. I'll go back to that quote. The contrarian players, short bonds, no recession, sticky inflation, no cuts in 2024. Isn't that kind of what Sonia was talking about there as well?
And that's where I was going to say is basically increasingly just on the margins, entering the mainstream discussion, you're starting to hear What happens if you get that real reacceleration? And to tie it into the commodities play, what happens if the increases that we've seen, not just in oil, but in copper and beyond, in iron ore in particular, less than copper, and also in food, is really tied to strength and demand and stickiness and inflation that's going to prompt further moves early next year that's going to surprise the market? That could be a real game changer.
My environmental concerns playing well in New York, just so you know. All right, MH writes in, Rhine River Cruise. Rhine River Cruise.
Is she the one in New York?
That's what
Who's actually
Anne-Marie
DC?
would like to happen.
Okay.
AMH, a Rhine River Cruise.
Is that what you were thinking of? I thought you were thinking of the one in Alaska.
I like the idea of the fjords.
Yeah, the fjords are gorgeous.
Oh,
it's beautiful.
Yeah,
and
yeah,
honestly,
yeah.
hard to get to places, and you see the sea life. I can get behind
If you've got a massive yacht, you'd lend me, to go and look at the
I'll try to drum one up. I'll see if I can pick one out of the jet stream.
Kevin Booker, Clearview Energy Partners, up next.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
At the end of the day, we've had this just bearish onslaught of Russia news and of China news, and what hasn't gone down is crude. Crude's bottomed. It's positive in our trend work. I think Brent's on its way to 90 here. Look how the energy stocks, after a pretty meaningful consolidation or pause this year, have just regained the flag of leadership.
Getting back on the show a week ago, Chris Ferrone of Strategas, talking about crude getting to 90, crude through 90 in yesterday's session for the first time since November. Just quite the rally that's developed over the last 2 months, Lisa. A 20% move on oil.
And why? And this is really the question. Is it just because of Saudi Arabia coming out and saying, and not just because, this is not insignificant, saying that they're going to continue with a 1 million barrel per day cut in production? Or is this something more in terms of strength that is underpinning this? I mean, I keep going back to Leland Miller. China's economy is doing okay. It just isn't doing quite as well as it previously had been expected to.
Just pulled up oil production in America on the Bloomberg. 12.8 million barrels a day. Just short of 13 million. And we're looking at prices like this.
A record amount of production that's fueling, supplies at a time where, there's been some speculation. Maybe people are using less gasoline because of electric vehicles, and that's why oil demand hasn't been going up as much as it should be. It doesn't make sense if you put it all together. There isn't a cohesive narrative unless there is some strength underpinning the moves that we've seen.
Kevin Book joins us now, Managing Director of Research at Clearview Energy Partners. Kevin, what is crude doing in the 80s with oil production in America at 12.8 million barrels a day?
Well, it's prospering. It's going ahead and reaching for the skies because some of the biggest producers in the world, other than the U.S., are cutting supplies to the world. And when you look at the Saudi Arabian and Russian decisions in recent days, I think traders are starting to finally take them seriously. Prince Abdulaziz, the energy minister of Saudi Arabia, referred to the 1 million barrel voluntary cut as a lollipop. it's starting to seem like an all-day sucker, a really long-lasting effect, and that's getting priced in now as well.
Kevin, they're talking up monthly reviews. Are you saying at that monthly review, nothing's going to change?
Well, nothing has changed so far. That is a caveat that leaves room for opportunity. I think the kingdom in particular is wary of crushing economic recovery wherever it might occur and stalling the economy generally, globally. But right now, it looks like there's still room to run. So no, we from the very start, if you looked at it, the $75 barrel worked backwards from an elasticity effect. It looked like it should have been about a $9, $9.50 per barrel impact from the $1 million cutback. The market didn't price it in right away, probably because it thought it was evanescent. But now that it looks enduring, yeah, sure, we're looking at a real premium.
At this point, though, how much is this also driven by the fact that growth isn't as bad as people previously expected in places like China and even Europe?
Second half of the year is always a bigger demand part of the year than the first half. My colleague Jacques Rousseau, who you have on from time to time as well, he points out that we're looking at about a 4Q 2.1 million barrel demand ahead of supply. So that deficit is going to be pretty enduring. There's a lot of that demand concentrated, yes, in China, a lot of it in jet fuel. That increases the risks if there's some sort of hiccup over there, but it doesn't change the overall dynamic when we're looking at a sort of a seasonal effect.
There's also a question around what the bogey is for Saudi Arabia and maybe even for Russia. Is there a sense that they're trying to get oil prices to a certain specific level before they'll start to try to balance out some of their supply versus the demand?
Well, I think that there are two separate things that have to be taken separately. The kingdom is aligned with the Kremlin very explicitly as a matter of business, not politics. And if you look at the Kremlin, they've figured out that revenue is equal to price times volume. And if they're going to cut volume, a higher price works for them. The differences, though, are one country funding a war and another engaged in a very sophisticated and elaborate negotiation towards expanding the Abraham Accords. I don't think that the kingdom is looking to blow up that opportunity, difficult though it may be, and with many steps yet to come.
How important, Kevin, is it to refill the SPR? And how likely is it we're going to do that anytime soon?
Well, the Energy Department made it pretty clear, John, that there's not much interest in doing it at this price level. They pulled back from their requisition for 6 million barrels of additional volume. But how important is it? Look, that's a matter of opinion and perception. There are some who would say that the SPR was never needed, and especially not now in a world of shale. I've testified at least 6 times on the Hill that it's an insurance policy, and the insurance is cheap when you look at what it can do to prices to draw it when you need it. So I would be in the camp that it is worth refilling and should be done as soon as it can be affordably done.
So effectively, to build on what you've testified, we don't have that insurance policy right now, Kevin. So how vulnerable are we?
Well, we have 350 million barrels of oil in the SPR still, which is not trivial. On the other hand, what we don't have is the full carrying capacity of the reserve. And we don't have the clarity that conveyed when it was bigger. I think that was not only a message to the world about insurance against economic risk, but also a message to producers that if they didn't take up the slack and bring the market back into alignment, the U.S. would undercut them and take away their premium.
How awkward does this make the meeting between President Biden and Mohammed bin Salman of Saudi Arabia expected in the next few days or so at the G20 meetings?
I don't think it's going to get in the way of a fist bump. Look, the currency, the economic currency of oil trade remains the dollar, much to the chagrin of some who would think otherwise. The political currency of oil prices remains blame. The challenge for the White House is not just geopolitical, but also domestically political. The usual steps in the process of prices rising is for a White House to blame overseas producers, domestic producers. In this particular case, blaming overseas producers very much complicates the negotiation. And you saw Jake Sullivan yesterday very specifically avoid blaming the kingdom, as he and former National Economic Council Director Brian Deese did in October. And now at home, you also have producers, some of them aligned, at least notionally, with the White House climate agenda, probably not going to want to blame them, at least ahead of the Conference of Parties in Dubai. So maybe a little lighter on the blame and more room to talk.
Given that there isn't going to necessarily be a lot of action that necessarily comes from these discussions based on the unwillingness to really place blame, what is the offset? What is the off-ramp for oil prices going even higher? Why aren't we going to stay at these levels and go even higher from here for the near future?
I'm not sure you would want to bet against going higher, but they're obviously the economic fundamentals decay when prices rise. American drivers are pretty resilient. You can see that right now. On a trailing 12-month basis through July, though, we estimate that you're talking about some 600 plus gallons bought over the year through July by the average driver, more, by the way, in red states than in blue states. So there's economics and politics to that. The other side of it, though, is where you get more supply. Look, it would be difficult to say this, I think, from the White House perspective, but a certain amount of realpolitik is already at work on sanctions. The unspoken mini deal with Iran brings sour barrels to market. Sanctions leniency with Venezuela that could be crafted ahead of the election next year to induce democratic reforms. That, too, looks like another source of barrels. And maybe a certain amount of pragmatism in enforcing the price cap on Russian barrels to third countries. So there are heavily sanctioned countries where the White House can take a light touch. It looks like they may already be doing so or poised to do so.
Kevin, do you like cruises? That's all we want to know.
I like cruising in a car slowly down the street on a hot summer day.
Sounds
trapped
wonderful.
on a boat with nothing but food and booze, not so much.
There we go. We're on the same page. Kevin, thank you. Kevin Burke of
this?
Clearview Energy Partners, just rounding up the team.
Now
getting everyone on the same page.
You realize you're making me want to defend the cruise industry.
I know, that's so on brand.
Which is, well, I mean, come on, you know that's how I think. So now I'm going to start looking for arguments against
you
that.
can do that.
Yeah, okay.
I want to bring up this currency pair right here. Dollar lira. Bang. What a move. Stronger Turkish currency. We're down on that currency pair now by about 0.1%, so that's in the Turkish lira's favour. This headline right here, maybe a leopard can change its spots. Erdogan of Turkey, we will reduce inflation with tight monetary policy. That's new.
Yeah, that is. I just immediately went to the profile of the new central bank governor, Hafiz Gaye Erkan, who's this young woman who came from Wall Street to really lead the central bank. And I wonder what influence she's having over Erdogan in this new reformed way that maybe you have to follow conventional monetary policy in order to have some sort of conventional inflationary outlook.
That headline from the Turkish leader just moments ago. It's amazing to see. I wouldn't say it's surprising given what we've seen develop over the last couple of months, but certainly surprising relative to where we were a couple of years ago.
Well, yeah, I mean, if you think about it, Erdogan's response to high inflation was to cut rates because that was going to be the way to juice inflation. And anyone who disagreed with him was ejected from the central bank. So what kind of new shift in leadership is there to change this approach? And suddenly you're seeing downgrades to the Turkish outlook for growth. What is this?
I used to sit down with the central bank governors of Turkey, and I always used to say that they had the hardest job at central banking, because these were some highly credible, intelligent individuals in that seat a lot of the time. And you knew what they wanted to do, but you knew they could only go so far. It was such a tough seat to be in. That move right there, dollar lira, 26.76. David Leibovitz of JP Morgan Asset Management is coming up next on this equity market. The rally stalling just a little bit, futures negative 0.2%.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business,
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle. It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
The hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We have an unsustainably strong economy still.
Yes, things are slowing, but they're not collapsing. You shouldn't be underweight equities at this point in the cycle.
Everyone keeps saying, let's be bullish the bond market, but look at the price. Look at the price all summer. It has continued to go up in yield.
Bad news is good news when it's just a little bit better.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Alarian writes in, Nile River Cruise. Nile River Cruise.
I could get behind that.
That's the last of the cruise chat this morning. From New York City,
No way.
good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. TK with a day off. He's going to be back tomorrow. Bad news is good news, so long as it's just a little bad.
I love that quote. It's
Okay,
just
Steve
fantastic.
Cheverone of Federated.
You know, this is where we're at, is that basically you could have something that softens the outlook for the Fed, but not enough that you actually get the hard landing. So if you have growth, but you have a Fed that just to right-size things cuts rates, that's the Goldilocks that was the narrative, I would argue, a couple of weeks ago, but seems to be shifting a little bit on the margins.
Is $90 crude bad news or good news?
It depends why. It seems like people are trying to parse who it's good for and who it's bad for. I would argue for the Federal Reserve, it makes it very complicated. And I think that the airline industry very much highlighting that, coming out this morning and highlighting the increase in their costs tied to diesel, tied to crude. How much does that really end up getting passed along to consumers who just have to eat it?
Let's get those airlines up and have a look at them right now in the pre-market. Southwest is down by about 4%. The note that we got from Southwest, I think, was pretty interesting, Bramo, that essentially they're all coming out saying the same thing. Fuel prices are up. But Southwest also said they continue to expect solid profits in the third quarter and full year 2023. So to your question, do they eat it or pass it on? Are they kind of telling you what they're going to do there between the lines?
That basically, if they're going to continue to see robust profits, and you saw a similar thing from United, that they're not going to downgrade their full year forecast, they're going to maintain it. Does that mean that they are going to pass it along? We saw yesterday United cutting the number of flights that it was going to be operating domestically out of Newark, in part because there was less demand. So you just reduce supply and increase prices. I mean, are we going to see this kind of activity rather than actually seeing the discounts?
So are we getting lower fares or not? Because I thought we were getting lower fares domestically.
There was a story in the Wall Street Journal talking about $20 fares. I couldn't find them. I quickly went online and quickly looked for a couple of different routes that I personally was interested in.
And your line, not theirs, was that these are cities that people don't want to go to.
No, it's not their line. That was your line trying to infer what I was implying. But I'm just saying the less popular routes.
Okay.
That's
another way of saying cities that people don't really want to go
well,
to.
there isn't. Okay, moving on. There is a question here of some of the domestic cities and the routes there, whether it's the mid states in the U.S.
Picking on Ohio a lot this morning, weren't you?
I'm not.
If you're just chilling and you missed that. Picked on Ohio a lot in the last couple of hours.
Really, you're just trying to start trouble. You're just trying to distract me.
Maybe my Senate seat might be in Ohio. Or maybe not. Futures right now on the S&P.
Where are
slightly
we going
softer.
with this?
Negative 0.25%. TK's away.
So we have to go.
Someone's got to go a little bit crazy, right? In the bond market, yields a little bit lower by a couple of basis points here. 423.61. We've seen quite a move over the last two sessions. 16 basis points higher across Friday and Tuesday. Underpinning that move, tons of supply from the credit market. I'll speak to Amanda Liner with Goldman Sachs about that at about 9:30 Eastern time. But also, you can't overlook this move we've seen in crude. We're talking about a 20% move from mid-July to where we are right now. Just a bit softer on the session to 86.45. Right now on Brent, Lisa, 89.63.
And how much further could it go if you do have some sort of unilateral resolution from Saudi Arabia that they want to get prices higher, and it seems to be going through, and you don't have the SPR, the Strategic Petroleum Reserve, or what do you call it, the Strategic Midterm Reserve?
Many people have referred to it as that, yeah.
If you don't have that potentially coming in as something, I do just want to say Cleveland to Orlando was one of the routes, and Detroit to Atlanta. This according to a Wall Street Journal article.
I love that you keep digging around this.
Well, because it just raises this question, where are they? Because I was looking, for example, at routes to certain other places.
Places you'd like to go. Yeah.
They were a lot higher. They were still very expensive.
Okay. David Leibovitz is going to rescue you. Global market strategist at JP Morgan Asset Management. David, it's good to see you.
Good to see you.
Thanks for being with us. Let's talk about that wrinkle in the soft landing dream. It's crude. Back towards $90, just south of that now, through that level yesterday. How much of a problem might that be for this rally that's really stalled out recently?
So I think that the problem it presents is that it creates a tension between the growth story and the inflation story that creates this tension for the Federal Reserve. And so on the one hand, we're going to see headline inflation, which is what central banks obviously target despite focusing quite a bit on core. You're going to see the headline inflation number begin to move higher. At the same time, you have these higher energy prices, you have the resumption of student loan payments, you have a savings rate that has dropped relatively precipitously, and we wonder if the consumer is beginning to bend, not necessarily break, but show some signs of weakness. And this, again, creates a tension for the Fed. They want to make sure that they get rid of the inflation that's been generated over the past couple of years, but they're trying to do so without causing a recession. So their job has become infinitely more difficult given this move.
Bear with me here for a second. How important is it what happens with those extra oil costs for the airline industries? In other words, if you start to see them pass it along to consumers, does that shift the conversation at the Federal Reserve in a way that it wouldn't if it started to eat into margins?
So I think the airlines are an interesting story because they've had pricing power all along, right? As people have begun to re-engage with services and kind of put goods off to the sides, the airlines have said, we've been able to raise prices and people are willing to pay. I don't know why you would change that in this type of environment. So I think that they're going to continue to raise prices in an effort to defend their margins, but that's going to create an inflation problem. And again, at some point here, the consumer is going to need to make that decision. Do they go on the extra trip or do they hunker down and begin to prepare for a more challenging growth environment?
Do you sense a shift, and we've been talking about that this morning, from this consensus around a Goldilocks and a soft landing to suddenly something more in the Neil Dutta and the Katie Kaminsky camp of, hold on a second, what if the Fed does pause and then they have to hike rates again next year, and all of those rate cuts that are getting priced in are absolutely off the table? Are you moving to that side at all?
So I think what's interesting, if we take a step back, is that at the start of the year, everything was going really well. You know, Europe avoided a recession, China reopened and had a really good first quarter. The U.S. data was better than expected, and everybody kind of got this warm, fuzzy feeling that it was all going to be okay. What's happened more recently? China stalling out, Europe showing some serious cracks, particularly in manufacturing, and an inflation story that isn't really resolving itself the way that people would expect. I'm not sure that we have more clarity on, where we're going to be 12 months from now, but I think you're seeing investors begin to entertain the idea that maybe a soft landing isn't a guarantee, and I think that's what's causing market volatility to pick up here.
What I've struggled with this year, David, and we spoke to Steve Chevron about this yesterday. He said that when growth is scarce, you buy growth in the equity market, and I said, well, it's odd because we've had this growth rally year to date in the face of a series of upside surprises in the US economy. What is that about?
So I think that, somebody actually said that exact same thing to me yesterday. And so I got to practice this conversation. But I think
because they listen to us, David, that's why.
Exactly. But I think, the issue here with buying growth in anticipation of slower growth is that we had the AI boom over the course of the past few months. And so valuation is way off sides. If these were 10 multiple points cheaper on some of the big names, we'd be more interested. But given where they're trading today, it's a very difficult case to buy risk assets at a valuation that feels extended when you see some potential clouds on the horizon. And so we're leaning more into value, more defensive names, the dividend payers, and a big part of that is the price that we're being asked to pay to hold those assets.
Well, are we looking also at energy companies that are really going to be coming to the fore and actually becoming more popular?
So energy, I feel like there have been a number of false starts over the years where people get really excited about energy and then it kind of falls flat on its face. I do think that, the underlying businesses from an operating perspective are in much better shape than they were, say, 5 years ago. And so if you get that tailwind of higher oil prices, you get that margin expansion, and you continue to have this focus on returning cash to shareholders, energy could be one bright spot, perhaps in the short to medium term. And I think that's what makes this market so difficult to figure out, right? We're talking about a slower growth environment potentially in 2024, but we're talking about energy companies and airlines that have pricing power. And so which side of the trade do you want to be on? Are we going to get the soft landing, and do you want to lean into that cyclicality, or do you see clouds on the horizon and maybe we don't want to play it a little bit more defensively?
I want to ask you kind of a sensitive question. It's not about cruise lines, but I know that other people at your firm have been talking about the entire yield curve at 3%. And everything going back lower. Are there any shifts or arguments right now within the team about this idea that you could have higher for longer and that maybe these higher longer term yields are here to stay?
So what I would say is that the dispersion across the research community of Wall Street is nearly identical to the dispersion of views that we have internally. There are lots of people in very different places. I think what the Fed would like to see over time is a positive real yield curve that slopes upward. So I'm in the higher for longer camp. And I think when they do cut, maybe they go back down to 2.5. Is 2.5 really the neutral rate in the type of environment that we find ourselves in? I do think that we need to be prepared for an environment where rates stay higher for longer. But I don't think that's a bad thing, right? Interest rates, that allows markets to do what they're supposed to do, which is differentiate between winners and losers. And that hasn't been the case for the past 15 years. So this could be a better environment for value, better environment for active management, better environment for fixed income. A world that maybe feels and looks a little bit more like the environment we're in prior to 2008.
So the bias is steeper curves?
I think so.
Okay, because we've just had a record, potentially. This came from Cameron Christ yesterday. 217 consecutive weekdays. In 06-07, this yield curve was in inverted territory. Yesterday was the 216th. So today is 217. Can you believe it's been that long?
It is
kind of nuts, right?
Especially considering the fact that people used to say, this is a sure thing for recession. Where is that now?
What do I read into that?
So I think this is the issue in the current environment. We know all of the economic models broke during COVID. Forecasting is nowhere near as straightforward in this environment as it was prior to the pandemic. And so what you see amongst the investment community is just this very wishy-washy behavior where it's one side of the boat, then it's the other side of the boat. It's 40% of professional forecasters saying we're going to have a recession that then doesn't materialize, and now everybody thinks we're going to have a soft landing. I think what we need to recognize is
changed 5 times this year.
Right, the unprecedented nature of everything that's gone on, particularly the fiscal response. We don't have a playbook for that because we haven't seen a fiscal response like the one we saw to COVID in decades, frankly.
David, thank you. This was great. David Leibovitz of JP Morgan Asset Management. Lisa trying to get you to disagree with Bob Michael in a very subtle way.
Well, hold on a second. He basically was saying that there are disagreements, and this
should have heard what Lisa was saying in the commercial break about people who take cruises. Same kind of people who take McDonald's on airlines. That's what you said.
That is not at all what I said, but you know what?
You'd go with that.
Let's just go with that one.
If you're just tuning in, welcome to the program. Your S&P 500 negative here by 0.2%. We're not meant to have favourites, but we do. Another favourite is Neela Richardson of ADP, and Lisa, she joins us in about 18 minutes' time.
I cannot wait to hear what she has to say in terms of those real gains that you're seeing in income. You mentioned that earlier, John, and I do think that this is one of the developments over the past few months that's really interesting and goes beyond just a temporary boost in spending because of what happened in the pandemic. This is really the question. If you get this could really prolong what we've already seen.
So all these headlines about cuts in tech, do you remember? Over the last 12 months, and then just didn't see it show up really in the headline labour market data.
They were getting hired by everybody else. That was the whole thing.
Walking into other jobs, apparently.
Has that shifted? Because we did see that with the JOLT survey, which, by the way, everyone used to discount as completely imperfect and a completely non-scientific measure back in the day. And now it's the key forward-looking indicator for what's going on.
Inflation expectations.
I personally, I enjoy that. I enjoy that.
Do you?
Yeah, I do, because it's so.
Have you ever had the phone call from you, Mitch?
I have not gotten the phone call.
I've never had the phone call.
Still waiting.
Do you know anyone who's gotten the phone call?
I don't know anybody who's gotten the phone call.
If you have gotten a phone call,
I'd love to hear from someone.
Please
if they've got
call
the phone
in,
call.
and we will patch you through.
Matt Miller writes in, 8 presidents come from Ohio. It's the most of any state in the nation. It's very upset with you this morning.
Okay, well, I look. I will just say, my father was born in Ohio. I have fun.
That gives you the right to, yeah. Okay. Sure.
I'm just talking about routes of airplanes. This is from a
I'm
story.
told that's tied with Virginia.
For what? Oh, in terms of the
presidents.
Yeah, Ohio. It's interesting, though. I guess the swing state in between all the different things.
Is that what it's all about?
Rust Belt.
Uniting the country?
Yep.
Okay. Henrietta Tracer, Vader Partners, joining us next from New York. This is Bloomberg.
We've all been there. You get invited to go to Kyrgyzstan, where you're turned into a YouTube kids show star. Build a satellite and play a game with a goat. The point is, Hello World is back, and you should watch it. Thursdays on Bloomberg Originals and Bloomberg TV.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Today, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
As far as I'm concerned, the most important thing that the president is focused on is just trying to do everything within his toolkit to be able to get lower prices for consumers at the gas pump in the United States. It's really the price of a gallon of gas for the American consumer, not the question of which country's doing what here or there, that is going to be his ultimate metric for whether we're succeeding or not.
Okay, confused. That was the National Security Advisor, Jake Sullivan. I have no idea what all of that meant. Isn't the gas price higher in this country right now?
Right now it is, and they lowered it for a bit, and now it's going back up. It is.
So apparently I shouldn't care what the Saudis and the Russians are doing. I should care about what's happening with gas prices, but gas prices are up, so shouldn't I care about it?
Okay, I was looking today at the prices, the AAA gasoline price level in the United States, and you could see that it is near the highest levels going back to later last year. It was higher, but still, this is unfortunate heading into a season that typically is not a driving season. We're going to get toward one it could potentially shoot higher. Basically, they're trying to massage a message that is very uncomfortable for them right
Should
now.
he have been prepared to answer that question? That did not sound like an individual that prepared anything.
Have you seen any kind of cohesive remarks around the strategic petroleum reserves and what they plan to do, what levels are important to step in with? This has been a very tricky political issue for a long time, and now we're setting up for an election season where that SPR has been drawn down significantly, and it's unclear what levers you could pull other than to hope for a bigger downturn somewhere, but that's a sort of perverse hope to have.
Remember that fist bump?
Yeah, no.
That has worked out.
And we heard that there's going to be another fist bump, even
Is
though
there?
there's
I
some
missed that.
discussions.
When's that fist bump going to be?
Evidently, it's going to be in the next couple of days. There's going to be a G20 meeting between Mohammed bin Salman and President Biden.
I imagine they're not going to repeat.
I know.
That.
Kevin Book was saying that maybe they could.
Well, the Crown Prince probably should offer
this.
You know,
but then what if he offers this and it's not reciprocated? Then is it like game over and they cut production by another million?
If you don't do the,
I mean, honestly, like,
I can't believe we're having this conversation seriously for a start, but yeah.
Carry on. All right, let's move on.
Henrietta Trey's Director of Economic Policy Research at Vader Partners joins us now. Henrietta, we need to talk about the potential for a government shutdown. It's just not on the radar for people on Wall Street in a major way. Andrew Hollenhorst of Citi wrote this morning. Congress must act before the end of the month to avoid a shutdown. How avoidable is that shutdown, Henrietta?
I think the shutdown is quite avoidable. I've never really been in the camp this year that we're going to see a shutdown, mostly because I believe that Speaker McCarthy would look at the potential for a shutdown and realize that it's harder to turn the government back on than it is to keep it open. So I'm really concerned about the ability of Congress to create an off-ramp if they do shut down. And so I've gone back and looked. The longest shutdown on the books is 35 days. That was, of course, during the Trump 2018 to 2019 period. And that shutdown is basically what we would be trying to compete with. It's just for political purposes. It's just to sort of exercise demons and let air out of the balloon. And I'm afraid that it would have to be quite protracted. So I think that gives Speaker McCarthy quite a lot of impetus to reach a deal on a short-term agreement. That's what he's been socializing his members to for the duration of the summer, basically since late July, if I'm not mistaken. And so I think that what we'll see is a short-term kick-the-can sort of approach, which is, of course, what he did during the speaker's vote, and then again during the debt ceiling negotiations. We're just prolonging the inevitable, which is the reality that Republicans do not have the vote for spending cuts at this time.
Dumb question of the day, Henrietta. Why is it that the House of Representatives isn't back in their seats until next week, even though the Senate's back up and running? And for the rest of the world, this is the week where the year restarts.
Right, exactly. So the Senate is up and running. They are ready to go, guns blazing, into 3 separate small spending packages. They have, of course, completed work on all 12 appropriations bills, which is the first time they've done that since 2018. Each measure is basically more bipartisan than the next. They are marching in lockstep, and I think a really important dynamic is to think about Minority Leader McConnell's health issues. He's going to want to demonstrate pretty remarkable competence right now, and I think that's going to give them a lot of incentive to move forward with 89 and higher level thresholds on votes for those 3 small spending bills, plus the war in Ukraine supplemental funding request from the White House, which the Republican caucus in the Senate supports. And then the House is going to come back with just a litany of things that they're going to need to address. And they've only done 1 appropriations bill, so they're way behind.
At this point, we are heading into election season pretty significantly, and you could discuss it from the Republican side, which we have been extensively. But on the Democratic side, I'm curious how much of a headwind these higher oil prices that we've been talking about really are, considering that it was such a crisis last year when prices got to these levels.
What I've spent every election cycle looking at is when voters bake in their forecast for what the U.S. economy looks like. At the very earliest, you're talking about March, April of next year before voters start locking in their opinions of the economy. So right now, the potential for ups and downs and roller coasters on gas prices is impactful in the day-to-day, but we're not going to vote for another 18 months or so. So that gives the Biden administration quite a bit of time. Now, the understanding that inflation is high and gas prices are high is something that you see in the public discourse all the time, whether it's true or not. Right? You see, number 1 hit songs about how gas prices are high and the dollar doesn't get you to go anywhere. That is sort of baked in, but I don't know that this particular blip is going to be something that we need to overly stress about from the Biden camp.
Should we stress about the relationship or lack thereof with Saudi Arabia?
I mean, I think that you're going to see a lot of discussion of foreign policy, but Saudi Arabia is not going to be the number 1 talk. It's going to be China. And then after that, it'll be Russia and Ukraine. So I do think that that's occupying headlines right now. But foreign policy is notoriously one of those issues that American voters just do not pay attention to when it comes election day. Obviously important right now, important for investors, especially for gas prices. But when it comes to actual voting, that's not how people turn out.
Out of interest, and I think this is interesting, at the next debate, you're going to see a lot of candidates from the Republican side on the stage September 27th who have said, and may well say again, that they're going to declare energy independence and they're going to see more oil production in the United States of America. And that conversation is happening at a time where oil output in America is very close to all-time highs. Now, Henrietta, is that something that this administration chooses to celebrate, ignore, or whisper about?
I mean, they sort of walk that fine line. It's the same with the border control debate. You know, more people have been arrested at the border than we've seen in years. So I think it's that very difficult dynamic for Democrats, which are a big tent party where you've got to work with environmentalists, labor unions, business interests, free market economy advocates, the business roundtable. I mean, they really try to walk the line. So I think they say different things to different audiences. And I would say, as I said before on your program, watch their actions. Watch what the administration actually does. You know, to bring it back to China, where are the U.S.-China tariffs? Where are the Section 301 tariffs? Are they on at exactly the same rate as they were under Trump? They are. Are they likely to stay that way? Probably. So are you going to see various cabinet secretaries go over to China and try to, hold hands and start export control working groups and things like that? Sure. Are we simultaneously going to roll out export control restrictions that have never been seen before from the Bureau of Industry and Security? Yeah, we sure enough are.
Andrea, just quickly here, I want to finish up. You mentioned unions and some of the push that we've seen from President Biden. Today, he is going to be discussing some of the avoidance of the warehouse and the shipping strike that didn't happen and celebrating the union over there. I'm curious, do you think this is going to be an effective push for him in terms of reelection?
I do think that getting the labor unions back in the Democratic circle is critically important. So you'll want to see that with steel workers. You'll want to see that with autos. You'll want to see that with dock workers. Any labor union they can speak to is where you see Ambassador Tai spending her time, Secretary Raimondo, et cetera. They're all trying to get as close as they can to as many labor unions as possible because, of course, that's where you've seen so much of the bleed into the Trump camp. Whether that's sustainable post-Trump is something that Democrats really want to try to avoid. So I do think that labor is top of mind for Democrats, always has been, and I know it is for very specific cabinet secretaries in that White House. And I think that's going to be a sustained effort that they pursue. And you'll see that as a dichotomy with environmental groups for sure.
Henrietta, thank you for being with us today. Henrietta Trays there of Vader Partners on the latest in the United States, the politics of Washington, D.C. In the next hour on Bloomberg TV, here's the lineup. Barry Bannister of Stifel and why he thinks we've seen the highs already for the year on the S&P. Richard Bernstein of Bernstein Advisors on why he thinks you're going to see a rally in the cyclicals. And Amanda Lynham of BlackRock, a timely conversation here as we see an explosion in corporate credit issuance to kick off the month of September. Well. It's just a tease. It's just a
explosion.
Just trying to
coming.
Tune in, all of that good stuff.
I'm looking forward to it.
Thank you. From New York, this is Bloomberg.
climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
Well, we are looking at a little bit of softness, perhaps driven by this move that we're seeing in crude and concerns about what that means. Also seeing some weaker than expected data out of Europe, Germany in particular, lower by about 0.2% for the S&P, led by that crude level. This is Bloomberg surveillance, and all morning we've been talking about oil prices that had reached yesterday the highest levels going back to November. We heard from Southwest, we heard from United, we heard from Alaska Air. They are concerned about some of the increases in prices, and then Delta came out with their missive of the morning that had nothing to do with oil prices, with the CEO saying that Tom Brady, former star of all football teams, joining the airline as a strategic advisor. Bloomberg's Michael McKee is joining us for economic data. But Michael, do you want to comment on the fact that this
I thought I was your strategic advisor.
You're going to be the strategic advisor for my Delta travels.
If you want to fly Delta because Tom Brady has a contract to come in and give speeches for them, that's good investment for Delta.
It seems to be working, at least for some streaming networks. We are getting some data on the margins with some trade information coming in a little bit, I believe, lesser of a deficit.
Yeah.
What's the latest on that?
Negative $65 billion, but this is July data, so it doesn't incorporate the rise in oil prices that we have seen, but it comes in a little bit higher than last month, because last month was, the previous month, put it that way, June was revised down to 63.7. So all in all, probably not a whole lot of impact on GDP, but we'll keep an eye on what happens in the months going forward, because oil prices are obviously going to make the deficit worse depending on how much we're importing. We also have headlines, Lisa, from Susan Collins, the Boston Fed president, who is sounding slightly more dovish than she has, saying that the Fed may still need to raise rates, but maybe not in September. Here's a quote from her speech, which is just breaking now. I expect we'll need to hold rates at restrictive levels for some time, and while we may be near or even at the peak for policy rates, further tightening could be warranted depending on the incoming data. Patience will give us time to better separate signal from noise as we assess available data and to balance risks as the effects of tighter policy continue to work through the economy. So she's not a voter this year, but she is a well-known economist, so I'm sure her words carry some weight. And she just joins the parade of people, including Chris Waller yesterday, saying that we don't have to do anything in September. And I think you're going to get the markets to that point pretty quickly.
Are there any hawks left on the Federal Reserve? Well,
Loretta Mester was out saying that she thinks we need to maybe raise rates again, but she's also not a September person, so necessarily, she says. So I think when we get the CPI next week, if it comes in as expected with the core dropping, then the Fed is pretty much locked into not doing anything in September.
John and I spent a lot of the morning talking about the conversation that we had with you, with Patrick Harker of the Philadelphia Federal Reserve, where he was saying that anecdotal data might serve a better guide at this point than a lot of the hard data that people traditionally look at, really highlighting why we should care about the beige book, which comes out today at 2 p.m. I always care about it, but other people might say it's really boring and not important to care about. Do you think that this will actually be more telling in terms of the real-time indicators of how much higher rates are percolating through the economy?
I think it will give us a better picture maybe than we've had recently. You'll get views from around the country in the different Fed districts, and that'll be interesting because as you pointed out, Pat Harker said in the Philadelphia district, he's getting anecdotal reports from CEOs that things are slowing down. Is that happening across the rest of the country, and is that going to affect people like Loretta Mester, who thinks we might do a little bit more? What's the balance of strength in demand versus supply? Do we start to see it out of balance? I mean, it was interesting this morning. I saw some analysis of the Atlanta Fed GDP now, which is at like 5.6, 5.9%, and everybody says that's not going to happen. But we could get, it was Steve Stanley at Santander said, we could get 3.6, which would be extraordinary.
Before you go, I'm curious, Steve Matthews of Bloomberg News came out with this story today where he basically said that Fed officials are poised to double their growth forecasts on the heels of some of these better than expected prints. And in light of what we're seeing with, you can castigate it how you'd like to castigate it, but Atlanta Fed GDP now seems to show there is a robustness that had not been foreseen at any point over the past couple of years. What does this do in terms of the balance of the probabilities of how much they could potentially raise rates further down the line?
Well, it's too early to say that they have to raise rates more than another 25 basis points, which was their forecast. We'll get a new forecast on September 20th, but it does suggest that they have gotten the forecast for the economy wrong, at least through the third quarter. And if we get strong growth, it raises supply-demand questions and questions about whether we will see more inflation. But, of course, the language that Steve used, double their forecast. Well, their forecast was for 0.5%. So if they double their forecast, they'll go up to 1%, and we were just talking about the possibility of 3.6. Then the question is what happens in the fourth quarter, because you've set a high bar, you've set a high starting point, and there are still people out there who are looking at this strong data and saying, yeah, but that means maybe even contraction in the fourth quarter because you can't keep rising at that rate.
I can't wait until tomorrow when we can talk about Barbie and Oppenheimer and how that boosted the beige book, particularly in Philadelphia, as well as Taylor Swift. Thank you so much, Michael McKee, as always. Joining us now is someone who always has incredible insights. We loved catching up with her over in Jackson Hole. Neela Richardson, chief economist at ADP, with a real insight into just how much ammunition, firepower a lot of the consumers have. And Neela, throughout the morning, John and I were talking about this real income increase that we're seeing across the board. And I'm wondering, from your perspective, how much is that going to fuel the next wave of consumer spending in a way that maybe isn't being fully appreciated?
Hi, Lisa. Good morning. Good to see you. Yeah, real wages going up is a great thing. It's a great thing for workers. But I think it's very important to provide context to that number because the thing about inflation, and I know this sounds very obvious, is that prices generally go up. But when it comes to core inflation, they don't come back down. And so we're still looking at higher prices from the consumer perspective. And where you've seen the wage growth is for predominantly low-paid jobs. And so that, by our estimate, is about $5,000 over the course of a year and a half of double-digit wage growth for this particular sector. $5,000 after tax doesn't buy a lot of eggs, oil, higher rent prices, and medical care. So you have to put this in the context of the consumer household budget as well.
It's really important to look at it that way, especially in light of what we've been talking about also this morning a lot, which is oil prices and gasoline prices, diesel, all of it heading higher and significantly so. How much is that going to crimp budgets in a more material way at a time where there already is heightened awareness of price sensitivity simply because of what we've seen and the levels that we've gotten to?
Oil prices going up, even for a short time, just complicates this narrative for the Fed, right? It's the one part of the economy we thought we've had under control, that higher oil prices wasn't going to spill over into transportation costs or goods production. But yeah, the specter has risen again. And so now we know even if the oil prices go down in the short term, they're always there, not quite asleep, and they could peak up. In terms of the consumer budget, we're back to school, we're back to work, we're back to commuting. And so those oil prices are not going to be something that consumers can skirt around, even if there's more remote work than there used to be.
And we were talking about this in light of some of the warnings from the likes of United Airlines and Alaska Airlines and Southwest saying that their energy prices have increased dramatically, which is not shocking considering what diesel has done. How much can they pass this along to consumers that already are starting to push back?
Yeah, that's tricky. Air flights have gone up. Consumers may have overdrawn their burst of revenge travel, and especially going into the fall, there's less of a holiday travel season. And so that's also a particular concern. Also, it's very hot, Lisa. I don't know if you noticed that.
I did notice that.
But in terms of energy costs, even late into September in much of the country, air conditioning is really driving up energy costs, separate from the airlines, but part of the overall consumer budget picture that allows for that wiggle room for travel. If you're paying higher energy costs at home, harder to make room for that last minute fall season travel as well.
Although I will say that recently, just anecdotally, talking about the beige book and anecdotes, I will say that going into stores, I've noticed that people are actually air conditioning less. And I wonder how much it's to save costs, because sometimes you go in and it's still really hot. Anyway, I digress. I'm wondering, from your vantage point going forward, a lot of people are looking at Friday's jobs report and saying it was Goldilocks. It basically gave the Fed a free pass to remain on hold. And then bond yields rose. They rose on Friday and they rose again yesterday. People saying it was technical. People saying it's because maybe the Fed would pause and then there'd be a reacceleration of inflation. How would you describe the labor data that we've been getting, both from ADP as well as from the government, in terms of, is it really Goldilocks?
You know, we're in a labor market that is, in some sense, Goldilocks. We're seeing wage pressures start to decline and moderate. We're still seeing solid job gains. But within that overall macro picture, it's a highly fragmented market. It's a market that has seen a lot of churn and continues to see elevated churn. And within all of that, there's a lot of inefficiencies. And so really, I think that the Fed's job now is much more complicated. When inflation was super high, it was easy to know what monetary policy was supposed to do. Now they're entering this period of fine tuning, right? They're tweaking what the terminal rate should be. Maybe it's 25 more basis points, maybe it's 50, maybe it's a pause in September. There's all the spectrum of choice depending on what data you're looking at. If you look at the labor market, there is an argument to go stronger and there is an argument to pause. And it's just a matter of where you're putting the weight. Are you putting it on the unemployment rate? Are you putting it on wage growth? And that is going to be something that the Fed is going to have to feel out in all of this data.
What happened to all the layoffs, the white collar layoffs that people were talking about a year ago?
They never happened. We see initial jobless claims are still quite low. And this is still a very solid labor market, even though the unemployment rate went up to 3.8% in this last report. It was because more people came into the labor market, not necessarily because companies were laying off. And when we look at our data, we see still solid growth across sectors, even sectors that have struggled this year, like manufacturing. For sure, services are still seeing strength. And so, yeah, if you're looking for bad news on the economy, I encourage you to look elsewhere because the labor market is not the source of it right now.
Which a lot of people are saying is the reason why there is going to be ongoing strength. And we are seeing the potential for the Federal Reserve to increase their growth expectations. Just to give you a sense, we get initial jobless claims, of course, tomorrow. And then I am curious, early next week, NFIB Small Business Optimism Survey, how much you start to see smaller businesses experience a little bit of stress or not in terms of anecdotal evidence. If you're just joining the program right now, you are seeing the S&P lower by about 0.2%, now 0.3%, deepening the losses ahead of the opening session. A bit of euro strength, a reprieve after quite a bit of weakness, 107.39, and 10-year yields lower, just a touch lower, 4.24% after yesterday, the sell-off that we saw in Treasuries. Neela Richardson of ADP with us here. And Neela, just on a personal note, I know that Tom is off. People are going back to school. Personally, I've got kids that are going back to school. Do you have a sense of whether the whole back to school spending is going to be as robust and, fruitful for the stores and less so for the parents as people had expected?
I on the consumer spending front, just generally speaking, we've seen consumer spending stay strong. But there's caveats around that in terms of excess saving, that was built up because of relief payments directly to households during the pandemic. It's starting to wane. We're also entering this period where there's higher interest rates, so putting some of that spending on your credit cards is going to be more expensive than it used to be. I think really what we're looking at is seeing through the fall and into that holiday shopping season where there's more optionality about what you buy. Kids need clothes for school, and you can change like the labels, but it's hard to change the growing children in terms of new back to school clothes. But I think you get more discretion around the holiday shopping season. That's when 20% of retail sales show up in the economy. I'd be really curious to see how those higher interest rates bite that consumer spending.
Neela Richardson, always a pleasure of ADP. Thank you so much. It is not an option to buy your growing children clothes. I just learned maybe what kind, but maybe not. Maybe the holidays will be the time when we can start cutting back. Coming up, George Ferguson, senior airline analyst for Bloomberg Intelligence, on some of the shifts in oil.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody uses my knife, I want them to say, damn! Golly, this is a badass knife.
From New York City.
From London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
Gary Gensler's decision of sort of engaging this regulation by enforcement rather than getting clear laws. He knows they're not clear. He just likes that lack of clarity so that he can go after anybody and make up the rules as he goes along through bullying. And that's not the American way.
That was Chris Larson, Ripple co-founder and executive chair, speaking with Bloomberg's Ed Ludlow. You can hear more of that later today at Bloomberg Tech, 12 p.m. in New York, 5 p.m. in London. We have been talking all morning of the airline industry and their response to higher energy prices and higher prices just in general for labor as well as just generally the operations. What does this mean for prices? What does this mean in terms of potentially waning demand heading into the fall and winter season? George Ferguson joining us now, senior airline analyst for Bloomberg Intelligence. George, what do you make of the announcements and frankly the synchronized announcements from Southwest, United, Alaska Air about higher energy prices and not necessarily factoring into profits this year?
Yeah, so, we were actually refreshing our models yesterday and been watching fuel prices during the end of the summer. And, they were creeping up and it was kind of becoming clear that there was no way they were going to make, I think, consensus earnings for this quarter. So I think the announcement is part of, these companies trying to start to warn the markets that things aren't going to be good as we all thought. I mean, really, coming out of second quarter, earnings were pretty good, especially for the full-service carriers, especially for United, American, and Delta. And we really thought it would be a great third quarter for them. And fuel prices, right, have come up about 50% since then, really crept up on them. And pricing power, I think a lot of the tickets were probably already locked in because they were sold for summer. They were leisure travel, which typically has a longer lead time. So I don't think there was much room to move on fares. And like I said, we've been sort of busy looking at our models again, taking a lot of the numbers down. And I think this was trying to get to the markets to focus on it, that, hey, things just aren't going to be as good in 3Q.
So in other words, you think that the reaffirmation of full-year forecasts from United and a similar kind of tone from Southwest is not totally accurate, and that this is the first step to actually downgrading some of the earnings?
Well, so I mean, I'd be surprised if the full year can hang in there, if fuel prices stay here. I just don't see pricing power for the airlines right now, right? I think when we, again, look at our models for 3Q, really what we're seeing is we think yields are slipping, which is, synonymous with fares. We think it's been a very leisure-driven recovery for the airlines. It's been a leisure bounce back. And so we just think that strength in fares can't continue into 4Q. We don't see business travel coming back. And so I just have a hard time imagining with the setup we have right now and higher labor costs for the full year to be able to hang in there.
How many of the airlines have actually hedged oil prices?
Not many, right? So the only ones that really hedge oil prices, Southwest has a decent hedge, so they've been hurt less. We see small amounts of hedging at Alaska and JetBlue, and the rest just don't hedge.
When you talk about the softening demand, there was a story that I was reading about, a number of stories, about how prices are starting to go down in airlines, even reaching 2019 levels, particularly domestic flights. And that's one characterization. How much is this isolated to domestic travel in the United States? And how much is this a broader softening that extends overseas?
I mean, so if you're talking about U.S. carriers, I think that a lot of them built in pricing, again, for this summer. Everyone I talked to went to Europe, I think, for vacation this year. So I think everybody saw the strong dollar and booked their overseas flights. And that's why I think, 3Q looked better for the full service carriers, because a lot of those tickets had already been sold. I think once we get past the summer season for the U.S. carriers, that long haul demand just isn't going to be there in the strength that it is right now. And so I think fares will absolutely soften there. And like I said, we've already seen the domestic starting to tail off. I think that some of the domestic consumers not as well heeled. They couldn't afford to pay the higher prices. And in 3Q already, we had the airlines starting to warn us about yields and they're seeing some weakness in that demand. I think overseas, for overseas carriers, when we talk to people in Europe, I think a lot of even the European carriers, we're seeing their demand from U.S. consumers. One of the interesting things I've heard from, I think, European travelers is the cost of dinner in New York is really expensive. So there's not much value for coming to this side of the Atlantic. And I think that was putting a bit of a damper on demand when it comes to, long haul out of Europe. Again, I think the U.S. consumer was holding up a bunch of that. Asia's still reopening. Asia fares are really high, but capacity is starting to leak back into that market. And I think fares will come down to Asia, but the capacity constraints right now just keeping fares.
I love it, George. All the trash talking on both sides of the Atlantic. On one hand, it's so expensive in New York. On the other hand, have you seen how crowded the Uffizi is? I mean, honestly, you're getting on both sides. There is a question, though, George. You did say that you don't see business travel returning. We have heard that it has been coming back and that people are going back to the office. What's the latest in the thought process around what comes back and at what levels? Is this really just an issue of people not traveling or companies not shelling out for business class?
Yeah, so, it's always, this is a hazy part of the market we always sort of probe through, try to figure out what's really going on. I think that with return to office coming this fall, it seems like at least some industries, especially the financial industry, pushing a little harder to get people back in the office. I think that's going to improve, business demand. We've still seen it between sort of 65 and 75%, so it hasn't fully returned. Some interesting anecdotes we hear from the field is like, the consulting industry. Consultants just not going and working on site anymore, working from home, right? And so some of that may be because people aren't back in the office, so why bother bringing the consultant back? Consultants are a big part of, airline spend. So I think once we start to see a return to office, then I think we're going to figure out if something like the consulting industry follows suit, goes back to working out of companies' premises. But I mean, you can imagine that if there's an economy there, if the consultants go to companies that they're working for and say, if you don't want the consultant in your office, it'll save you some money. We may never see sort of business travel get back to 100% of what it was in 2019. But again, look, things morph, and so there'll be other business travel that backfills. But I still think we've got a bit of time before we get back to even 80-90% of 2019 business travel.
Before I let you go, George, I do want just your take on a controversy this morning on Bloomberg Surveillance about why certain routes by certain airlines have been increasingly discounted by certain airlines. There was this story in the Wall Street Journal about $20 fares from Cleveland to Orlando, from Detroit to Atlanta, flights that are as cheap as $115 from Mexico to Central America. Why do airlines discount certain routes more than others?
It's all about competition, right? And so, I think everybody likes to think that United and American Delta full of business travelers, Spirit, Frontier full of ultra low-cost leisure travelers, but there's a mix inside of every airplane, except for business travelers in Spirit and Frontier. And so, if Spirit and Frontier show up, for example, in your marketplace and you're Southwest or United, and you feel like they're hurting fares in that market, you may abnormally lower your fares to even loss levels just to try to drive them out of your marketplace. It's all about competition.
Any travel coming up soon, George?
Yeah, I'll be over in London for National Society of Transport Aircraft Trade. Always a great conference in the beginning of October.
Well, we'll catch up with you on your experience traveling there, as well as what you learned. George Ferguson of Bloomberg Intelligence, thank you so much for being with us. Coming up on Bloomberg TV at 2:30 p.m. Eastern, Armen Panosian, new co-chief executive officer of Oak Tree Capital, at a time where there is an increasing amount of money going into private capital. This comes as there is suddenly a renewed appetite by companies to sell debt. We are getting word of yet another debt sale on the slew that we saw, the barrage of corporate debt sales yesterday that some people say was kicking around the Treasury market a significant way. There's a $3.7 billion debt offering for the Syneos buyout coming out. So it's not just investment grade, it's also high yield. Some $40 billion of debt sold yesterday. The expectation is it could surge to the highest level this week, certainly of the year, if not for quite a bit of time, as companies start to grapple with how we deal with higher rates for longer, whether we lock them in. Right now, we are seeing crude come down after yesterday hitting the highest levels going back to November. We are seeing that cut from Saudi Arabia, from Russia, percolate into this feeling that maybe the U.S. and frankly the China economy as well isn't as weak as people previously thought. Today a little lower, $86.31, but still substantially north of that $80 front on crude traded on the NYMEX. We also are seeing yields basically going nowhere, 4.24%. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
New York City, a $100,000 salary feels like just $36,000. That's according to a new study that looks at 76 of the largest U.S. cities to see where $100,000 goes the furthest, after taxes and after accounting for the cost of living. For many, reaching a six-figure salary is a huge moment when you feel like you finally made it. But that feeling may not last long when you realize just how much taxes and the cost of living in an expensive city takes out of your paycheck. And that's especially true after 2 years of inflation. Hybrid and remote work have opened up so many more opportunities for people to choose where they live. So that forces the question, should I stick it out in an expensive city or try to find somewhere more affordable? So where should you live if you want to maximize your salary? Consider Memphis, Tennessee. The home of the Blues topped the list with a take-home pay of about $86,000. Tennessee doesn't have an income tax, and the cost of living there is about 14% cheaper than the national average. So a dollar there takes you much further. Texas is another popular choice, and it's clear why. 7 of the top 10 cities where $100,000 goes the furthest are in Texas, a state known for low taxes. Of course, there are so many factors that influence where you choose to live. You may want to be at the center of things, or be near family, or be somewhere where there are a lot of career opportunities in your field. It's not always just about dollars and cents.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Live from New York City this morning. Good morning, good morning. Your equity market slightly negative here. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, more Fed officials putting rate hikes on ice as Asia pushes back against dollar strength, and crude sitting near the highs of the year. We begin with the big issue, a new challenge to a soft landing.
When you look at the broad commodity market,
commodity prices are rising.
Higher oil prices, the spike in oil prices and gas prices.
Crude oil and gasoline prices might be a market-based measure of economic demand, and right now they're both very strong.
That tends to be something to follow as a catalyst into where you start to see inflation numbers tick up.
Pressure on inflation. The last thing consumers need at this point in time.
It really does look like year-over-year inflation bottomed at 3% in June, and it's going to probably start drifting towards 4.
You probably saw the 2 weakest prints you're going to see this year over the summer.
If we are seeing higher commodity prices, eventually that should translate into higher yields.
We're going to see higher yields for a little bit longer.
The reality is that it's very, very difficult to achieve a soft landing.
There's so many wrinkles right now.
There's definitely some fraying around the edges.
Bad news might wind up becoming bad news as we move forward from here.
Crude very close to 90 in the last 24 hours, a break at that level for the first time since November. Joining us to discuss, Stifel's Barry Bannister, Richard Bernstein of RB Advisors. Barry, your words, you say new highs in stocks, exceptionally unlikely. Barry, can you give us the why?
Yeah, if you look at the broader stock market, the valuation is very high. The price-earnings ratio, the way we calculate it, versus the financial conditions index is high. The stock-to-bond ratio looks high to us. And the earnings estimates for 2024, the street, 9% earnings growth. Our model comes up with about half that level of growth, about 4.5%. So overall, we've had a great run through mid-2023. We've been saying since the summer that the stock market would be flat in the second half as it digests the recent gains, and we have some uncertainty looking forward.
Richard Bernstein, do you still believe the outlook for profits is actually bottoming here?
I do, John. Our data, our models actually are suggesting that we're starting to look at profits reaccelerating, which I think is very important, and very important for something that you didn't even mention in the preamble here, was that the labor market is still pretty tight despite a profits recession.
Now we're going to see profits start accelerating. Corporations usually hire as profits start accelerating. So I think to expect the labor market to start easing when profits are reaccelerating may not be the right tack to take here.
Barry, what's Richard getting wrong?
Well, if you look at, for instance, technology, where our earnings estimate is below the street by a more significant margin, earnings are a lagged effect of the slowdown we've already had. In other words, the durable goods, the factory orders, the PMI indices, they all slowed down in 23, and what you find is there's a lagged effect. And we've gone back 30, 35 years historically, best fit. There's a lagged effect to the economic variables. So we have to be cognizant that we have seen a fairly significant slowdown in some of the cyclical economic data that will filter through at least through the first half of 24. And getting through the first half of 24 is a very long time to wait to be right about a reacceleration. So,
Richard, where are you seeing that reacceleration in profits right now? Where are you expecting to see that in this equity market?
Well, it's already happening, John. I mean, this is not something we have to wait for. It's already happening. Profits growth is troughing. And in the United States, profits growth is troughing in many parts of the world. I mean, I don't think people realize that European earnings are growing faster than the U.S. technology sector's earnings. So, you know, I don't think we have to wait for this. It's already happening.
So, Richard, the small caps, international, what's the bias for you?
Right. So, John, I may sound like a broken record here. I still view the equity markets as being like a seesaw. And on one side of the seesaw, we've got tech, we've got all the sexy stuff on one side. And on the other side of the seesaw, we have everything else in the world. And so our firm is squarely planted on the everything else in the world side of that seesaw. And small caps are clearly playing a role in that. I mean, all you have to do is look at the relative price between the NASDAQ 100 and the Russell 2000. I mean, it's an historic gap. But yet earnings growth is starting to trough, which usually favors lower quality and smaller companies.
I wanted to pick out a quote that you'd put in your research, Richard. The quote reads as follows. I'll share it with our audience. The performance of the Magnificent Seven versus the Russell 2000 continues to stretch. We should all hope this doesn't continue because the implications for the U.S. economy are dire. Now, is that hope or a strategy? Richard, which one is it?
No, I think that's actually what history would suggest. John, when profits growth troughs, markets become very Darwinistic. It becomes survival of the fittest. And so that's why you get broad leadership at the beginning of a cycle, narrow leadership at the end of the cycle, because more and more companies fall by the wayside as the cycle matures and they can't keep up their earnings growth. If you believe that there are only 7 growth stories in the entire world, that is an amazingly dire economic forecast. So my argument is that we should all hope that the Magnificent Seven underperform, because if they do perform, and if that's correct, let's say it's not a bubble, I kind of think it's a little very speculative, but let's assume it's not a bubble and it is fundamentally based, that is a tremendously dire forecast of the future. We just can't believe that the global economy is in that shape, that there's only going to be 7 growth companies in the entire world.
Barry, do you hope the Magnificent Seven will underperform, or do you think the Magnificent Seven will underperform?
Look, the cyclical growth, which includes the big retail, the Tesla, as well as all the big tech, is about half the market, 45%, if you just take all of cyclical growth within the S&P industries. So if they underperform, the market's not going anywhere. And, you know, what I have to do is predict not only the market level and direction, but the winners within the industries. And for the sake of argument, let's say we are reaccelerating in a very significant way. The real 10-year TIPS yield should be well north of 2. It was 2.5 before the financial crisis, 3.5 before the tech bubble burst. So let's say it's 2.5. If you overlay the price of oil, Brent oil, against the 10-year break-evens, it should be 2.5. So what are you looking at? 5% on the Treasury yields. We're not going to maintain a 21 forward multiple of earnings at a 5% nominal Treasury yield. So the point is, the stock market is a financial instrument. If you're going to talk about very bullish outlooks for economic growth, you're also going to have a lower multiple for it.
Richard, what would you say back to that?
So I don't disagree with what Barry just said. I think the market overall is on the expensive side for sure. There's no doubt about that. But I think I have to remember, Barry said this, that what's important is the construction of the market. You know, in the first half of the year, the Magnificent Seven contributed about 70 to 75% of market performance. So if you're saying the market's overvalued, if you're saying the market's going down, one's implicitly arguing my seesaw combination here that the Magnificent Seven underperform and other parts of the market are likely to outperform, with the fulcrum of the seesaw, kind of what Barry's referring to, basically doing nothing. And I think that's a fair assessment.
Richard, away from stocks, developments in the bond market, yields up again over the last couple of days. We'll talk about some of the corporate issuance in the credit market a little bit later this morning with Amanda Landham at Goldman. We'll do that about 9:35 Eastern time. But yields up, driven in some part also by this move in the crude market. Big rally for WTI, 20% move since middle of July. Richard, we've seen a couple of airlines, three of them actually this morning, United, Southwest, Alaska, all talk up higher fuel costs. The conversation we had on the program a little bit earlier this morning is whether these airlines need to eat that or whether they can actually pass that on. Are you confident they can pass some of this on?
I think they're going to try, for sure. I think that's what most corporations do at the beginning. But John, I think your opening statement, the preamble here, was really important because it started with saying the Fed's on ice, but then it was all about commodity prices. I think if we ever needed to understand that the Fed is a lagging indicator, your preamble said it perfectly, that the Fed is thinking it's time to pause as commodity prices are starting to go up and companies are going to try to pass that along. I think that's a perfect example of why the Fed has always been a lagging indicator.
Well, there's some real tension here, Richard, isn't there? The Federal Reserve potentially rate hikes on ice in September. At the same time, you're seeing iron ore at the highs we haven't seen for about 4 months, crude at the highs we haven't seen since November. All of this is happening as China seems to be slowing down. Can you make sense of that for me, Richard?
Well, I think, John, we've got to be a little careful on jumping on the China stinks bandwagon. I think that we're kind of looking at a situation where the government there, both the central bank and the fiscal side, is not giving up the stimulus battle. And so, in the United States, we would always say, don't fight the Fed. I think one wants to be a little careful from an investment point of view to say you don't want to fight the PBOC and the Chinese Central Command or however you want to phrase it. So I think we want to be a little careful. Their economy is not falling off a cliff. It has been stumbling. It's disappointing. But, their economy is going to reaccelerate.
You mentioned the Federal Reserve. I hear Mike McKee. So let's get to Mike McKee. Mike McKee, rate hikes on ice this month.
It's beginning to look that way. A lot of members of the Open Market Committee have suggested they could take a pause. But heck, we went to the mountains, we went to the beach this summer, and we kicked the can down the road on a lot of possible problems for the economy ahead. One of which you've been talking about a lot this morning, oil prices. You were talking about jet fuel, but what does it mean for gasoline and consumer confidence? The stronger dollar, it keeps getting stronger, which means probably we have fewer exports, but we also have lower inflation. Stronger U.S. growth. We were talking about an over 5 handle on the Atlanta Fed GDP now. Some people are saying that's ridiculous. We probably won't get more than 3. 3% would be 3 times what perhaps the potential growth is right now. Some problems solve themselves. All things China. We're going to be looking to see, and you've been talking about it on this show already, what happens with the Chinese economy and what impact that has around the world. Government shutdown. There's a self-inflicted wound coming up at the end of the month, it appears. And then labor unrest next week. Same day we get CPI, we get word on whether the UAW will send 150,000 workers out on strike, which will also shut down suppliers and things like that. So a lot to worry about, or not. Here's the gasoline price situation. Everybody's going to be talking about the impact of these higher oil prices on gasoline, but take a look. Gasoline prices are going down, even as oil prices are going up. It's that time of year when demand is slower. We've got all those refineries that were out back in service pretty much. So where do gasoline prices go? We don't know. Makes it very difficult for the Fed. Now, for September, they're kind of putting things on hold. But November, well, we heard from Susan Collins this morning. She said, patience will give us time to better separate signal from noise as we assess available data. And I'm going to quote the eminent physicist Niels Bohr, who once said, prediction is very difficult, especially if it's about the future.
Well, Niels Bohr nailed it, didn't he? Mike McKee, thank you. you, buddy. As always, Mike McKee there on the Federal Reserve. Barry Bannister, Richard Bernstein are going to be sticking with us. Your equity market on the S&P 500 here, negative by 0.2%. I'm happy to say we can get you some movers going into the opening bell. Here's Abby.
Indeed, John, and we are looking at the possibility of a second down day in a row. Mild losses right now for the S&P 500 and the NASDAQ ahead of the open, but one stock that is soaring going against that grain, Roku. These shares are up more than 10% the last time I took a look, given the fact that they are planning on cutting 10% of their workforce. They're consolidating some office space, and excluding the charges for those restructuring moves, Roku raised its third quarter revenue guidance by as much as 7%, so investors are excited about that. Block, on the other hand, down 2.7%. UBS has cut the shares to a neutral from a buy on a potential slowdown in gross margin profit growth. And John, they're talking about a softening consumer discretionary spend going forward. You were mentioning those airlines. Well, Southwest Airlines in some ways confirmed that, saying that they have seen some luxury travel down in the month of August. Apparently the Labor Day weekend was strong, but those high rising fuel costs, well, what is that going to mean for the airlines? We'll be exploring that more after the bell.
Looking forward to that conversation in about 17 minutes time. Abby, thanks for that. Equities a little bit lower then, down by 0.25% on the S&P 500. In the bond market, yields pretty much unchanged on a 10-year over the previous two sessions, a 16 basis point move Friday and Tuesday. A curious move. Was that all about credit supply? We'll have that conversation with Amanda Lynham of BlackRock a little bit later this morning. In the FX market, the euro right now slightly positive at 107.31, positive there by 0.1%. The story, though, over the last 8 weeks, dollar strength, dollar strength. Coming up, Asia pushing back against a surging US dollar.
They're really fighting a strong dollar above all else. So they don't really have control over the big dollar story. They do have some control over the yen. If they really want to strengthen the yen, then they do have the tools now. They don't really want the exchange rate to be another source of instability.
Japan pushing back with some verbal intervention. China pushing back as well. That conversation up next.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
They're really fighting a strong dollar above all else. So they don't really have control over the big dollar story. They do have some control over the yen. If they really want to strengthen the yen, then they do have the tools now. The Chinese authorities have the capacity to manage some weakness. I don't think they need to be too afraid that all of a sudden the yuan is going to drop precipitously.
The US dollar heading towards an 8th consecutive weekly gain, sending Asian currencies to multi-month lows and prompting authorities there to push back with threats of intervention. Japan issuing its strongest warning in weeks, saying the nation is ready to take action amid speculative market moves. And in China, the PBOC escalating its defense with a record one daily fixing. Bloomberg's Ender Curran joins us now for more. Ender, I mentioned this a little bit earlier. Talk is cheap. Is that talk going to work?
Well, the problem for the authorities in Asia, John, is that this is not a story about the yuan or about the yen. It's all about the US dollar. And as you know well, the conversation here is that the Fed may not yet be done hiking, and even if they are, interest rates are probably going to stay high for a while. And that's what's driving the dollar higher. So it's well outside of the control of what's happening in Asia. The yuan fell to the 2007 low that you mentioned. You might on paper say that's because of the China slowdown, but as I'm saying, it's as much a dollar story as anything else. And of course, over in Tokyo, the authorities there warning against speculative moves that they might have to step into the market, but they're going to have to step in, of course, against the Fed freight train. But it is another example of how the Fed's hiking cycle and the dollar is causing pain around the world, and surely it will add further fuel to the campaign that's led by China and other nations that want to diversify away from dollar usage.
And out of interest, what are they worried about? Because Japan are telling us they want to reset inflation expectations higher. Surely a weaker currency helps that. China's going through some economic difficulty. We spoke to a lot of guests, including Alan Ruskin this morning at Deutsche Bank, about the potential of actually a weaker currency helping them. What don't they like?
Well, a weaker currency, there's a question of diminishing returns when it comes to trade and exports, when demand for trade and exports is already weak, John. I think that's part of his thinking there. But also I think it's more about volatility and the pace of the drop or the pace of decline. Certainly Japan has always leaned against large gappy type moves in the yen. And on the Chinese side, of course, they don't want the yuan falling at a pace that might trigger or pressure companies and households to try and get their money out of China. Remember the whole capital outflow story that we experienced back in 2015. So I think on the one side is quite a debate of diminishing returns when it comes to what kind of lift you get for trade, but on the other side, it's the danger from too much volatility in your currency market.
And a current down in Washington, D.C. on top of the story, pushback from China, pushback from Japan. Back with us for a final word, Barry Bannister, Richard Bernstein. Barry, we need to talk about the other side of the trade. 8 weeks of gains for the dollar. Longest weekly winning streak potentially going back to 2014. I remember those conversations 10 years ago, Barry. We used to talk about it. Is that strong dollar good or bad for the S&P 500? Barry, is it good or bad?
Well, typically a strong dollar is disinflationary, and so it's good for the tech stocks. But in this case, the Fed is really doing a pretty good job of breaking the world. The Chinese are pretty close to deflation. So in what you call real effective exchange rate terms, the yuan nominal and real seem to be going in different directions. The Japanese are having to repress their currency. And so the Fed is, with its rate differential, keeping the dollar aloft. It would be, I think, favorable, though, if we get some relief on inflation, for the Fed to back off a little bit and for the dollar to come down. I think it would be a positive, of course, for earnings, but for other things as well.
Richard, would you agree?
So, John, I think the most interesting thing is the first half we were talking about commodity prices, and the second half here we're talking about an appreciating dollar. Normally when the dollar appreciates, commodity prices go down. This time we're talking about commodity prices going up at the same time you have an appreciating dollar. That says somebody out there is demanding commodities, that the price increase of commodities is not curtailing demand. And the price is still going up despite a stronger dollar. So I think overall it suggests that people shouldn't think that the global economy is falling apart here. Somebody out there is demanding commodities, whether it's China, whether it's who knows who, but somebody out there is demanding commodities, and the appreciation of the dollar isn't stopping it so far.
If it was just crude, I'd say, Richard, maybe it's just a supply story. Russia, Saudi, but it's not just crude. To your point, it's also iron ore as well. So,
Correct.
Richard, with all of that in mind, final word. Let's put some money to work. If the international story is not as bad as people say it is, and you're indicating it might not be, where do you want to put that money to work right now? Where specifically, country, sector, index? Pick whichever one you like.
So, John, we have our lowest weight in the United States we've had in the history of our firm. We're overweight Europe, as I mentioned before. European earnings growth is surpassing that of the U.S. tech sector, and that's expected to continue as we go into 2024. Japan, the weak yen is an interesting story. We'll see if that continues, given some of the discussion we've just had. But that's critical in terms of the Japanese story. Even China, with the amount of fiscal stimulus they've had. I mentioned small caps before in the United States. We think that's interesting as well. It's basically everything outside the sexy stuff on the one side of my seesaw.
Richard Bernstein, Barry Bannister, to the two of you, I've enjoyed the last 20 minutes. Thanks for being with us. Appreciate it. 8 minutes away from the opening bell. Equity futures here trying to stay to recovery. Just a little bounce off the low. We're still down here by 0.2%. Coming up, the morning calls, and later, September kicking off with an onslaught of new debt supply. That conversation still ahead with BlackRock's Amanda Lynham. Live from New York City this morning. Good morning. Your opening bell, 7 minutes away.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Just a little bit of weakness to start the week. We're about 7 or 8 minutes away from the opening bell. Call it 5 now, actually. Equity futures pulling back just a touch on the S&P 500, down by, let's call it 0.2%. In the bond market, some big moves again. 2 sessions, Friday, Tuesday, 16 basis points higher on a 10-year yield. The 10-year right now at about 425.19, pulling back just a touch. How much of this move was about corporate credit supply? We'll have that conversation in about 10 minutes' time. How much of this move was about this right here, crude? WTI and Brent. WTI, 8-day rally at the close yesterday. The longest daily winning streak going back to January of this year. The overall price through 90 briefly on Brent for the first time since November. Across the board here, still near close to highs for the year. The dollar is just about negative, but the crude price is the one I want to focus on. Brent and WTI. Brent at about 89.72, WTI at about 86.50. That's the price action. Let's get you some morning calls. First up, UBS downgrading block to neutral, seeing limited upside as growth decelerates due to a softening consumer. Your second call from Morgan Stanley upgrading First Solar to equal weight, saying that shares deserve a premium given the lack of downside risk. That stock is positive by 1.8%. And finally, TD Cowen upgrading Constellation Brands to outperform, expecting the company's analyst meeting to serve as an upside catalyst. That stock is up by 1.7%. Coming up, debt issuers storming the market with a post-Labor Day bond blitz. That conversation up next with BlackRock's Amanda Lynham. Your opening bell just around the corner.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
23 seconds away from the opening bell here this morning. Good morning to you all. Equities pulling back just a touch. No real drama here throughout much of this morning. We're down about 0.2% on the S&P. On the NASDAQ, down about 0.25%. Plenty of disruption in the last 24 hours in the bond market, one, and in the commodity market too. We'll talk about that now. Switch at the board. There is your opening bell. Get to the bond market. Yields look like this, lower by a couple of basis points on a 10-year, 424 over the previous two sessions. 16 basis points higher Friday, Tuesday, of course, closed on Monday. And that move, is that about supply coming out of the credit market or about this move in crude? 86.43 on WTI, negative here by 1/3 of 1%, but an 8-day rally on crude that we need to talk about a whole lot more over the next couple of days. In the FX market, the euro showing a bit of strength. The data out of Germany, ugly, but some hawks, two actually, going into the ECB a week tomorrow, flagging maybe the potential for an interest rate hike in September, just reintroducing just a little bit more two-way risk into that ECB meeting in Frankfurt, Germany. About 40 seconds into the session, we look like this. Equities right now on the S&P negative by 1/3 of 1%. On the NASDAQ, we're down about 1/3 of 1% also. One sector to watch at the open, the airlines sounding the alarm on higher fuel costs due to surging crude prices. Southwest cutting its Q3 outlook right in this. August bookings were on the lower end of the company's expectations, modestly impacted by seasonal trends. Abby has more. Hey, Abby.
Hey, John. And you can see that Southwest Airlines down more so than United Airlines and Alaska, down more than 1%. In fact, down for a fourth day in a row over that time period. Southwest Airlines falling about 5%. So this filing that came out may not be a surprise to everybody. They also talked about the fact that they saw a weaker leisure travel in the month of August. To be fair, Labor Day better. They are expecting better trends as the year goes on, or solid trends. But this rising fuel issue, oil, WTI crude up more than 35% from its low earlier this year. That really pressing into jet fuel. So these three airlines highlighting the fact that that could really crimp their profits going ahead. Now, they have not actually adjusted numbers in that fact, except for, of course, Southwest Airlines, as you just talked about. They did tighten their revenue range. Now, it's really interesting. Southwest Airlines, because of the issues last December, I think we have to discount a little bit on the year. It's down more than 10%. United Airlines up more than 28%. But the group as a whole, John, this is really interesting. It's a classic inverse relationship between the airlines and that big cost component, oil. For the year into the peak back in July, up more than 43%, now down 30% from that as WTI crude and Brent crude oil has gone higher. And right about now, even the airlines up about 10% on the year. Crude oil up just a little bit more, up 14%. It seems that the balance is tipping in the direction of commodities despite that dollar strength.
Abby, thank you. Southwest right now down a little more than 2%. A note on the airlines from Bank of America remaining cautious on the airline sector, writing the following. Commodity prices have created meaningful earnings volatility this year. Pricing power could weaken as the recovery normalizes and capacity comes back online. As a result, our new earnings estimates result in lower price objectives across the group here. This is a call across the group for the entire airline sector. The latest there from Bank of America. I want to turn to big tech. Shares of Apple under pressure. Chinese government agencies have banned staff from using iPhones at work, according to the Wall Street Journal. It isn't clear how widely the orders were issued. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. Apple is softer by 0.6%. The Wall Street Journal reporting that some central agencies in China have issued directives via chat rooms and in meetings that they should replace their mobile device in the event it is a foreign device, not just an Apple iPhone, but a non-domestic device. I would say, remember that Bloomberg reported in May of last year that Beijing offered a 2-year deadline or term limit for state corporations and indeed government agencies to swap out their foreign brand personal computers for a domestic brand. So this is not necessarily an unprecedented move. Apple now soft at 0.8%. Apple have not responded to a request for comment from Bloomberg News on this story. But it's interesting timing, given what we've discussed in the last few days about Huawei's Mate 60 Pro. I would also point out, John, that the European Union published its gatekeepers list under the new digital services law that we were expecting. As expected, the Apple App Store was listed under it, but interesting that iMessage may be exempt, and the EU is probing that. So that may also be a factor as Apple shares are down 0.9% now.
Let's stay on China, Red. Does this raise questions about the new iPhone being launched in the next week or so?
Yeah, I mean, China is still a critically important end market for Apple. It is its biggest international or overseas market beyond the United States. You and I always discuss following the launch of a new iPhone generation what the big drivers are of it, and the Chinese middle class is always a part of the conversation that you and I have. That said, you know, I'll be at Wanderlust on September 12th next week. I think there's high anticipation that the hardware upgrades to this generation iPhone are substantive enough that they will do well broadly. And despite all the geopolitics and headlines, you know, Apple, remember, was quite bullish on their performance in China in the quarter just gone. While the US smartphone market saw contraction, China grew.
Ed, thank you, mate. The stock is down by about 1%, 5 minutes into the session, pulling back just a touch here by 0.4% on the S&P 500. On the NASDAQ, down a similar amount. We're negative by 0.37% on the NASDAQ composite. Turning to the food sector, Albertsons rising after a Bloomberg scoop that the company, along with Kroger, is selling stores to C&S Wholesale Grocers and SoftBank to help with their $25 billion merger. Katie Greifeld has the story. Hey, Katie.
Hey, John. Yeah, Albertsons currently up about 1.8% on the heels of that Bloomberg scoop that C&S, with, of course, backing from SoftBank, is in talks to buy most or all of the grocery stores that Kroger and Albertsons are looking to offload here. That's according to people familiar with the matter. So rewind here. Remember that Kroger agreed to buy Albertsons in that $25 billion deal last October. The end product, of course, would be a U.S. grocery giant with nearly 5,000 stores. And at the time, to soothe those antitrust concerns, the company said that they would sell up to 375 stores, which brings us, of course, to today. And it's not clear so far how many stores C&S would be acquiring or how much they would pay for them. But according to this Bloomberg scoop, that deal could be announced as soon as this week, John. So watch this space.
Stock is up 1.6%. Katie, thanks for that. Let's turn to earnings. Roku raising its third quarter revenue forecast and cutting 10% of its workforce. We determined to implement additional measures to bring down operating expenses by consolidating office spaces, slowing headcount, and limiting new hires. Isabel Lee has more. Hey, Isabel.
Hey, John. Investors are definitely liking that news because the stock is up around 14% for today, and the company also raised its guidance to between 835 to 875 from 815. So that's a massive increase. And Roku is among the tech and media companies that have earlier this this year face prospects of weakening sales as advertising pulls back. And the company last year warned its investors of a tough economy ahead. In March, it also cut back some 6% of its workforce, and this is the second time this year. But because of this recent update, it seems like it's going to be good news for the stock moving forward. We have Bloomberg Intelligence saying the outlook suggests revenue gains are reaccelerating, and the job cuts should help overall profitability. And we have Piper Sandler, for its part, raising its price target to 90 from 70, John.
The stock likes it, up almost 14% there. Isabel, thank you for that. Isabel Lee there on Roku. That stock higher to 95.23. The broader market looks like this. 8 minutes into the session, we're negative by, let's call it 0.4%. Yesterday, more price action in the bond markets pay attention to. Yields higher by 16 basis points over the previous 2 days. Yields this morning on a 10-year lower by, let's say, a basis point or two to 4.24. Plenty of blame to go around, some for the commodity market, some for this. September kicking off with a flurry of new debt deals. At least 40 businesses tapping the high-grade debt market on Tuesday alone, with US companies pricing more than $36 billion in new bonds, marking the busiest session of the year so far. BlackRock's Amanda Lynham writing, quote, a key implication of the higher for longer interest rate environment that we expect is an increase in performance dispersion across the corporate credit markets. I'm pleased to say that Amanda Lynham joins us for more. Amanda, let's start with what's happening with supply currently. Are you expecting the same through the month of September?
Good morning, Jonathan. Thank you for having me. Yes, September is historically an exceptionally busy month for primary market supply. Over the past 5 years, it's actually been the busiest month in the U.S. high yield market. And in IG, it's also one of the busiest alongside March and May. So the significant uptick in activity that we've seen, it should be widely expected by bond market participants that have played in this market for a bit. It's just historically the seasonal pattern. I think there are two things, though, that are really important to watch. One is arguably for the high yield market, this is a larger test because we've been coming off of 2022 and year to date, which has been so low from a supply perspective. So it will be notable to see how the high yield market digests the wave of new issue activity that we expect for refinancing. You had noted that this so far this week, while early, has been dominated by investment grade. And so I do think watching that high yield market, and we've seen some announcements this morning, how that flows through the rest of the month will be critical. And then second, you've been talking about it all morning in terms of, is the primary market activity the reason why there's been a sell-off in Treasury yields? And certainly there is a link in terms of, and this is mostly an investment grade phenomenon, if investors are buying a new issue and they wish to hedge the interest rate component, they will sell a maturity of the equivalent, or they will sell a Treasury of the equivalent maturity to kind of hedge out that interest rate risk and isolate the spreads. I think the issue, though, is that the activity we saw in the U.S. IG market so far this week has been heavily skewed to the front end. And I don't think in general that we can attribute it primarily to what's going on in the primary corporate credit market. I think there are enough cross currents, as we've all been following, to really attribute the volatility in the Treasury market to other things outside of corporate supply. But certainly there is a link. I just think that where the issuance has been focused predominantly in the front end, predominantly in single A rated IG issuers, I don't think that we can draw that link completely.
Well, there's two ways of looking at this. Either the people in the Treasury market weren't paying attention to the supply that was coming through, or Amanda, there's other things, and you've pointed to those other things. So let's talk about it. Those other things, what are the other things you think we should be focused on?
Well, certainly the higher for longer narrative, we can't seem to close the door on that completely. And I think that's probably appropriate. The rally in commodities and crude in particular in recent days has kind of added further fuel to that. We've seen certainly announcements from certain sectors in terms of the potential impact to margins and the bottom line. And I think in some ways we can't really dismiss that narrative that the Fed will need to remain in restrictive territory for quite some time. And certainly whether there's one or two more tweaking hikes from here, I don't think can be completely ruled out. And so that does lend itself to pressure in the Treasury market specifically, as kind of the market adjusts to what is a higher for longer cost of capital environment. Now, as it relates to corporate credit, I think really it's all about dispersion. And so we think that that higher for longer cost of capital environment will drive dispersion across asset classes. So whether that's public versus private credit, fixed versus floating, if you think about high yield versus leverage loans, as well as sectors. So sectors with strong pricing power. Are you a commodity purchaser or are you a commodity producer? Arguably, those are kind of really important factors in this current environment. And then certainly at the issuer level, are you aggressive with your capital management structure? Have you been paying down debt? If you're doing M&A, are you funding that with equity or cash? All of those things will add up to success or not on a relative basis on how sectors and companies can navigate this environment.
Amanda, let's just stay on the energy component of that. The winners and losers of $90 crude. Right now, Brent is back through that level. For WTI, it's 9 days of gains. Incidentally, longest daily winning streak potentially going back to January of 2019. Now, Amanda, years ago, we used to talk about the high yield sector being very sensitive to energy. Just how energy sensitive is high yield now versus where it was, say, 5 years ago?
Sure. So to frame this, energy has probably been one of the more bondholder-friendly sectors in the high-yield market over the past few years, because those companies have been really diligent in previous years about paying down debt, specifically coming out of the pandemic. So the sector in both high-yield and IG, for that matter, trades tight to the overall index. In terms of the sensitivity, when you're up at levels where we are in crude, so I would say really anywhere north of 50 dollars a barrel, and we're clearly well above that now, the sensitivity flow through to high yield isn't as extreme as you might think, because you're so far above the break even that the incremental cash flow to these companies, it's not going to make or break them in terms of a fortune perspective. And so really it boils down to, we know they have the ability to do bondholder friendly balance sheet repair, but do they have the willingness? So it's less about the price of crude at that point and more about what is the management philosophy on the balance sheet. I think for corporate credit investors, this is going to reignite this debate about input costs, margin pressures. We've gone through this to varying degrees over the past few years about, again, are you on the commodity purchasing side of things or are you on the commodity producing side of things? And those have different fortunes associated with them. And I think that's really going to drive the dispersion. But energy is already at this point priced pretty tight relative to the broader markets. I think also the last time I was speaking with you, we had talked a bit about financials. And I think, this kind of also isolates some of the kind of unique capabilities of the financial sector in not being as exposed to input costs, not being as exposed to some extent on wage pressures and labor costs and freight and logistics. Those are different dynamics and conversations that we're having with investors. And if you looked at, say, just isolating U.S. investment grade, you look at financials and bank spreads relative to industrials, they're still hovering at levels outside of the March regional bank disruption. We're hovering at levels that we really haven't seen since 2012. And so that's a sector that I think is really coming back into focus for investors in terms of if other non-financial sectors are dealing with cross currents, whether they're higher input costs or wage costs, are there other places to look to deploy capital?
I often say this whenever we talk, but Amanda Lynham, that was a clinic. Amanda Lynham there of BlackRock. Amanda, thank you. Coming up, crude on a 9-day winning streak.
The potential for ups and downs and roller coasters on gas prices is impactful in the day-to-day, but we're not going to vote.
They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
This is Bloomberg.
2 days of losses potentially on the S&P 500. We're down here by about 1/3 of 1%. That's the price action. Let's get to the trading diary. The week ahead looks like this. Fed releases its beige book at 2 p.m. Eastern Time. President Biden speaks at 2:15 this afternoon. Thursday, more Fed speak. Harker, Goolsbee, Williams, Bostic and Bowman. And another round of jobless claims. And on Saturday, the G20 summit begins. From New York City, that does it for me. Thank you for choosing Bloomberg TV. Good luck, of course, for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg. financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Wednesday, September 6th. Here are the top market stories that we're following for you at this hour. The dollar wrecking ball. Dollar mixed, Asian currencies weaker. What this means for economies and markets. And energy deals. Enbridge scooping up 3 utilities for almost $10 billion. Bridgepoint buys ECP for $1 billion. We're going to get the view from the C-suite with Williams CEO Alan Armstrong and Weatherford International CEO Gershon Saligram. And services spend. We get the latest read on the economy with Anthony Nieves, ISM Services PMI chair, as those services numbers break right now. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Before we get to that, Guy, we have the Bank of Canada.
Bank of Canada, actually a bit of a non-event. 5% matching estimates. I need to see what Tiff Macklem's got to say, though. He's got a real challenge. He cannot make the same mistake that he made in January, which was saying, we're going to pause, then the market starts pricing in cuts. And I think that's what they've got to try and avoid this time round. It's going to be interesting to see whether the ECB and the Bank of England have to make kind of same decision. How do they keep it hawkish, yet pausing at the same time? The Governor of England, Andrew Bailey, out on the tape right now. We are near the top of the cycle on interest rates. But the ISM data, Alex, is strong.
Yeah, and you can see it reflected. Yields popping on that. Let's get to it with Michael McKee. Hey, Mike, what do you got?
Well, we got a number that kind of matches what the guesstimates for third quarter GDP are going to be. Services PMI comes in at 54.5. That's up from 52.7. Business activity, which is the production version for services, is at 57.3 from 57.1. New orders rise 57.5 from 55. Employment rises, although it's too late for using that in terms of forecasting the August payrolls, but it was up to 54.7 from 50.7. Supplier deliveries are easing a little bit, still under the weather at 48.5, but 48.1 was the previous. And prices paid, 58.9 from 56.8, so that's something to keep an eye on. One of the questions that Fed officials have been asked these days is if we are seeing the economy re-accelerate, does that further imbalance supply and demand and lead to higher prices? And that's something we know that they are keeping an eye on. So at this point, it looks like, at least on the services side, things are still pretty good. 54.5 is a good headline number.
This data is sensational, considering where we are and considering the kind of rate hikes that we've already had. Absolutely sensational numbers. This is an economy that is cracking on and really doing the business. Mike, thank you very much indeed. Mike McKee. We transition now to instant analysis. Anthony Nieves, ISM Services PMI chair, joining us now to talk about these numbers. Anthony, these numbers are really strong, and they're much stronger than economists had forecast. Give me your instant analysis on how we should be reading this data.
Well, looking at the 4 sub-indexes that comprise the composite, each one of them was up month over month, which had driven this index to come in at the 54.5. And that was driven by employment, up 4 percentage points. And employment still remains a mixed bag for many of the respondents. Some of the industries that comprise this sector, specifically accommodation and food services, had the largest gains, and they're still having difficulty backfilling positions.
Anthony, is this like the last gasp of summer? Is that what we can read? Do we read any seasonality into this?
I think this is actually better than what we've seen historically. We see usually a bit of waning in the summer months as people are on vacation. There's not as much hiring until September, which is typically the pivotal month going into the last quarter. And what we see now is this is even better than what we've seen pre-pandemic levels at that August threshold.
And Anthony, I'm looking at a prices paid index, 58.9. Has the Fed got a grip on U.S. inflation yet?
It's a great question, and one of our respondents actually commented on that and said they thought the Fed was doing a great job by staving off inflation with the interest rates, that looking at how prices have moderated from where we were near 80% back just several months ago. Still, prices are increasing, just as not at the levels that we had seen in the past several months.
So, Guy, the market, is it too hot or is it just right? I think is a question, because you take a look, the dollar up, yields up, stocks roll over. You're now seeing the higher odds of a November rate hike coming into the market. I mean, all of this is pointing to a different story than anywhere pretty much in the world.
Which is why the dollar is doing what it's doing right now.
Right.
You've got to, if you are any other central bank at the moment, you do not have this problem. This is a U.S. problem. This is a U.S. issue, and the rest of the world is looking on in awe at the moment as to what is happening. Anthony, is this a U.S. economy that is re-accelerating? The rest of the world feels like it's slowing down. The U.S. doesn't.
All indications are that we're going to continue on this path. We had seen that from the respondents indicating this when we did our semi-annual forecast back in May. There was no talk of recession. Everyone felt the second half would be better than the first half, and all indications are that we're on that track right now.
Anthony, we were talking to Tim Fiore, your counterpart on the manufacturing side last week, and he said that it looks like we found a trough in manufacturing. We don't know how long we're going to be there for, but we found the trough. If that's true, do services need to roll over to meet manufacturing, or can it really now be manufacturing move up to meet services?
I think it's the latter. Manufacturing, I always keep an eye on the manufacturing because they're the bellwether. They usually lead into recessionary periods. They lead out of recessionary periods. And I'm glad to hear Tim say that, and the numbers indicate that. So hopefully we start seeing them get north of that 50 baseline sooner rather than later. Because I think that manufacturing, it does give us that forecast as to what the economy is going to look like down the road.
Can I just come back, Anthony, to what is happening with the labor market? Clearly, companies are still struggling in the service sector to get the labor they want, yet other data from other sources indicates that we are starting to see people coming back into the labor market. The overall labor market is growing. We saw the JOLTS data last week indicating maybe that actually we are now coming more into balance. Do you think, how consistent is your data on the labor front with what else we're seeing with the other data? How do you think these line up at the moment? Are your numbers consistent with that, or do you think your numbers are telling us something different?
I think they're fairly consistent with that because the respondents, it's a mixed bag. We have some companies that saying that you're holding back, it's a variable expense, let's see how the economy goes, let's see how our business goes, and it does vary by industry within this sector. Whereas other industries are saying, hey, we can't backfill fast enough, we don't have enough workers, specifically in that hospitality arena, accommodation, food services, retail, they can't find the workers as easily as some other industries can.
Hey, Anthony, before I let you go, here are the list of worries that many people say when they look at the consumer. Student loans ticking back up, savings being run down. There's also a great article on the terminal that talks about daycare now becoming an issue, as about 70,000 daycare closures could really impact the workforce. Any of this ring true at all for your respondents? Like, are they highlighting any of this as risk factors?
Not at this juncture. I've not, I go by all the survey comments that we receive, and right now I've not seen that. That could change next month, but all indications are that what they're mostly concerned about is inflation, is the long-term outlook of the economy.
All right, Anthony, thanks a lot. Super appreciate Anthony Nevis, ISM Services PMI Chair. Guy, a really unbelievable reading. I mean, let's be honest. Stocks rolling over, yields higher, yields higher, dollar higher as well. I mean, the weakness that we're still waiting for isn't coming.
The U.S. economy continues to defy expectations, and these are such strong pieces and such strong numbers. The data are strong. There's a great piece on the Bloomberg today talking about how the Fed is going to have to upgrade its GDP forecasts next time round. You look at the rest of the world. The rest of the world is in a completely different place right now. The Fed's going to have to be higher for longer. You are now having to seriously ask the question, I think, as to whether or not the ECB is going to be cutting before the Fed, whether the Bank of England is going to be cutting before the Fed. These are central banks that have come in late and are now potentially going to be cutting earlier. And we're going to talk about the dollar in a moment. The impact on the dollar of that maybe hasn't even still been felt yet.
Yeah, and you have to wonder, too, are we going to be, instead of really a market moving on, say, November hikes, is it going to be pricing out the cuts in 2023?
2024? Like, is that now what we're going to be trading on based on this data?
How can the Fed signal cuts at the same time as raising its GDP forecast? Every time this data, all the other data, points to the Fed having to raise its forecasts. That has to tell you that the cuts are further out, doesn't it? It just logically would seem to indicate that. But I do wonder whether the ECB is going to be under is going to have a real problem soon. It's going to have to start kind of fighting back against the cuts narrative. The Bank of England, I think, the same thing as well.
Or is it just normalization? It's not because of a recession. It's straight up normalization, which is different. Or is it the long and variable lags? Governor Bailey just talking about the substantial impact of rate rises still to come. Are we still going to be in that narrative for a while too? Anyway. It's going to be interesting.
Yep. I think all of this comes back to the dollar, though. The dollar, and you talked about it in the headlines, the wrecking ball of the dollar, maybe that's just getting going.
Which apparently was a Miley Cyrus callback, and I just didn't know it because I don't know anything about pop culture. So our question of the day is, how do you deal with the dollar? We're going to address that with Akayo Yoshioka, Senior Portfolio Manager at the Wealth Enhancement Group. Coming up next, this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
When you look at the broad commodity market,
commodity prices are rising.
Higher oil prices,
the spike in oil prices and gas prices.
Crude oil and gasoline prices might be a market-based measure of economic demand, and right now they're both very strong.
That tends to be something to follow as a catalyst into where you start to see inflation numbers tick up.
Pressure on inflation.
The last thing consumers need at this point in time.
It really does look like year-over-year inflation bottomed at 3% in June, and it's going to probably start drifting towards 4.
You probably saw the two weakest prints you're going to see this year over the summer.
If we are seeing higher commodity prices, eventually that should translate into higher yields.
We're going to see higher yields for a little bit longer.
The reality is that it's very, very difficult to achieve a soft landing.
There's so many wrinkles right now.
There's definitely some fraying around the edges.
Bad news might wind up becoming bad news as we move forward from here.
Those were some Bloomberg Television guests weighing in on the challenges of a soft landing. You got oil, higher yields, and that brings us to the question of the day. How do you deal with the dollar? Well, joining us now for her take is Akayo Yoshioka, Senior Portfolio Manager at the Wealth Enhancement Group. Great to have you on the program. How do you deal with the dollar? You can go many different ways in this direction. How do you deal with it?
Sure. It is difficult to deal with given expectations were that the dollar could be weakening, as we get towards the end of this hiking cycle. However, the U.S. dollar strength really is a reflection of the yield yield differentials across the globe, as well as just the surprising economic strength as we saw today in the ISM services number.
Do you think as well that it's a symptom in many ways of a US economy that is doing better than everybody else is? It is also a symptom of a US economy that still has the potential to generate inflation. You look at the prices paid within the ISM data. Do you think the Fed is done? Do you think the Fed is anywhere near cutting? What do you think the outlook is here?
In terms of, the Fed, I think they're going to continue to be data dependent. Do they pause in the upcoming September meeting? Probably, but I don't think they take future hikes off the table just quite yet. I think they do want some of that, those cuts that are priced into the market for next year to get priced out and not expect any cuts in 2024. I think that's still yet to come and needs to get reflected in overall market pricing.
Akayo, I just want to point out Henry McVeigh over at KKR upgraded his growth forecast. He said that the real GDP growth will surprise to the upside. Now sees 2.4% in 2023. And this was before we wound up seeing that super strong services ISM Goldman Sachs tracking number is already higher for the third quarter and the fourth quarter. How do you play that? Like, is the dollar then a wrecking ball that's going to hurt multinationals? Do you play it on a U.S. basis, even though a lot of optimism is already priced in? What do you do with that?
Yes, I think you've got to stay with the U.S. and, lean into that economic strength that we're seeing. It will hurt a little bit of the translation from a revenue standpoint. However, and especially the multinationals that have done so well. However, we still think that the U.S. has a lot of room to grow over the long term. And a lot of the companies that make up the public markets and public stocks are, primed for additional growth despite whatever the dollar does.
Let's look at how everybody else responds to this. Where does the surprise come from here that could upset this narrative? Is it that the Japanese get rid of yield curve control and maybe step into the market? They've been kind of signaling that overnight. Is it the Chinese come out and deliver massive stimulus and that changes the case around the dollar as well? Where does the surprise come that upsets the current narrative? We've got very used to narratives changing quickly. Are we about to see another one?
I'm not sure if we're about to see another one imminently. However, these are all the concerns that everybody's watching, and especially I think the one from Japan. I mean, we're at levels in terms of the dollar-yen cross-currency levels that, prompted Japan to intervene in the past. And, we haven't seen these levels in many, many years. And so, this kind of, portends additional potential relaxing of their yield curve control, and that really spooked markets at the end of July. So we'll see. It's all that transmission mechanism in terms of monetary policy into currencies and yields, and we'll see how it all turns out in the next coming weeks.
And it feels like if you front run it, it doesn't necessarily even pay off either. So Akayo, if I'm looking at, say, the sectors in the S&P that have done well over the last 3 months, it is pure on cyclicals. You've got energy, consumer discretionary, and industrials. What do you still like in that group?
Within industrials, we like quality names. Well, in general, quality names, companies with strong balance sheets and good free cash flow. Honeywell comes to mind in the industrial complex that is one of those strong, diversified companies with good free cash flow, high quality exposure to some aerospace that continues to do well. So we like Honeywell in the industrial space there. We like energy names. Chevron and Exxon continue to perform. Gasoline, higher prices there. Refining margins are going to continue to go higher. So we like a lot of the cyclicals on a longer term basis. It's tough to judge right now, just given the potential slowdown that might occur coming in 2024. However, if you can ride through that, those are very good names to continue to own beyond any sort of downturn in the economy.
Ayoka, Yoshioka from Wealth Enhancement Group, thank you very much indeed. The point about what is happening with the US industrials, Alex, is absolutely amazing. They have been huge performers. You look at Honeywell, you look at what's been happening with Deere, some of these big industrial companies that should be cyclicals. People are talking about the economy slowing down, but it's not, and they're really outperforming. I just want to flag something. The UK has announced that it's going to rejoin the EU's Horizon Science Programme. This is a huge deal for the UK and just basically speaks to the idea that relations are starting incrementally, slowly, to normalize with the EU. This is actually quite a big step forward. So it's fascinating to see that happening at this point. We'll see what happens going forward. Clearly, the UK at the moment, actually, the data, Alex. I know you like to rain on our parade.
I do.
But the UK data actually isn't as bad now that it's been revised significantly upwards. The US data keeps being revised down. UK data, EU data keeps being revised up. But nevertheless, you guys look like you're on a different page right now.
We really do. You really, I mean, but I wonder though.
I hate to say it.
I know you do. I know it's really painful. But the stronger we are in Q3, does that then sort of set expectations a little too high for Q4? But then I can go back and say, I've made this argument for the last year and it still hasn't panned out. So there's that also. Yeah.
The US economy looks like it's in a very different place. Maybe the upside to all of this is that maybe you'll all be coming on holiday again to Europe next year.
Maybe.
Because you're going to have your strong dollar. You're going to be able to afford that holiday to France once again.
I don't know,
man. It may just not be a one-off.
Not with those jet fuel prices, but that's a whole different story.
That's definitely true. Anyway, what are we going to talk about next? We need to talk about San Francisco. It's lost out to London. It's lost out to Singapore. It's lost out to Dubai as the blockchain capital of the world because apparently of hostile US government policy. This, according to the founder of the crypto pioneer Ripple Labs. More on that next. We're going to take you to San Francisco. The startup is coming. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. The markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
It's 7 on the West Coast. Beautiful day. We want to get to the startup where we cover the top tech stories from the Bay Area and beyond. As Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. Ed, San Francisco was supposed to be where the crypto world sort of blossomed. Now, you recently spoke with co-founder of Ripple, Chris Larsen.
Yeah.
That's not how things planned out here.
Yeah, look, the conversation was supposed to be about San Francisco and how he's trying to fix it, but we very quickly changed to him lamenting that, to his mind, the federal government and regulators killed the industry in this city and that it's lost its title as the blockchain capital of the world. But he had particularly sharp words for Gary Gensler, the chair of the SEC. This is what he said.
Gary Gensler's decision of sort of engaging this regulation by enforcement, rather than getting clear laws. He knows they're not clear. He just likes that lack of clarity so that he can go after anybody and make up the rules as he goes along through bullying. And that's not the American way.
You know, that's pretty sharp, calling the chair of the SEC, any regulator, a bully. But his point was that they're trying to fix the industry through the courts and not through regulation. And he gave me this stat that had they not killed the industry here, he thinks that the post-pandemic economy here in SF would be markedly better. Vacancy rates for commercial real estate, for example, would be half what they currently are, which is about 32%.
Ed, I just want to transition quickly to what is happening with Apple.
Yeah.
Does Apple have how big a China problem does Apple now have? You've got this new Huawei phone, which I'm assuming people are going to look at as a comparison to an Apple phone. And now you've got the government saying, if you work for us, you can't use one of those.
Yeah, the Journal reporting overnight that central agencies, some have given instruction via message and in meetings to get rid of your foreign phone, not just Apple, but a non-domestic brand phone and make a domestic brand phone. I would remind the audience that a year ago, Bloomberg reported that the Chinese government issued a very similar directive for personal computers, that they gave a 2-year deadline for all government agencies and state-backed corporations to transition to domestic hardware for personal computer. But next week, we have the Apple event on the 12th. We remind ourselves that not just the proportion of revenue that comes from Greater China, but so much of the installed device base is there. So it's a worrying time for them. It will be interesting to see if they actually proactively address this next week.
Ed, thank you very much indeed. Bloomberg's Ed Ludlow. You can catch Ed, of course, and Caroline Hyde on Bloomberg Technology coming up in around 90 minutes' time. They're going to have more on that interview with Ripple Executive Chairman Chris Larsen. Coming up, we need to talk about that data that we got out of the ISM. Absolutely fascinating on the hiring front. Bruce Van Saun is going to join us from Citizens. He's the CEO.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions. This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, the big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We're about an hour into a trading session. Let's see if you heard this one before, right? Good news, bad news for the equity market. ISM services kind of blowing out of the water, and equities heavier on that report. Abigail's tracking the moves. Abby?
Indeed, Alex. We have the S&P 500 down 0.7%, the worst day in about 2 weeks. In fact, down a second day in a row. That is the longest losing streak in about 3 weeks. So this mini rally that we've had recently being disrupted, and by that ISM print largely that Alex was talking about, this idea that maybe the Fed's going to have to step in. It might not be in September, it might be at the November meeting, but nonetheless, this idea that more money might be taken out of the system. We see this with the dollar, Bloomberg Dollar Index up 0.2%. Yields are higher, pressuring stocks. The NASDAQ is down more. Over the last 2 days, the S&P 500 down more than 1%. Let's connect this. This chart is pretty busy. We've taken a look at it before, but it's a helpful chart. What we're looking at here in white is the S&P 500. In blue, we're looking at the Bloomberg Dollar Index. You can see a clear inverse relationship. So as the S&P 500 has gone up this year, the dollar was basically in a range, but now the dollar is starting to break out. The Bloomberg Dollar Index is still in this range. It looks to me like we might actually see the S&P 500 go out of that range if the dollar continues to climb. I would say that there's a pretty strong chance of that, especially since the S&P 500 right now in overbought territory. That's actually bullish, but if it starts to turn back down, as it may, beware for sure. Another pressure right now, and this is so interesting, we actually have oil higher, not so much on the day, but over the last couple of months, we have oil up 22% on the year, up more than 10%. And right now, into today, despite the recent dollar strength, you have this oil rally. You usually don't see that. Is there really the demand out there? That ISM print may suggest it. It's interesting, though, rising oil, Alex, as you know, not so great for airlines. And of course, 3 of the big airlines today came out saying that rising oil might produce a problem, but you can see Southwest Airlines is the one that's really suffering, down 2.2%. They tightened their revenue range. They're also talking about August was a little bit weak for consumer discretionary spending, but they see more strength. But I think we have to discount Southwest Airlines, Alex, because of course they had the snafu last December, so it's probably not as even of a look, and the airline group overall higher.
Yeah, but no doubt that word hedging is going to come back into play. Abigail, thank you very much. Really appreciate it. All right, well, activity in the U.S. services sector just crushed it in August, driven by strains in new orders. You also got hiring. The demand's really there. So we want to take a broader look at the consumer and the overall economy with Bruce Franson, Citizens Financial Group CEO. He joins us here on set. Bruce, great to see you. Thank you for joining.
My pleasure.
So the ISM services gives one picture. The excess savings, potentially people spending on credit cards, student loan debt coming due, that paints another picture. What picture do you have?
I think the economy remains in pretty good shape, and we're likely to see the soft landing scenario, I think, now has moved to the fore. So I think the Fed has done a good job of bringing inflation lower, but not completely snuffing out the job market, so people can still find jobs. They've exhausted some of their excess savings, so as you say, they're starting to draw down on some of the savings that built up during the pandemic, and then also starting to borrow on cards a bit. But for the most part, consumers are in good shape. We're not seeing any loan delinquencies, and companies mostly are in pretty good shape as well.
Bruce, good morning. It's Guy. Do you think, therefore, the Fed has done enough? Do you think it needs to do any more to slow the economy down?
Yeah, I think they likely have done enough, although we'll just have to watch it. I think the ticking up in energy prices is something to consider, the continued strong consumer spend. But, you know, monetary policy works with a bit of a lag, so I think they have to wait through November and take another gauge of the data at that point. Likely they're done. If they go again, it might be one more 25 basis point hike. But I think that's it. And then likely we would see a pretty long period of stable rates before you start to see cuts. I think those likely hold off till the middle of 2024.
Just one more quick one on the consumer from that end. You guys did wind up ending your car dealer financing, right?
That's correct.
And it was because of recession worries. Like, are you disappointed that you did that now because of where the economy is? Or are there other areas that you're looking at?
It's a little more nuanced than that. So effectively, once deposit costs increase through this whole rising rate with the Fed scenario, and deposits became more dear, we kind of looked at where were we invested on the asset side of our balance sheet. And auto is a relatively short duration asset that we kind of used as a shock absorber. It's not a very strategic business because we don't have deep relationships with those customers. They're customers of the dealer. So this was more of a strategic play. Let's run down some of our higher cost funding and run down that portfolio. In its place, we're using the capital freed up to launch this former First Republic private bank that a bunch of folks came over to Citizens. And so we'll run down $9 billion of auto and related consumer paper and build up $9 billion of loans to the private bank's customers. And so therefore that'll become a strategic use of our balance sheet and replace something that wasn't that strategic.
Bruce, are you feeling a little over-regulated right now?
You know, we're in a heavily regulated...
Every CEO say yes to that. Does he have to say yes?
Well, we're in a heavily regulated industry, and you know, some of that regulation has really kept the industry strong and kept the confidence of all our stakeholders. I think at this point, some of the new proposals feel like they might be overcooked in terms of requiring more capital and kind of gold plating what the Basel framework intended. But there's a significant comment period right now that I think you'll get lots of views on that. So, you know, it'll play out down the road, but for the most part, we're continuing to try to maintain good relations with the regulators and keep the banking system safe and sound.
And of course, we're talking about having to issue longer-term debt if you have a market cap of over $100 billion. There also has been reports here at Bloomberg that the Fed is putting a lot of pressure on you guys, not you personally, but regional banks, to beef up other measures as well. How does that affect your end product?
Well, I think if you look at the report they did on SVB's failure, they had a bunch of MRAs, or these recommendations from the regulators, that really weren't followed up promptly. So you would expect in the wake of that the regulators are going to be more on the front foot, more putting pressure on banks to really tighten up how they run and to get things done on time if there's any issues outstanding. But I think that's all manageable. So I don't think it affects necessarily how we're running the bank, but we have the strength and the breadth of talent to be able to comply with what they're looking for.
Does more regulation, Bruce, imply more consolidation? Can I extrapolate one from the other?
Yeah, I think there's a couple things that potentially drive more consolidation. So that would be one. So if the costs of operating the bank on a standalone basis go up, and these new regulations really run right over tailoring, which there used to be break points where the load was a little less the smaller you got, which is now kind of called into question by these new proposals. So I think that could potentially foster more consolidation. The other thing is just the way the world is changing so fast, and banks have to invest in digital and data analytics and AI and cyber defenses and fraud defenses. The smaller banks really, to afford all of that investment, are going to need to consolidate, I think. So I think certainly at the smaller end of the equation, you'll see consolidation due to more technology and business model reasons. But the bigger banks, you know, the question is, do you want to have just 4 mega banks that are in the too big to fail category, or do you want to spread that out and have more competition for those very big banks? And that's a policy question that I don't think Washington has determined yet which way to go on that.
So does that mean no or yes to you? Like no or yes in terms of looking at acquisitions? Because you sit right in the middle of the two things.
Yeah, no, I think right now you're not going to see a whole lot of acquisitions just because with rates as high as they are, the deal math doesn't work very well, and it's still very opaque in Washington as to what their posture is. So I think that'll kind of stymie deals over the next 6 to 12 months. But you'll start to see things getting done at the smaller end. And then, you know, we'll see if there's what happens with the next election cycle, and is there a change in the regime, and could that, with falling rates, if rates go back down below 4% and there's a fresh regulatory view, does that facilitate more transactions maybe in 25?
How long do you think it's going to be, Bruce, before America has another SIB? Is that the ultimate direction of travel here? And do you see your bank playing a part in that process?
Yeah, we have a long way to go before we would get all the way to that size. But, you know, I think some of the Category 3 banks, you've had PNC be aggressive as a consolidator. You've had U.S. Bank as well. So I think, there's opportunities for some to try to scale that $1 trillion level. We'll see how it plays out.
Give me some idea in terms of just the issues that were at play in this industry, say 6 months ago. Deposit outflows, then deposit inflows, as there were some concerns about other banks, et cetera.
Yeah.
Net income margins is getting squeezed. Has the bleeding stopped, or where is there still a trickle?
Yeah, I think we're in a period of stability. And from where I sit, the worst is behind us.
Okay.
And so deposit flows have stabilized. The migration from your non-interest-bearing deposits to interest-bearing has slowed. So I think you saw pretty good results on those dimensions in the second quarter earnings. I think that will continue in third quarter, that you should see more deposit stability. Certainly banks are going to continue to pay up for deposits, so funding costs are going to go up and margins are still getting squeezed a little bit. But I think they're close to bottoming out. The other thing that we're seeing is the capital markets are starting to open up. Like Citizens is going to be on the cover of 3 IPOs this month, which we haven't been able to say in a long time. And so there's deals flow starting to pick up, which also should help the revenue picture.
Great stuff. Bruce, thanks a lot. Great perspective. Bruce Franzon, Citizens Financial Group CEO. Come back next time you're in New York as well. Coming up, we're going to take a look at how rising interest rates are putting pressure on hedge funds to perform. It's a basis trade. We're going to talk about it in today's Wall Street Beat. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
Breaking news for you. is said to renegotiate nearly all of their leases and exit unfit locations. That stock was halted for trading volatility. It's now up 16%. I'm just going to go right to Wall Street Beat because Shonali's here and we're going to talk about it. And this is what the Wall Street's going to be buzzing about. Renegotiate all leases in some ways is not a surprise to me, but what are unfit locations?
There is no quantification of what unfit locations are. Now, this was a CEO letter posted on their website that starts actually talking about the hyper growth, the unsustainable growth that they had initially, and then it blames the pandemic. It says they navigated a pandemic and had gone through some of their transformation at that point. Now, remember, we knew that they are trying to operate now to avoid any potential future Chapter 11. They have cited going concern issues. They say that over 2/3 of operating expenses in the second quarter, they have been able to get a handle on it, but they still remain too high, and this is their wording, are dramatically out of step with the current market conditions. And so, to the point we've been talking about in the commercial break while we saw this coming out, there are very drastic moves in commercial property prices, and now WeWork wants their share of the benefit of that.
Shonali, what's the next domino after WeWork?
That's a great question because we know that WeWork is in a lot of these large commercial office properties in many cities around the world. The question, to your point that you were asking earlier, where exactly are the problems lying? A few more headlines around this is that they do intend to remain in the majority of buildings and markets. So this renegotiation process is pretty important, isn't it? Because it will determine whether they stay there or not. They will exit unfit locations, but again, we don't know exactly how many locations that will be, particularly when they're also saying that they want to stay in the majority of markets. So their total pullback, and remember, there were a lot of WeWork copycats as well. So the total market dynamic here is still unknown, especially when you see such a giant in the room going through such a massive transformation.
Before I let you go, there was also a really interesting article from the Financial Times that talked about basically hedge funds basis trades and how the Fed and regulators are quite worried about this. We even saw in Jackson Hole liquidity being a primary issue that they're focused on.
This is a massive story this year, and the reason being is you have a scoop we had earlier this year. The Federal Reserve, the SEC, has also been asking prime brokerages about it, and now an international body, the Financial Stability Board, really targeting non-bank investors and really blaming these investors for the spike in demand for the liquidity in March of 2020. Remember, this was largely a pandemic era. However, this was a moment the Fed had to step in and really intervene in repo markets, which are distorted in times of stress for these hedge funds. Now, they say macro and relative hedge fund strategies in particular, which tend to employ the so-called basis trades. This is the arbitrage between futures and current trading in Treasury markets, which of course we know are very volatile. So everyone does have their eye on it. A lot of debate about how dangerous it is. Sometimes these trades are levered 50-to-1, guy, and clearly you have international bodies now taking a closer look as well.
It's interesting, even those in the market talk about the market being overfished. They talk about the inevitability of leverage caps coming in. Maybe that's ultimately the direction of travel here. Shonali, great stuff as ever. Thanks for being on hand to deal with that WeWork story. We'll come back to that in a minute. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside? Here, European natural gas prices are down sharply. The strike in Chevron's LNG facility in Australia is now on halt until Friday, so we get a little bit of a reprieve there. Speaking of energy, the Barclays CEO Energy and Power Conference is underway here in New York. The outlook for the industry very much in focus is oil around $90. Natural gas demand still picking up. So joining us now with perspective is Alan Armstrong, Williams CEO and President. Williams handles about 30% of the natural gas in the United States that's used every day to heat homes, cook food, and generate electricity. Alan, great to see you.
Great to see you, Alex. Thanks for having me today.
You bet. So what's your outlook? We talk about whether we're in a recession or not. Will we get there? Will we not? What's your outlook for the U.S. economy right now based on flows through your pipeline?
Yeah, you know, we are seeing a big pickup both in current demand. We've had 5 days this year over 50 BCF a day of power generation. So that's a 6% growth from last year's peak, which was also a big year for power generation demand. So we've actually hit a record this year of 53 BCF a day, which is an all-time record for power generation demand. And you might think of that, well, gosh, of course, because it's been so hot this summer, but this part of the country, as you know, barring this week, has not been all that hot. And really, a lot of the populated part of the country really hasn't been that hot. So anyway, really extraordinary pull on natural gas coming from power generation right now. And importantly, a lot of signs of increases in capacity on our pipeline system. So I don't know when I've seen a time where we've had so much request for new capacity builds on our pipelines. And a lot of that, I think, is the market is realizing that reliability is going to have to be there. A lot of electrification going on around the country, and with that comes more and more pull on gas-fired generation to complement renewables in our markets.
Okay, so that's a big outlook. We've seen in the last 24 hours a lot of M&A now. Enbridge, for example, buying 3 utilities from Dominion for almost $10 billion, right? Do you think that this demand and this shift that we're going to be seeing over the next couple of decades, are you buying stuff? What do you see for M&A in the sector?
Yeah, you know, I think for us, because we have so much growth, organic growth just around our existing asset base, and we've got such a large footprint that allows us to buy assets that are just bolt-on to our businesses, I think that's really the best place for us to play right now. So we continue to have very high return investment opportunities in and around both our gathering systems and our pipeline systems. And, you know, typically people think about pipelines being a regulated rate of return. And the truth is that on expansions, we're not limited by that because we can't be forced by the federal government or anybody else to expand our system. So it gives us, so in one way, the permitting woes of our country, which, you know, by the way, I think are really not good for our country. But on the other hand, being an incumbent pipeline has allowed us to continue to have really attractive returns in the expansion of our existing assets.
Alan, good morning. It's Guy. When you think about those acquisitions, you're thinking about the long term. How long do you think those pipelines are going to be carrying natural gas?
Yeah.
When you think about those acquisitions, are they going to be carrying hydrogen in the future? Can you just talk to me about how you see your business going through the energy transition and whether a pipeline is good for natural gas, is also good for hydrogen or other potential fuel sources?
Yeah, you know, here in the U.S. with low-cost natural gas supplies, hydrogen is going to have to be heavily subsidized for it to make work. We actually, as Williams, we have 4 projects in front of the DOE right now looking at hydrogen hubs, and so we are certainly a part of that. But the fact is natural gas is so much lower priced here in the U.S. and is such a lower carbon fuel that we think natural gas is going to be here for quite some time. We have a lot of room to run in terms of reducing higher carbon content fuels like coal and fuel oil. We've got a lot of ways to go to continue to reduce emissions by using that. You know, replacing coal-fired plants with gas is a 40 to 50% reduction. If we were to replace the remaining coal plants here in the U.S., there's about 230 remaining coal plants here in the U.S. If we were to replace those with gas, that's 35 million vehicles off the road.
Alan, you talk about the permitting issue. If the Republicans were to take the White House, do you think it would be easier to get permits for new pipelines in the United States?
You know, it wasn't easy during the Trump administration. I always remind people of that, you know, the permitting problem often starts at a local level, and really our permitting process is such a morass these days that it's not that simple just to fix it. Very thankful for the efforts of Senator Manchin in pushing for permitting reform and pushing for the Mountain Valley Pipeline, which is a huge positive for Williams. But frankly, I don't think it's as simple as just replacing administration. It's a very complex issue.
We just have about 30 seconds left. But if someone said, build all the pipelines you want now, Godspeed, go. Business booming. What's the biggest problem? Is it material? Is it labor? Is it cost? What is it?
It is dealing with the local right-of-way. So if you said, it's just so hard for me to get in my head that you could actually go build a pipeline without all of that. But I'd say building from the Marcellus and connecting the Marcellus to LNG export on the East Coast is the single biggest positive that we could gain for our country. Because we have this enormous resource, and the market is really hungry for natural gas around the world.
Okay, we'll get back to you on sort of what's the hardest part about that, aside from permitting. Alan, good to see you. Thanks for stopping in. Alan Armstrong Williams, CEO and President. Coming up, European close, Georgia Taylor of Invesco, Georgina Taylor, will be joining us up next in the next half hour. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Wednesday, the 6th of September, European equities are under a bit of pressure. The luxury sector is under a lot of pressure. We'll talk about why in just a moment. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Let's check those markets, figure out what is happening. European equities down by around 0.5%. There's a bunch of reasons for it. The one I want to highlight is Richemont, the luxury goods company's management team out at the AGM a little bit earlier on. The boss is talking about the fact that Europeans, well-heeled Europeans, have stopped spending or are cutting down on their spending. They haven't stopped spending. They're cutting down on their spending. Inflation is hitting even the highest echelons of the economic spectrum in Europe, and that's starting to ripple through the whole sector. Richemont is down by 4.5%. The rest of the sector's under real pressure as well. That's a real fear in that sector. The Chinese are under pressure. The Americans are already slowing. If the Europeans slow as well, that is a big problem. One factor which may help out those beleaguered upper-end spenders is what is happening with the natural gas picture. It's down by 9% today. Looks like the strike, as Alex was saying, in Australia at the Chevron plant is on hold until Friday. Doesn't mean it's gone away completely, but this is a very volatile market right now, Alex.
So as Guy kind of outlines here, you're looking at the negative reasons why European stocks are down. Here we have like good reasons why the U.S. stock market is down. Yes, the S&P is off by 0.8, tech getting hit hardest, but that's because the ISM services was so good. It was so strong along all areas in terms of employment as well as new orders. And so that actually then weighed on the equity market. Digging into some of the details, skip WeWork for just a hot second, but Bloomberg dollar then right around the highs of the session of 0.2%. We'll get to that in a moment as well because, higher yields jumping about 6 basis points on the 2-year. We're seeing the swaps move maybe more towards a hike in November, but it does feel like maybe the question actually is we need to price out cuts in 2024 now based on some of this data. And then back to WeWork, totally idiosyncratic kinda. That stock up 8%. It was up 18%, so we are fading this pop after it said it's going to reevaluate its office leases, try to renegotiate them, exit bad businesses. I have no idea how to quantify that though, but it's kind of about time, Guy.
Yeah, we've been waiting for this one, haven't we? You've got some green on the screen. I want to talk more about what you were just mentioning with the dollar and the fact that the data out of the United States is so strong that the buck just keeps on going. There's no sign of the buck stopping anytime soon. And that's putting pressure on different economies around the world. But the two most obvious ones that we've seen today are the Chinese economy and the Japanese economy. The Japanese pushing back really strongly against the idea that the yen should fall further from here. The intervention chat starts again. The Chinese are fixing, and they're using that fixing to send a clear message, Alex, about what is happening and the fact that they don't want their currency to be under pressure. But basically, the dollar strength adding to yuan problems, adding to yen pressure, and that is a big problem in Asia. But it's not just Asia, Alex. It's Europe as well. You have to be looking at the scenario in front of you right now and thinking, the Fed ain't going to be cutting anytime soon. But you look at the European data, the data out of the UK, out of Germany, out of France, and you do wonder whether actually the ECB and the Bank of England could be the first to cut, whether or not actually the Fed could be going much later, and that's going to be a big problem again in this dollar trade.
Yeah, ECB Governing Council member Visco speaking in Milan saying we don't follow Fed policy. Sure, easier said than done. And speaking of that point, Bank of England Governor Andrew Bailey did speak before the Treasury Committee on the inflation outlook and kind of where rates are near the top.
Many of the indicators are now moving as we would expect them to move and are signaling that the fall in inflation will continue. And as I've said a number of times, I think will be quite marked by the end of this year further. I think we are much nearer now to the top of the cycle.
We are near the top of the cycle. Even the hawks at the ECB are signaling maybe one more hike to come through. The market today, after that ISM data, putting further hikes potentially back on the table for the Fed, or certainly pricing out the cuts that we've seen. And that is going to be a further tailwind for the dollar, which takes us back to our question of the day. How do you deal with this strong dollar? Joining us now to deal with this, our European economics editor, Joey Sneevice, Noor Ali, Bloomberg M Live, joining me here in the studio. Noor, I'm going to start with you. We've got a situation where the US data just keeps getting stronger and stronger and stronger. The ISM is the perfect case in point today. The European data, you look at the German data over the last 24 hours, looks like it's certainly rolling over. Europe's dealing with stagnation. Canada's dealing with stagnation. Are we in a scenario now potentially where the Bank of England, the ECB, could be cutting well before the Fed?
I mean, look, today, surprisingly, the Polish central bank really made the headlines. We had respikes across the terminal because they cut interest rates by 75 basis points here. They weren't expected to do that or by as much. Yeah. So the question here is, what's your positioning, right? Where do you think central banks are headed? If you think the Fed is going to continue on hiking while the ECB and the BOE and the European central banks in comparison are probably going to have to cut sooner, then that's your bullish dollar bet, right?
So we wrap that in then to what central bankers are saying from the ECB, right? Like, we're not going to follow the Fed. We're going to keep fighting inflation. Maybe we're done, but we're going to keep fighting it. We're going to ignore the Fed. Is that realistic?
So that gravitational pull of the Fed is one of the things that the ECB has been trying to withstand. Overall, we are a week away from the September rate decision. On that, it's very open whether that'll be a hike or a hold. The Hawks, and today's the final day they can speak before that quiet period sets in, the Hawks today went out quite strongly saying another hike is needed. On the other hand, you do have people like Ignazio Visco from the Italian central bank, a traditional dove, who say, you know what, a hold might also work. So overall, though, the ECB, given that euro weakness that you're mentioning, the ECB, irrespective of what they do next week, they will try to give a hawkish slant overall to their message, just because every time they're dovish, the euro weakens further. Yeah. So that is one of those things that they need to also indicate we're going to stay high for a while, because again, if they don't hike next week, the first question is the one you asked: when do they start cutting?
Yeah. Yeah, Zoe, this is the problem. The Fed doesn't have this issue. The data in America are coming through stronger and stronger and stronger. You look at the GDP forecast that we're expecting from the Fed, it's expected to be upgraded. The ISM data today, much stronger than anticipated. The Eurozone data is not delivering that. How is the ECB going to manage that communication? That as soon as they pause, the market is going to extrapolate and it's going to say, you need to cut. Realistically, can the ECB avoid that?
I think they're trying already now. Last night, the German central bank governor, Joachim Nagel, went out quite strongly, saying bets on a rapid cut once we reach peak rates are misguided. Similarly, the French central bank governor, Villeroy, who is very much kind of in center ground on the ECB, he made the point that keeping rates high for quite some time is the thing that is more important than another hike. So, but if we look at history, the ECB's peak rates never have been that long. Mm-hmm. The longest they had was 7 months. And that was in year one of the euro. The other peaks they had were 3 months or 4 months of peak rates. So that would mean quite quickly. And if I think back of our latest economic survey on what economists think how long rates will stay high, they thought there wouldn't be a cut until March, which would be now at least half a year.
Yeah, and even later for the Fed. So Nora, if all of this kind of plays out the way we think it is, and how does the dollar then affect European equities? Like, where does the wrecking ball land for Europe?
Look, I think that's an excellent question, Alex, because today I wrote about European equities being, quite attractive in terms of seasonality. We know that, towards the last quarter of the year, European equities typically tend to rise. That's according to at least the last 30 years, data going back to that much. We know that September is potentially not a good month for them, but you also look at their valuations, particularly relative to the S&P 500, and you'll see that actually they're quite appealing. European stocks have been much cheaper on a forward PE ratio compared to the S&P 500. They're also bang on the average here when it comes to their own valuations. So I could see potentially here, that they could potentially do very well. But in a wider wider macro here story with a stronger dollar. Risk assets typically don't perform very well as well. So that's a major headwind for global markets. And we're not just talking about Europe here. We're talking about Asian currencies. We've seen the Chinese, the Japanese step up, their support of their currencies overnight. That's massive, right? And that really plays a big role into what we're going to see into the end of the year. And that could be a big game changer.
Absolutely. Zoe, Noor brings up the issue of what is happening with the Asian currencies. Now, we often talk about euro-dollar as being kind of the most important sort of story that markets think about. But in reality, the basket for the Eurozone has a huge weighting towards Asia. And we need to think about what Asian currencies are doing. Does that take the edge off the issue of the stronger dollar for the ECB? If the Asian currencies are as weak as they are right now, does the ECB need to worry about the dollar?
I think it does need to worry about the dollar. Officially, of course, the ECB, when you ask them about anything about currency, they will highlight that they don't have a currency mandate, but they keep an eye on it. I think the issue that we have here with the Asian currency is that Asia also is weak. And if you're thinking about where you get your factory, where you get your orders, that might not necessarily be coming from Asia right now. You earlier mentioned Germany and how weak Germany is. One of the reasons for Germany's current weakness is that one of its main export markets, China, is just not doing very well.
Right.
So that just all ties together. Ignoring the dollar is at anyone's peril.
Really great conversation. Thanks for setting up for us. European economics editor Zoe Sneijs and Noor Ali of Bloomberg and Live. Thank you so much. Coming up, more on the question of the day: how do you deal with the dollar? We're going to get the take from Georgina Taylor, head of fundamental multi-asset strategist at Invesco. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Thursday, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
I think you've got to stay with the U.S. and, lean into that economic strength that we're seeing. It will hurt a little bit of the translation from a revenue standpoint. However, and especially the multinationals that have done so well. However, we still think that the U.S. has a lot of room to grow over the long term. And a lot of the companies that make up the public markets and public stocks are, primed for additional growth despite whatever the dollar does.
Yoko Yoshioka of the Wealth Enhancement Group speaking to Alex and me within the last hour takes us back to our question of the day. How do you deal with this strong dollar that has got stronger today as a result of that sensational print we saw on the ISM services data? Georgina Taylor, head of fundamental multi-asset strategy at Invesco, joins us now to discuss. Georgina, nice to see you. It strikes me that the dollar is just a symptom of the fact that the US economy looks great and the rest of the world doesn't. Is it as simple as that?
I think to a certain extent it is. I mean, we always talk about the dollar smile. So is it about growth, which exactly as you allude, the US is doing better than everywhere else, so that's the growth element. But there's also the interest rate differential, part of that story as well, that's still very supportive of the dollar. But also you want the dollar when things are rolling over a little bit, and there's a little suggestion that places around the world are just starting to crack. So are the defensive qualities of the dollar kicking in slightly as well? So you've got kind of both sides of the smile starting to support the dollar, perhaps.
Georgina, how much of it can I also look at in terms of positioning? Like, there's one school of thought that if you look at, say, futures positioning, there's a lot more to add, but then hedge funds are short, so maybe they're covering. Like, I'm wondering how much of that is coming into play rather than making such a broader economic deal about it.
So in terms of the dollar more broadly, I mean, I think the big moves have been with the yen and China, which you've absolutely been referencing today, but the moves haven't been as big necessarily versus other currencies. So I think we do have to differentiate slightly. And from our perspective, the dollar isn't necessarily crowded. I think if you speak to people, everyone has been in the dollar and everyone has been positioned perhaps that way. But I think there's a difference between what people are saying they're doing and have done versus, how far that positioning has gone in aggregate. So to us, there's still an opportunity in the dollar, to be honest. And as I say, let's differentiate between whether this is about those Asian currencies or whether it is purely about the dollar in terms of driving those currency pairs.
The dollar's done well. Of course I've been in it. Of course that's been my position. Yes. That's always the case. European equities look really cheap right now. Is that the next kind of logical progression from this? The US economy looks good, Europe doesn't. Sell Europe, buy the United States.
I don't think it's as easy as that. And the reason for that is that, look, there is a valuation case for Europe over the US, but also let's be mindful of how the US market has become a bit of a duration play. And I think at the moment there is a bit of a risk that we are interpreting, the US where rates are continuing to go up. So let's be careful, because some of those cash flow stories that have driven the US market get choked by, a higher interest rate environment for longer. And even in other parts of the world, this, rates may be peaking out doesn't necessarily mean that rates are coming down immediately. And I think that's what we have to be careful of, that nuance right now in terms of what's driving some of these moves in markets and where we go from here.
We were talking in the last segment that if the ECB doesn't hike next week, that the question then becomes, when do you cut? There is a narrative that the UK and the ECB are going to have to cut before the Fed. Do you play that in the equity market?
Yeah, I think if you put the economics and lay out the economics, that is absolutely supported by the economics. But again, I think from our standpoint, don't misinterpret peak rates with rates coming down. So I think we may have to wait a while, even for the ECB and the Bank of England, because let's not forget, they have had to work incredibly hard to get interest rates to where they are right now. And I think behaviourally, as investors, we mustn't continue to anchor ourselves in a lower rate environment, just thinking, well, we've suffered the pain of higher rates, the playbook kicks back in of low rates, policy support. That may not happen for a while because they don't have the luxury necessarily of being able to do that immediately. So I think where you look is to say, well, look, it might not be, the consumer could still feel a bit of pain for a while. And that's been the story in terms of the consumer. Maybe we have to stimulate growth in other ways, not by loosening policy. So maybe we have to look towards investment and where do we get self-sustaining growth coming through rather than just another policy-fueled move in terms of supporting growth.
Okay, so you bring up a really interesting point about the bond market. A lot of people are saying you want to buy bonds at the moment. Now, there's a difference of opinion as to whether or not you want to buy the front end because rates are going to roll up, because central banks are going to roll over, they are going to be cutting, or whether you buy duration. Do I want to own bonds at the moment for the high yield, or do I want to own bonds at the moment because you're going to see capital appreciation as ultimately you see central banks cutting?
I think at the moment you maybe lock in some of that high yield, but I don't think you get the capital move just yet. And I think that's because this higher for longer. And look, the Bank of England have alluded to this just in the last 24 hours, that maybe we have this tabletop kind of approach in terms of policy and you don't get rates coming down. So I think, look, if you can close your eyes for the next few months, then yeah, I think fixed income is obviously looking much better value. I think the move further out is yet to come, so you've got to wait a little while for that to happen.
To kind of circle back to where we began in terms of the dollar and the aftermath of a weaker yen and weaker yuan, where does that filter out, you think? Like, do they have to sell treasuries? Do they sell other currencies? Like, what's going to be the knock-on effect of that if the dollar just continues to grind its way higher?
I think you'll see what we've seen the intervention anyway, in terms of verbal intervention. I think, yes, there is always the Treasury market in terms of a tool that they can access. But I think, again, it will probably be trying different things as they move forward in terms of, say, firstly, that verbal intervention, secondly, providing some kind of stability and some backstop. Again, the problem is, particularly for areas like China, they want to allow the market to be free-flowing, and there is a lot of confidence that has to be instilled in the market, particularly in terms of their currency and investments. So there is a balancing act that everyone is striking right now in terms of fighting this move in the dollar. So I think it might be a more gradual response than something that will be far more definite for markets to really grab hold of.
Georgina, great to see you. Thanks for stopping by to see us. I have to say that I think Hugh Pill, Alex, may have stolen that tabletop from us. Table Mountain, referencing it. We had that much earlier. It's the Table Mountain versus the Matterhorn, I think it was. I can't remember which mountain we selected in Europe.
It was.
We were there first.
We were. Yeah, we did this last week, dude. You were gone. We talked about the mountains.
I was in Greece.
We had the graphics. We were like, look at the mountains, look at the Matterhorn, and then look at the tabletop. We did the whole thing. Because Hugh Pill said
I'm not gonna say that Hugh Pill watches and may have got his idea from here, but I'm gonna say that maybe that could be the case. Anyway, it's nice to see you, Georgina. Thank you very much. This is Bloomberg.
Names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
Story that we're watching. So the European luxury sector, as Guy was pointing out, is seeing some softness today. You got the chair of Richemont. This is the why. The Swiss owner of brands like Cartier, Montblanc, Net-a-Porter said that inflation is starting to hit high-end consumers. Johann Rupert told shareholders at the annual meeting in Geneva that even well-heeled consumers are scaling back. Doesn't help that demand started to sputter in the U.S. and China earlier this summer. And Guy, those are really taking down some other luxury names like LVMH. Like, I don't shop at Cartier, but I like to shop at Net-a-Porter, and I told you I am 100% on a budget. See? Proof.
This is the Alex Steele effect, basically, we're talking about here. But I think the real shock here is that everybody expected this group to be insulated from the inflation impact. And what he's saying is that's not the case. And what he's also saying is that 10 years of excess, and I think what he's basically talking about here is the QE era, is going to take a long time to unwind. So this isn't just a short hit. This is going to be something that takes a long time to roll over. And the European luxury sector's taken this really badly, Alex, today. So the names are down, like LVMH is down really hard, Hermes is down really hard, Richemont, of course, is trading down really hard as well. But he talks about the fact that 10 years of excess has only just started to be unwound. That's a grim story.
But on the flip side, you have to wonder, too, the higher rates are good for those exact individuals because now they get to make more money on their money and take less risk versus lower end consumer where it just hurts, whether it comes to car loans or mortgage rates, etc. So you have to wonder if that dents the effect overall at some point.
I'm sure that is the case, but he is saying that even the well-heeled are now having to spend more on essentials. Now, define an essential, I suspect it's different for those two groups, but he's saying that even the basics for these groups are costing more, and as a result of which they have less disposable income. Or maybe they think they have less disposable income. Anyway, what they are doing is spending less on luxury. And he says that process has only just started. And that is something that I think a lot of people didn't expect. They thought this group was going to be insulated, and he is saying they're not. And that's a shock, I think. It certainly had an impact. The luxury stocks are down pretty hard on that. It's interesting to see what else is taking a hit here as well. Yesterday, we talked about what is happening with the auto sector. Today, we get an upgrade appropriately within that space. So here's the luxury names: Richemont, LVMH, Hermes, all tracking lower today. In terms of the car sector, let's move on. I'll show you Stellantis. It is actually looking like it's having a better day today. It's only up by 0.2%, but remember the market is down. You've got a BNP Exane outperform rating, 22 euros. That stock is rising. That's quite a decent amount of upside to that stock. But it's interesting. The sell side is positive on the car sector. The market isn't. Anyway, there's also a bunch of 52-week lows out there. That's what they look like. Orsted is the interesting one there, down by 3.46. That's a new low. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Kara Masser and Tim Stanovec bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
It's actually turning out to be quite an interesting day here in Europe. We are down, but there's some really interesting stories developing. The French luxury sector is one of them. The comments from Richemont, I think, have ripped through that sector and ripped through that sector really hard today. We've just been talking about them. You've got what is happening with the Polish Central Bank. That's another story that I think is feeding through into the narrative. Governor Bailey in the UK talking about the fact that they are near the peak at the Bank of England. When do the cuts come? The data at the moment are not looking good out of Europe, in stark contrast to what we're seeing out of the United States. So I think there's some really interesting narratives beginning to develop as we come through at the beginning of September the 6th. Europe intraday, look at that, done absolutely nothing. But the index is not telling you the story. You're down by 0.6%. We're trading at 454. So just a little kind of move lower, but not really much action throughout the day. In terms of the single stocks, NatWest has got a new chairman. I think that's interesting. You've got Richemont down today by 6%. The new chairman's new job is definitely going to be to find a new CEO. And then Daimler Trucks up by 0.2%. A new battery plants that they are going to be building in partnership in the United States. Just again, speaking to the impact of the IRA, speaking to the impact, I think, of US policy and the IRA and various other factors that are supporting the US economy, in stark contrast, as I say, to what we're seeing here in Europe. So I think some fascinating stories. Tomorrow, we continue with the German data. The German data today on the industrial front was not good. Do we see that again tomorrow? Europe feels like it's kind of rolling over right now in a way that the US just isn't. We'll talk about that in a moment. Italian retail sales. Alex Steele is going to have no impact on this data. She definitely had an impact on the data earlier on this year. I basically, so here's my theory, Alex, that basically what we now need to see is a really strong dollar so that US tourists, aka Alex Steele, can return once again to Europe and spend money. I think that's got to be what we can hope for here in Europe.
It's possible. I mean, we've all been calling for the demise of travel for the last year and a half. It hasn't happened. We're looking for it to not happen this next summer, but maybe we're all wrong. I mean, I don't know. I'll let you know when I book my flight.
Okay, super strong dollar. That would be great news. Then the American tourists can continue. The story with the American tourists this summer, you talk to hoteliers, you talk to restaurateurs, you talk to all those kinds of people around Europe, has been massive. And it's going to be interesting to see how that shows up in the inflation data and how it continues. BOE decision panel out tomorrow, plus an awful lot of ECB speak. I think tomorrow, is the final day before the blackout period. And then we're going to be into the run into that central bank decision. Are we going to see another rate decision? Another hike from the ECB? Are we going to see another one from the Bank of England? When do the cuts start to be priced? Very different story, Alex, to what we're seeing over in the United States.
Yeah, I mean, here in the United States, we're having a 60% chance now, priced in the swap market, of a hike in November. Let's get more on this. We're in the ECB speak over the next couple days. Pooja Kumra, a senior European rates strategist at TD Bank. What happens if the dollar keeps going higher, the Fed still has to be hawkish, and the ECB just gets stuck?
I think then you are coming to Europe for shopping.
Fair enough.
I think this is one point which even Bailey actually suggested in the press conference right now. The total impact of currency is actually not that much visible in inflation, so I won't be worried from the currency being a key driver. But it's surprising the kind of divergence we are seeing in data. I mean, 2 weeks back, we saw services PMI in Europe as well as UK actually 3 to 4 basis points weaker. But today, ISM in US was pretty much blockbuster number that we were not expecting. So yes, we are actually in the end of the cycle. So we will see no clear signals. I mean, the ISM today was not in line with the kind of payroll number that we saw last Friday, which did see some weakness.
Pooja, isn't there though, let me ask you a fairly straightforward question. Which central bank is going to cut first? Is it going to be the Fed? Is it going to be the Bank of England? Or is it going to be the ECB?
So the thing is, ECB has the option to actually pull the brake at the right time and not overdoing it. And I think that's what saves ECB. So I think if ECB is actually going to cut rate, it's going to be like a lagged effect from Fed. So we actually expect ECB to actually follow in 3 months after when Fed starts cutting rates. And I think that's what markets are also pricing. So I think that's what, just because they haven't reached that much restrictive territory, our real yields are also negative right now. So I think that prevents a bitter move when that actually prevents ECB to actually cut rates before Fed. I think BOE is also a tricky one, but I think at this stage, given what we heard from its testimony, they don't want to go too aggressive when it comes to the rate hike path. So basically, one more and they are done. I think if that's the case, it will be more about staying restrictive. The key risk for UK was always the mortgage market, but I think we are still not seeing many signs of cracks there. If the mortgage market still holds up, I think it will be more of a synchronized cut. I mean, in all cycles, we have actually seen a synchronized move. So I think it's going to be the Fed that is going to lead the way for us.
Does that mean the data is going to roll over quite a bit? Because what I struggle to understand is why the Fed would cut. And if it's normalization, that's very different than we have a recession and weaker growth and we have to cut. I could see the former playing out more with, say, what's happening in Europe.
No, I totally agree that currently we are seeing a lot of weaker data, but I think there's a lot of pessimism already being priced in Europe as well, which is not being priced in US. Like when we started the year, markets were pretty much more worried about the US outlook. I think where we are going to see some changes taking place in Europe is possibly even some stimulus coming in, which was something even suggested by Scholz, German Prime Minister, whether how to actually support the economy. And I think if that's the case, that also it prevents how much we can see in terms of easing from ECB in the coming year as well, if they do provide that fiscal support to domestics.
Pooja, can I ask you a straightforward question about the investment case around bonds right now? Do I want to buy bonds because I'm locking in a high yield, or do I want to buy bonds right now because I'm going to see capital appreciation as we see cuts starting to come through?
You want to buy bonds if you don't have to look at them for the next 2-3 weeks, because the next 2-3 weeks we could see this bearish move continuing, but you're buying bonds because you feel that there is something mispriced in the economy. Markets are not seeing that kind of slowdown, which is visible in all the soft surveys, the banking lending surveys, the consumer surveys. So I think you buy bonds with expectations that we are going to see central banks actually having to actually cut rates just because they are over restrictive in the coming year. But the near term path could be higher, because what we are seeing on a day-to-day basis is that when we get strong data, that's definitely bearish bonds. If we see weak data, markets start playing a soft landing scenario, which means equities outperform bonds again. But I think at this stage, given all what we are seeing in terms of data, there's no clear direct evidence to buy bonds per se, but we are heading towards closer levels. For example, in treasuries, if we are heading towards 430, 440, it's a good buy level right now in the anticipation that you will get a capital appreciation.
Pooja, always great to catch up. Nice to see you. Pooja Kumar, Senior European Rate Strategist, joining us from TD. Okay, European equity markets are done for the day. Off their highs, broadly lower today. The FTSE 100 doing a little bit better. DAX down by 0.2%. It's the CAC 40 that has really been hit hard today. That on the luxury news that has come out of Richemont that has rippled through into names like LVMH. During the auction, little tick higher, but nothing really going on there. What are we going to talk about next? Alex's favorite subject, crude trading near 9-month highs. We're going to look at and see how these prices even are affecting oil services companies. We are going to be speaking to Weatherford International's president and CEO. He's coming up next. Alex is going to continue to clear her throat, but we'll fix that in the break. This is Bloomberg.
They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point! From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
The fact is, natural gas is so much lower priced here in the U.S. and is such a lower carbon fuel that we think natural gas is going to be here for quite some time. We have a lot of room to run in terms of reducing higher carbon content fuels like coal and fuel oil. We've got a lot of ways to go to continue to reduce emissions by using that.
That was Alan Armstrong, Williams CEO and president, speaking to us in the last hour. Let's get another take on the energy industry. You got a bunch of M&A over the last couple days. You also have oil trading around $90 a barrel. So let's get the look from the oil services side. Girish Saligram is Weatherford International president and CEO. Weatherford has had quite a journey, declaring bankruptcy in 2019, then relisting in 2021, cleaned up a lot of its debt, and is now starting on kind of the next phase of its journey. Girish, give me some perspective on the back half of the year. You've upgraded your forecast twice already. What kind of demand do you see and where?
Alex, first of all, thanks so much for having me. It's such a pleasure to be back. We've had a very robust set of demand dynamics, and that's played out over the past couple of years. And as we go into the second half of the year, we continue to see that playing out. We've got a very robust set of demand from the Middle East as well as from Latin America, and that really is what has given us confidence to increase our outlook, along with a lot of the initiatives that we are driving both on the operational front as well as on the commercial front that's driving margin expansion and cash generation.
Girish, good morning. It's Guy. When do you think, therefore, that's going to translate for investors? When are they going to start seeing some of these returns coming back to them? As Alex says, it's been a bumpy journey over the last few years. How close are you to the point where you can start throwing some of this cash back at your investors?
Yeah, hey, Guy, it's a great question. We've been very focused on our balance sheet and making sure that our balance sheet is resilient, it's stable on a through-cycle basis. And so debt has been our primary focus of capital allocation after we have invested back into technology and CapEx for the company. Now, the good news is our investors understand that, and the stock price appreciation we've seen, I think, is a reflection of the return that we've been able to generate. Having said that, we take the notion of shareholder returns very seriously seriously. It's something that is a topic of conversation with the board and myself, and we are thinking through it. We hope that by sometime next year, as we have addressed a little bit more of our gross debt, we are in a position to come back and have a meaningful constructive discussion around that.
To your point, your leverage is now pretty much in line with SLB and Baker. So then how do you think your business evolves if oil stays sticky, say just around $80, $90? I know you don't break it out in terms of onshore or offshore, but what about international demand? Like, where is the demand really going to come from, and how quickly does it come back based on the oil price right now?
Yeah, Alex, it's a great point. 80% of our business is international. It's not North America. And so that's really where our leverage is and where we think the story is going to come from and the resiliency and the growth is going to come from. So spearheaded by the Middle East, Latin America is very strong. We are seeing resurgence in sub-Saharan Africa, in Asia, as well as in Europe. So all of these factors and all of these geographies, we think will contribute to that demand. We also think that our differentiation in products and technology is something that will give us a lot more leverage and allow us to continue on the path that we have been on for the last couple of years.
Girish, how does an oil services company navigate the energy transition? Do you just become a services company? Take the oil out, what's left?
First of all, it's about energy services. It's not just oil. So I think it starts with us taking a much harder look and making an improvement on our own operations. So we're very proud of the fact that we've just released our second sustainability report this year. We are reducing our own emissions and driving that. We're also improving what we do for our customers in terms of automation, remote operations, greater technology to reduce that. But we're also making significant steps and forays into multiple different platforms. So, for example, geothermal. We've been a leader in this space for over 20 years and have continued to develop new technology and partnerships that will allow us to make an even greater contribution and impact from this segment. Plug-in abandonment, which is still sort of oil and gas to a certain extent, but it's really an important part of the transition as the world moves to different sources of fuel. So that's an area we're putting a lot of emphasis on. Carbon capture and sequestration is a third area, and then solutions mining is a fourth. And our hope is that we continue to add platforms like these over the next couple of years to make a more meaningful part of our business and portfolio.
I mean, you're setting me up for the M&A question. Do you do this organically, or you do this through acquisitions? And how quickly do you pull the trigger on those things?
Yeah, I think it's a little bit of both. We can't say it's a one or the other approach. We are developing a lot of the technologies today organically, partly because M&A has really not been a factor for us, given our history and given some of our challenges, given Weatherford's checkered past on acquisitions. So we've been a bit wary. But I think now that we are back, our turnaround is more or less complete. We're looking at the future in a very different lens with growth as the major focal point. I think M&A does become a topic, and there's a lens and a set of criteria that we've established. So if something passes that set, that's something that we look at.
Girish, you've got a global footprint. I got to ask this question. How different is the U.S. economy right now relative to the economy you see in the rest of the world? The data coming out of the U.S. looks sensational. The data out of the rest of the world signals a slowdown.
Yeah, it is very different. I think it's confounded a lot of people. We continue to see a lot of strength in the U.S., especially on the employment side. Labor shortages and hiring people continues to be a big challenge. We don't necessarily see that to the same extent in other parts of the world. But I think one important factor to remember, especially given the sector that we are in, is in a lot of the countries that we operate, oil and gas is a very significant part of the economy and really drives a significant portion of that. So we are continuing to see very robust activity, especially in the Middle East and Latin America, where a huge part of that engine is really driven by energy.
Girish, it's so good to catch up with you. I'm really interested to see sort of the next journey that you guys take. You've solved the debt issue, now sort of how you evolve and how you become. So stay with us. Stay tuned for us on that. Girish Salagram, Weatherford International President and CEO. Thank you so much. Coming up, we're going to get some indication on factors supporting spending, job growth, and gains when the Fed releases its latest beige book. That's coming up in just a few hours. We're going to have more next. This is Bloomberg.
who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Find the biggest names in business. Choose Bloomberg.
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
Stocks trading very heavy. The sort of good news on the ISM services, definitely bad news when it comes to the equity market. Abigail is tracking those moves for us. Abigail?
Yeah, and that's the case for the month of September. We are starting off soft here. This is the NASDAQ 100 over the last 3 days, down 2 of those 3 days, down about 0.9% over that time period. And September, historically, seasonally, is the worst month of the year, averaging over the last 30 years, a decline of about 0.7%. So we're heading that way. There is the S&P 500 down 0.8%. You can see yields really popping on that ISM number that Alex was talking about. Good news is bad news because the Fed will still have to stick around potentially to hike more. The VIX responding a little bit, but still a 14 handle, so nothing too big there. And then the dollar index continues its path of strength. What does this mean for the S&P 500? Well, let's take a look at a chart that we had been looking at over the year. A beautiful uptrend you can see defined by the 50-day moving average. We had been tracking the August downtrend, which was broken, but look how we now have this range coming into motion. The S&P 500 back below that 50-day moving average, looking like it's going to go back to the lows that we've seen over the last couple of months. The fact that we haven't seen a higher high, but we're seeing these equidistant lows, tells you the buyers aren't quite as confident as the sellers. So it's going to be interesting to see this play out as we continue again in this seasonally difficult month of September.
Some really fascinating charts out there at the moment. Abigail, thank you very much indeed. What are we watching for the rest of the day? President Biden delivering remarks in the White House on the labor union deal for port workers. That'll be interesting to hear what he has to say. I wonder whether we'll talk about cars in that as well. Earnings coming through from GameStop. Watch that. And then we get the Beige Book. The Beige Book is going to be released at 2 p.m. New York time. How beige is the Beige Book really going to be this time round? Ira Jersey of Bloomberg Intelligence joins us now. Ira, given the data, how beige can it really be? Beige is usually a symbol of sort of signal of nothing happening here. Things are happening here.
Well, I think it's beige. Keep in mind that the survey weeks and the survey period was actually a couple of weeks ago. And if you think about just the economic data that we received and given the tone of financial markets, I think that it could be very beige, right? It will be very mixed bag. But I think in general, if things pan out the way that we think that they will, it'll probably have somewhat of a positive tone in it. In terms of the consumer, in terms of inflation will still be a worry. But I think that you'll see that most areas of the United States and the country are doing okay, with housing being, a big question mark in some places. And remember, what's really fascinating about the Beige Book and what you use a Beige Book for is that each of the individual Federal Reserve banks conduct their own survey, all the same questions and the like, but you can get the regional breakdown. And the United States is such a huge country that you can have 2 or 3 regions doing really well while the rest of the regions are suffering. So that sometimes informs how those members of the Federal Reserve will vote at the FOMC.
Okay, fair enough. So it's not like as all like green shoots as we thought, but is this really the first time we're going to really get the Barbieheimer and the Taylor Swift economy for the summer? And I'm not actually saying that in jest. I mean, that's been such a huge driver of certain things like entertainment tickets, concert tickets, etc. Do we get a real read on that?
So I didn't go to Taylor Swift, but I have been to 2 sold-out concerts for other mega bands, and I have to say, people are getting out and about, getting their summer colds like I have right now as well, because they're out and about. We will get some of that information, but in a way, these are some seasonals that we just haven't had for a few years because of COVID. If you go back to 2017, 18, 19, you had a lot of summer blockbuster tours and things like that. So in a way, I think that this is just going back to kind of a quote unquote more normal environment where you have people, spending money during the summer months, going to concerts, going to the beaches and taking vacations. So I think all of that will maybe be better than 2021 and 2022, but not necessarily, absolute gangbusters.
Come on, Ira, give which bands, which ones are we talking about? We need to know.
So I went to go see Metallica and then another heavy metal band. Yeah. And Metallica at MetLife Stadium was sold out, 83,000 people.
Wow.
It was absolutely amazing. It was their first stop. Well, you probably saw them first, Guy, because they did their European tour before they came over here.
Guy's super hip.
It was amazing.
He's super hip. I think we all knew that. Ira, thanks a lot. We really appreciate it. Ira Jersey of Bloomberg Intelligence. No concerts for me, but I have seen Barbie twice. I'm just saying, Oppenheimer's on my list too. All right, quick check in here. Just on the markets again, we're down by about 1 full percentage point for the NASDAQ 100. Utilities kind of eking out a gain here within the S&P, but that stronger dollar, higher yields, really shifting flows there in the market. Looking forward to that beige book. Wraps up for me and Guy. Coming up, Microsoft Gaming CEO and Bethesda Game Studios Executive Director joins Bloomberg Technology. This is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, the FTC, it gears up to sue Amazon this month after a 4-year antitrust investigation into the company. We'll bring you all the details.
Plus, after years in development, Microsoft's highly anticipated Starfield hits the marketplace to some rave reviews. We discuss with the heads of Bethesda Game Studios and Microsoft Gaming.
And the US is seeking more details into Huawei's made-in-China chip as they start to wonder about the effectiveness of US curbs on the country's vast technology sector. But let's dig into these markets first and foremost as we look at what is, again, a macro picture, Ed. Overall, we are seeing ISM services, the data, the macro picture of health here in the United States, whereas it is lackluster over in Europe and over in China. And what does that mean? Well, we actually see rates rise here in the US. We see the dollar rise in particular, up 0.2%. And as we start to see a question of whether the Fed has to go further in terms of interest rate hikes to cool down the inflationary pressure here in the US, that, of course, means further sell-off in the NASDAQ. We're off by more than 1.1%. The two-year yield, as we see, crescendoing up some 6 basis points. We're above that 5% level, so notable in the minds of many at this moment. And we're also looking at what's happening in the Bloomberg Dollar Index, as I said, up 0.2%. What does that mean for the rest of the risk assets out there? Well, we know that Japan, China, they start to talk up, really trying to fight back on preserving their own currencies. What does it mean for crypto? Well, we're seeing actually, of course, continued pressure from the US dollar vis-a-vis Bitcoin. We're now at 25,578. Is this more risk aversion that's playing in? Is it a strong dollar? But we're off by 0.5%. But dig into some of the micro that's dragging down the NASDAQ.
Yeah, Carrie, these are the biggest points movers to the downside on the NASDAQ 100. Clearly, that hot ISM print is impacting equities at the single name level, but there's news flow as well. Overnight, the Wall Street Journal reporting that China's central government is telling specific agencies, some agencies is the language they use, to get their people to move away from using foreign handsets to domestic handsets with particular focus on Apple's iPhone. We will discuss that later in the show, along with what's happening with Huawei, Tesla and Nvidia, also big drags on the index at the index level on the NASDAQ 100. Two other big names that we're watching at the mega cap level. Well, the first is Microsoft. As you heard later in the show, we will speak to Microsoft's gaming chief and the head of Bethesda Studios. Starfield available today. So many of you have reached out to Kara and I with your thoughts on the title. We'll dig into that. But we also had the gatekeepers list out of the EU, which has some relevance to all of these mega cap names. Then Amazon, down 1%. As you know, Caroline, according to our sources, the FTC will finally act later this month with that suit.
Yeah, as soon as September. That's, of course, what's currently being reported by our own people on the ground. And we know that the company has been trying to, well, win the ear of regulators, but it's failed thus far to really offer what has been a substantive reason as to why its marketplace in particular hasn't been deemed, well, overall, some sort of competitive threat at the moment. So we're going to be digging into all of these lack of concessions thus far, it seems, with Bloomberg's Leah Nyland. Leah, what is it that Amazon really has failed to show to the FTC?
Yeah, the FTC has been looking at Amazon now for 4 years, and it has a lot of concerns about the way that it has organized its marketplace. In order to get the Prime badge, which you know is the one that most people buy, it's the one that when you go into the website and click on the buy box, that's the one right there. In order to get that, you have to use Amazon's logistics service, and the FTC is concerned that that unfairly ties access to the marketplace to using these other services that Amazon buys. Now, Amazon has tried to assuage some of the concerns about that, such as by opening up this new program called Prime Sellers, so that you could do your own logistics by using like UPS or FedEx, but that doesn't seem to have resolved any concerns by the FTC.
Leah, we know that in mid-August, representatives from Amazon met with the 3 commissioners of the FTC. We talked so much about it with you on this program. But what we didn't really learn was, are there any concessions or anything, Caro talked about that Amazon tried to do to avert this from happening, or was it always just going to happen?
Yeah, what we've heard about that meeting, it took place in mid-August. They had a video chat with all of the commissioners and sort of laid out what they think are their defenses to these things. There were no settlement talks at that meeting. So the FTC wasn't particularly interested in hearing about a settlement, which Amazon had offered a settlement to resolve these sort of concerns in both Europe and the UK. But here in the US, the FTC was not particularly interested. So that was sort of the last step before a suit is filed, and we're hearing that it will probably come sometime later this month.
And just give us the context, remind us, and if you've forgotten, of course, Lina Khan, many who expected this was likely to come. It's the big
to the trends in the ETF industry, and we start with cash. Overall, cash-like funds, of course, this is ultra-short duration funds. They took in nearly $2 billion in August. That is the biggest monthly haul going back to February. You can see that cash kind of came out of favor over the summer, but it's back now as we head into the final quarter of this year. So cash is hot. So too are Indian equities, at least if you judge by this ETF. EPI is the ticker. It led EM inflows last week. Of course, this is an ETF tracking Indian equities. You can see that those inflows really starting to build. Of course, too, as China falls out of favor, that's putting a bit of a shine on India. Let's also talk about one of the biggest stories in both the crypto and the ETF industries right now. That is Grayscale's legal victory over the SEC. We spoke with VettaFi financial futurist Dave Natick last week about what the process could look like from here.
I think most folks are thinking that we're going to have some sort of common clock restart, and we'll be looking at something like the first quarter of next year before we get an actual approval. And at that point, I do think it's a horse race, and I do think cost matters.
All right, let's talk more about this issue. I read the stories from the beach in Valencia, but I couldn't think about anything else.
No.
I mean,
certainly not your vacation.
No, well, it was less of a vacation and more of a babysitting week. But James Seifert of Bloomberg Intelligence joins us now to talk about this. You know, one more disappointment for regulators and one more victory for crypto. Is this going to change a lot? Because I saw an incredibly muted reaction in prices.
Yeah, so, I mean, based on what Dave said, I agree with like 90% of what he said. I think Q1 is possible and even likely. Eric and I are very much on the record. We think it's going to happen before the end of 2024. But I'll throw out an earlier date. I think mid-October we could see approvals from the SEC here. Not guaranteed, but it's kind of likely in my book.
Does approval mean launches? What does the timeline look like?
So the timeline is hard to know. I mean, Grayscale wrote a letter yesterday, and they basically were saying, hey, SEC, give us a call. Like, what do we do next? Let's have a meeting. Let's figure this out. So even Grayscale doesn't know what's happening. I don't think the SEC knows exactly what they're going to do next, or if they do, they haven't made it publicly available for us to know what's going to happen. So timeline, not really sure. Theoretically, even if they approve in October, they could say we want to wait till this date. I do agree fully with Dave on the common clock theory. I don't think the SEC is going to give this to one issuer, one person, and going to say, here, go ahead, have at it. You have the only spot Bitcoin ETF for a few days or a week. I think they're going to launch either all of them or allow all of them or allow at least multiple to launch on the same day.
Here's what Grayscale's CEO, Michael Sonnenschein, had to say about this lowering fees as well, which is a huge issue.
We are committed to lowering fees when GBTC converts to an ETF. We'll obviously have to come back on and talk to you about what the fees are when that conversion actually happens.
And I know because I was reading Katie and Vildana's amazing coverage.
Thank you.
Vildana Heinrich writing a lot of those stories with you. They get like 2% right now, and they've got to cut that to like, what, 30, 40 basis points?
Yeah, I mean, who knows exactly where they're going to go, but we think 50 bips is likely at least. Like, it's going to have to go down that low. Look, Grayscale's raked in billions, if not billions, hundreds of millions of dollars over the years, right? So they've done just fine. But what they've done, what they've used that money for is they used the money to fight the SEC in court. A lot of people said it was frivolous, they were going to lose. They won. Now we're sitting here trying to figure out what happens next. I think it's about time. It's always been their plan to cut fees when they launched an ETF. They told me that in 2017 when we were talking about trying to do this in 2020. They've been saying they're going to cut fees as soon as they can get an ETF. So we'll see when it happens, and I would expect them to cut fees, and it's going to be a race to the bottom. Everyone's going to have to try and differentiate, market themselves as better than the others. I don't think there's really a need for 8 or 9 or 11 spot Bitcoin ETFs in the U.S. marketplace.
And you think about that race to the bottom, of course, they're up against, BlackRock, Invesco issuers who are very comfortable fighting fee wars. But
you pointed out somebody has an S&P tracker that is like 2 basis points.
Oh, yeah.
Right?
I believe that's State Street, right? So,
Yeah.
we're talking about virtually zero at that point. So we'll see how far this goes. But when it comes to this horse race, the common clock idea, of course, we talk about all the time how the first mover advantage is really important in ETFs. Is it as important
Bitcoin ETF race when you think about the fact that Grayscale already has billions of dollars of assets?
Look, there's also this theory out there. One, I do think it's as important because if one other issuer gets to come out, they're an ETF and they come in a way lower cost than GBTC. One, I think it'll siphon money away from other products around the world and products in the US. And two, like there's just no way to know exactly where the money's going to go. A lot of people think like GBTC is going to see this mass exodus of capital. I do think there's going to be some outflows, but for the most part, people aren't going to sell. They have tax burdens if they decide to sell this thing. They'll end up benefiting from it converting. And if GBTC does what it says it's going to do and lower the fees, there's just not as much demand to sell. So while I do think there is going to be a lot of money coming out of GBTC, and there's no way to know what that impact will have on Bitcoin itself, I do think this idea that GBTC is going to go down and only have like a couple $1 million in it is just ridiculous. I think maybe 20% of the assets might come out and go somewhere else, but I don't think we're going to see 50, 75% of the assets leave Grayscale.
All right, well, we're all going to have a very fun fall. We're going to be talking with you a lot. That is James Seyffert of Bloomberg Intelligence.
And tomorrow, remember, they've got a webinar.
They do have a webinar.
Eric,
I did hear about that.
Balchunas and James Seyffert, they have a virtual event. Eventually, they're going to start a weekly vlog.
I look forward to that. Yeah, if you could just live stream all the time, that would be great. But in any case, stick with us because still ahead on this show, we're going to look ahead at launches and closures in this market with Amrita Nanda Kumar. She is president of Biden. That conversation up next. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Slice through the noise.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Bloomberg ETF IQ. I'm Matt Miller alongside Katie Greifeld.
Eric Balchunas from Bloomberg Intelligence back with us now for today's drill down. But Eric, it's a little bit different today.
It is, Katie, right? So instead of looking at one ETF, we're going to take it and zoom out and look at all the launches and closures over the past 5 years. So this is launches to closures. You can see where that gap normally exists, right? Got a little close here, right? Naturally, after COVID. Then it really widened out as about 400 ETFs launched last year. But then closures kind of ramped up a little bit, although now they're on their way down. And you can see launches are coming back as the equity markets have rallied. Also, one fun fact here, Katie, for you. These ETF launches over 5 years represent half of all ETFs on the market. So half of new ETFs are under 5 years old. That tells you how young the market is still because all the flows come here. Also, interesting, of the launches this year, this is also a shocker, 70% of them have been active. That is crazy considering active makes up 5% of the assets. But they also are having a renaissance, and a lot of managers have been waiting on the sidelines with their active strategies. Now they're jumping in because they see success. Only 30% passive because it is tough to compete with BlackRock and Vanguard over here. This is where the action is going forward, Katie. Look for more active ETF launches.
Eric, thank you. Joining us now to discuss all of this is Amrita Nandakumar. She is president of Bund Asset Management. That is an ETF sub-advisor. And I want to dig into basically everything Eric said. So let's start at the top. When you think about launches, they've definitely cooled off this year. And when you think about the market environment that we're in, how difficult is it to bring a new ETF to market right now versus what we saw maybe over the last 3 years?
Well, first of all, Matt, Katie, Eric, glad to be back. Thanks for having me. You know, the truth is 2022 was a challenging year for asset managers, right? And we see some of the aftershocks of those challenges continue, whether it's ETF investors or ETF sponsors. In this case, a slowdown in launch activity, as you pointed out, as everyone's trying to recover and see what's coming next. But as a firm that partners with ETF issuers looking to bring their ETFs to life, we are seeing this cautious optimism. At the same time, we're also seeing a willingness to cut losses a little bit more quickly and redirect those efforts towards funds that are working or funds that issuers think should be working. So I think in this environment, again, it's expensive to launch an ETF to begin with, but you really need to make sure that you're bringing something differentiated to market, as well as really identifying who your core investor base is going to be early on, and maybe even before you launch, so then those early days of launch, your fund is trading, you're building volume and liquidity, and you're gaining interest from market makers.
Does it have to be active? I mean, Eric showed the huge slice of the pie of launches that are active. Maybe it's because we talk about active ETFs on this program every week, but
correlation.
But you can't earn any money on passive anyway when you're competing against people that have 2 basis points fees. So does it have to be active?
I don't think it has to be active, but I think you pointed out and Eric pointed out earlier, the willingness to compete with the so-called big 3, it's just not there anymore, right? As it is, the margins on ETFs tend to be lower than mutual funds or SMAs or other top types of products. And then to come out with an index that's truly differentiated at this point in the game is much easier, is much harder than actually we see in real life. And so active managers are coming out and saying, well, my strategy is differentiated. I might even have a captive investor base. And so let me put my special sauce or my secret formula out there and see what I can do in terms of asset
This is an anti-woke ETF, and I've got a whole bunch of Trump voters ready to buy it. And
so there's certainly a pool of asset issuers that I think would agree with that sentiment.
I was just thinking of one.
There's one, one that I think the news came out today about Strive, right?
Yeah, and let's talk about that, because you're saying anti-woke, probably not going to make it long-term. Strive has $1 billion. That's a big feat for an indie issuer in the past year. They did have some big investors lined up. But whether anti-woke or ESG, I think you have the same challenge. How do you dislodge Vanguard and cheap beta from the core? So I think they're 2 sides of the same coin with the same struggles. What say you?
I think that's right. I mean, I think investors have spoken time and time again, right? We've all heard the phrase, people vote with their wallets, but I'm not sure that's necessarily the case when it comes to ETFs, right? Whether you have these ETFs that track the political holdings or the holdings of members of Congress, Nancy Cruz, or K-pop or psychedelics, all of these fads, I don't think investors see these as serious portfolio allocations, right? If an investor is very passionate about a cause or about a politician, they'll direct their efforts and direct their funds accordingly, but they're not going to do it in an ETF. So at Vidant, we're a platform that allows investors to express their investment views, but when it comes to these very specific, I wouldn't even call them themes, but really hot sauce, we tend to be skeptical.
So I think that's your whole portfolio, right? K-pop and psychedelics.
Yeah. Sounds like a good weekend.
BTS. Anyway, thank you so much for coming in. Amrita Nandakumar of Vidant talking to us about launches. Programming note that next week we are back to our normal time, 1 p.m. Eastern on Monday. And if you can't get enough of ETFs, reminder you can listen to Eric and Joel Weber's podcast, Trillions. It's bi-weekly, covering the industry. That does it for Bloomberg ETF IQ. I'm Matt Miller alongside Katie Greifeld and Eric Balchunas. And he has, with James Seyfert, a webinar tomorrow on spot Bitcoin ETFs. Definitely go to Bloomberg Intelligence and catch that. This is Bloomberg.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, the big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
I'm John Oliver. Welcome to Bloomberg Markets.
And I'm Matt Miller. Let's get a quick check on the markets right now. We are down 1% on the S&P 500 at 44.53 right now. The level off almost 44 points. The 10-year yield continues to rise. So another 2 basis points today as investors sell that debt. Right now, the level at 428.16. The Bloomberg Dollar Index also continuing to gain ground. So a continuation of the trends that we saw yesterday at this time. The Bloomberg Dollar Index trading up at 1255, 1256, and NYMEX crude rising, Brent up as well. Right now, WTI, John, at $87.61 a barrel.
Well, it's interesting to see that move in crude, and yet in the equity market, Matt, you've seen a bit of cautiousness with stocks, even energy stocks, because of that new economic data in the United States, suggesting maybe the Fed stays higher for longer. But the central bank story getting attention here in Canada as well, because we saw Canada's central bank hold rates steady at 5%. Now, they were already at the highest level in 22 years. This decision was expected, but it is only the third time in 13 meetings that the bank has hit the pause button. And part of that is because we saw the economy contract in the second quarter. The Bank of Canada itself was not expecting that, and it spoke about excess demand in the economy starting to ease. And yet, in some of their messaging, there is still a hawkish tilt, given that the inflation fight is not over. I want to bring in Claire Fan from the RBC Economics team to get some reaction to the messaging here from the Bank of Canada today. Claire, great to have you with us. What did you make of the fact that, on the one hand, they stay steady on rates, but they do send to the market a hawkish message? Did that surprise you?
I mean, not really. Well, first of all, let's start with the decision itself.
Sure.
With the Bank of Canada obviously deciding to hold rates steady at 5%, I think what we want to call it at this point is a hopeful pause. So the Bank of Canada here is really hoping that they've done enough, with 475 basis point cumulative worth of rate hike that we've seen to date. So I think the question that they're asking now is really, we're starting to see weakening data, especially in labor markets, and the GDP data last Friday as well. I'm sure we're all aware. So are those foreshadowing a broader slowdown that we've all been anticipating as sort of a fall off for the rate hikes that we've seen today? Or is this a repeat of 6 months ago, when GDP just bounces right back up? So I think ultimately that's the question, and that's what prompted the pause today. But like you said, the statement was sounding a lot more hawkish, so that's down to them ultimately wanting to leave the options on the table. They want to leave the door open. So if they were to move rates higher again in October, given maybe more persistent than expected inflation reports or data, they could.
Yeah, and they've got to navigate the fact that we're next to the United States, which there's the possibility that the Fed continues on that rate hiking path. We'll see how that plays out. Claire, maybe identify for our global audience the differences in household debt between the U.S. and Canada. We have a shorter duration mortgage market in this country, so you have a lot of people who have already felt that impact of all these higher interest rates.
Yeah, that's definitely right. So the typical mortgage term is obviously a lot shorter, which is similar to situation in the UK. Very different from the US, where mortgages are typically way longer, 30 years. So that does allow, like you said, a lot faster pass through. Although it's still been kind of slow. GDP contracted in Q2, which is, a full year after the start of the Bank of Canada's first rate hike back in 2022. So if you look at the delinquency data as well, we're starting to see higher delinquency in market-wide auto and credit card loans. So we are starting to see signs of households, getting squeezed with heavier debt burden, with rates staying at currently high levels. So that's just one of the key differences. And in terms of the outlook for the third quarter, StatCan's prelim estimate for July did point to a flattish profile for the month. So to be honest, that leaves the start of the quarter to a weaker or a softer start. So whether it can really bounce back to match the Bank of Canada's forecast of 1.5% annualized increase in GDP is a huge question mark. And if it can't, that leaves us tracking a lot below what the Bank of Canada last forecasted.
Claire, how long is the transmission from monetary policy changes to the effect on the economy? It's been a debate lately. Here in the U.S., Jan Hatzius says he doesn't think that long and variable lags are very long anymore. On the other hand, so many people have fixed 30-year mortgages here and have moved away from the arms of, the great financial crisis and previous, that people have argued those lags are going to be even longer. What's it like in Canada, and what's your view on the U.S.?
Yeah, so that's a great question, and it does, play a lot into the differences between just how indebted households are. I mean, post the great financial crisis, the U.S. actually had a larger deleveraging cycle. It means that debt to income in the U.S. generally is lower than what we're facing here in Canada. So it comes to not only, the speed of how fast monetary policy can really start to flow through to impact household decisions and slow aggregate demand, it also comes down to the sensitivity. Because with a larger debt, you are by definition more sensitive to the same 25 basis point worth of rate hike, let's say. So that's obviously one of the key differences as well. And in terms of the leg, this point I think is really, surprised a lot of us in terms of just how resilient, broadly speaking, households have been, and that's true for both Canada as well as the United States. Obviously, we both know that there's an incredibly large amount of excess savings that the households have accumulated over the course of the pandemic, and that's helped insulating them in a lot of cases, through a lot of the interest rate and high inflation shocks to their finances. But in Canada, things are starting to look a bit softer. We have the unemployment rate again rising by as much as 0.5 percentage point within the span of 3 months. So previously, we have not had that without a recession. So that is just sort of giving the context of how economic conditions are starting to look like in Canada, and where it could trend ultimately. Again, back to the Bank of Canada, is it weak enough or deteriorated enough for inflation to slow back to target. I think ultimately that's the answer that we're all waiting for more data releases to find an answer to.
And then to go beyond Matt's question about the lag on interest rate impacts, I think worldwide markets have been wondering, once you start to see those impacts from higher rates, is there an entry point for central banks to at least lower rates even slightly? And that conversation is starting to gain momentum in Canada simply because, we talked about that contraction for the economy in the second quarter. You mentioned, who knows, if you see a bounce back in the economy, if the inflation story is not fully resolved. Would you be surprised, though, if the Bank of Canada going into next year were to decide, look, things are weakening enough, we actually have to send a message that we're going to lower interest rates here?
That is a great question. And I think at this point is not part of their concern. It's definitely a bit premature for them to think about cuts at this point because, again, the key question that they're trying to answer now is, have we done enough? That's the only question. And once they deem that broader macro condition will slow enough for inflation to persistently drop, not headline inflation, core inflation more so, excluding some of the energy, oil price shocks that the Bank of Canada also mentioned in the statement today that could be pushing inflation higher in the near term still. So will core inflation really come down to 2%? And once they have an answer to that question, maybe together, what really drives that slowdown in inflation, what underpinned that forecast is the slowing in demand. And that's what we're starting to see. And that's also in large part what made them pause today is that, maybe the slowdown in demand will be enough to push inflation down. Once they get a yes to that question, then we can have more of a discussion as to, where do rates move on from there.
Claire, great having you on the program. Thank you so much for joining us. Claire Fan there, economist at RBC, talking to us about the Bank of Canada and a little bit about the Fed as well and the two economies. Coming up, Dan Ives joins the show to talk about artificial intelligence ahead of the C3 AI earnings release. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important to your strategy for the bank. Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Thursday, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
This is Bloomberg Markets. I'm John Oakman with Matt Miller. Time now for our stock of the hour. AI hype's going to get tested after the bell today when C3 reports results. Now, the company has been a pure play on the AI excitement. Stock's up in the neighborhood of 180% this year. And now analysts have some pretty big expectations for strong top-line growth, but also signs, Matt, of spending commitments from customers beyond just some of the obviously hype that we've heard throughout these last few months from a lot of AI companies.
Yeah, it'll be interesting to see how companies that used the AI hype to try and drive their stocks actually do when it comes to their earnings. For example, Kroger is going to be coming out with earnings and just a couple of days from now, 2 days from now. And remember, last time when they put out their earnings release, they mentioned AI 8 times. So we'll see if it's actually driven revenue there. Let's bring in Dan Ives right now from Wedbush. He doesn't cover Kroger, but he does cover a lot of the other tech stocks, as well as some of the automakers that hope to cash in on the AI technology. Dan, what do you think about C3 AI, which is, a much smaller company than NVIDIA, trying to use this to cater favor from the market?
Sure. I mean, Matt, you and I have talked about this before. It's really about second, third, fourth derivatives. And I think C3 stands right there as one of the biggest beneficiaries, along with Palantir and some others, is what I view as use cases. Now, I think this is important quarter to show, like you saw NVIDIA to Microsoft to now, are you actually seeing the spending, whether it's financials, utilities, and others? So, look, I think this is just starting. It's a $1 trillion tidal wave on the horizons of the shores of tech.
How bubblicious is it? I mean, I was looking yesterday at a chart of Bitcoin, which, has kept getting excited to $30,000 on ETF hopes and then dropping back down. Eddie Vanderwalt from the MLive team told me he thinks it's because AI is the shiny new thing. And indeed, if you layer NVIDIA over Bitcoin, you see that it just continues to go up and to the right. Is there a little bit of a bubble atmosphere here in AI?
Look, I mean, there could definitely be fakes, right, from the real names. But, I mean, what we saw with the godfather of AI, Jensen and NVIDIA, I mean, that's real numbers that we're seeing. And I could tell you, I've seen it firsthand in Asia, across Europe, what the spending trend looks like. And I think now it comes down to over the next 6, 12, 18 months, I believe it's really the start of what drives a new tech bull market. I think that's really what right now it's about. Fundamentally, it's about the execution stories. If companies don't execute, then obviously they fall by the wayside. But now spending is going to be there.
And as an analyst covering these companies and somebody, to your point, Dan, who sees this as the wave of growth that we in many ways haven't seen since the early days of the internet for the technology sector, if stocks have had a big run, if expectations in the short term for quarterly results are high, and if there are some near term, let's call them messy quarters, how do you as an analyst react to that if you're seeing some huge growth over the longer term?
Yeah, I think that's the conundrum, I think, for investors as well, because if the longer term opportunity is there, you can't just put it in a box and say, what's earnings over the next 3 to 4 quarters, put a PE on it, that's right in the stock's value. I think transformational growth names, I've always viewed them differently, from Tesla and Netflix to Apple and Microsoft. But I think when I look at AI, it's a 1995 moment, not 1999, 2000. I think it's as transformation of the tech trends we've seen in 30 years. But it comes down to execution. That's what we spend all of our time doing, trying to understand who are the real winners versus the fake ones.
And then in terms of parsing it out to different groups, because, you know, AI means different things to different businesses and ultimately to their customer base. Are you doing the same thing? I mean, you're kind of looking at the different tiers of how you would play the AI sector?
Yeah, I mean, it's essentially a basket. I mean, there's the chip ways to play. Of course, NVIDIA, you have, AMD, and I think another big piece of the supply chain. And then there's what I've used the first derivative. It's the Google's, especially what's happening in Redmond, where Microsoft's really winning that hand over fist. And then, of course, you're going to have Amazon, where I think Jazzy and AWS are benefiting. And then you look at the core software names. I think Salesforce benefits, Oracle, then the pure play use case names like Palantir, C3, and others. But look at MongoDB. Look at Snowflake. It just shows the real spending starting to happen.
Dan, we've seen the CES, the tech conference in Vegas, turn into really a car show, and you are a tech analyst, but you've started really looking in the auto industry as that becomes really a tech sector. What's your view on if we avoid a strike or not in Detroit? Because the UAW, United Auto Workers, want 46% increase in pay for an industry that's losing billions of dollars going into EVs.
Yeah, look, it's a nightmare scenario, quite frankly. I mean, I was in Detroit a few weeks ago trying to get a pulse in the 313 area code. And look, everything's riding on EVs for GM, for Ford, Stellantis. And UAW, I mean, this is going to be a Game of Thrones battle. You get past September 14th, strike happens, it starts to push some of those plans. And that's the worry here, especially with Tesla, Rivian, of course, 100 other OEMs going after EV. Now, I hope that this is barks worse than bite, because this is a pivotal year for Bar and GM as well as Farley and Ford.
Everybody seems to want to cash in on the high-end customer, with the Hummers and the Escalade IQ. Is anybody going to make money on the affordable EV?
Well, it's really about battery cost. I mean, if you look, that's why I think next year Tesla comes out with a sub 30K vehicle, because battery costs coming down significantly, it's scale and scope. And even though some of these automakers will lose money in the near term, over the long term, I mean, this is an EV green tidal wave playing out. It's the biggest transformation to auto industry since Model T. So I think that's the way that Detroit's playing it. That's the way you're seeing it in Europe as well as in China, because it's the wave of the future.
Dan, great to get your perspective on both the EV transition and, of course, the AI story as well. Dan Ives from Wedbush joining us, and we'll keep an eye on those C3 results later. Coming up, more signs the IPO drought is coming to an end as the company that makes Wilson tennis rackets and Salomon ski gear reportedly files to go public. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg Markets. I'm John Ehrlichman with Matt Miller. Amer Sports, the maker of Wilson tennis rackets and Salomon ski boots, has filed confidentially for a U.S. IPO. Could ultimately value the group at as much as $10 billion. I want to bring in Bloomberg's Katie Roof, who helps to cover the IPO market for Bloomberg, for some more context. And Katie, kind of an interesting development, which you've been tracking pretty closely at a time when we've been more closely, arguably, watching some big potential tech IPOs.
Sure, yeah. So, the window is open, so to speak, or at least a lot of companies are hoping it is, following ARM, Instacart, and Klaviyo, which are all expected to go this month. We have a bunch of others, and now Amer Sports that are looking to go in the ensuing months. They have filed confidentially for an IPO, one of the major steps towards going public, and we're hearing that they want to go public hopefully by early next year.
So is there a peg for this? Like, is there a reason that they want to go public? I walked into a bar last night and I saw a pickleball game up on the screen. I know they make rackets for that, but their tennis game has been around forever. There's less snow these days, so we can't ski quite as much. What's the deal?
Well, it looks like their owner, Anta, which is a Chinese owner, they bought the company for about $5 billion in 2019. It looks like they're expecting that they can make a return here. We're hearing that the company could be worth about $10 billion. Obviously, that depends on market conditions, but it would be a quick buck for them, just a few years later after they bought it. Obviously, as you mentioned, pickleball is hot, but they have so many different categories of sports equipment. They have Wilson, with tennis and basketballs. They have a lot of ski brands like Atomic and Salomon. They have Arc'teryx, which is like a Patagonia competitor. It's such a long list, and clearly they feel that their business is doing well enough that they're willing to brave the somewhat weak IPO window, but we're going to see how the companies do in the coming weeks.
Yeah, well, you mentioned a brand there that's well known in Canada and beyond. Wilson, by the way, there is a Canadian in Chip Wilson. Some people might remember his rise to fame with Lululemon. He became a stakeholder in this business, and part of the plan, I believe, was to really shed more light on these brands. Katie, when you're covering the IPO market, how much does the potential audience or appetite depend on which brands we're talking about, especially you got a stable here?
Sure. So people will say that the best companies can go public in any environment, but the reality is bankers get a little spooked when they see a lot of IPOs not doing well, and so it's hard to even get bankers to sign up and do a roadshow for companies. And so right now, they're willing to do that. They're trying out the market for a few in September. A lot of the others, we reported Rubrik the other day, they also want to go public this fall, but a lot of it is dependent on how these first companies do, whether the IPO window is truly open, so to speak. It's a little bit up in the air.
All right, Katie, thanks very much. Katie Roof there covers IPOs for us for Bloomberg West. I mean, really for all of Bloomberg, but she's based out on the West Coast, which is helpful in the tech industry. We're seeing, John, a drop in stocks right now, a little bit of a sell-off in bonds as well on the back of some economic news we got out of the U.S. this morning. Right now, the S&P 500 trading at 44.55. Remember, yesterday at this time, we were at 4,500 even, and we're adding 2.5 basis points to the 10-year yield. Right now, 428.56 is the level there. But I think more interesting is the move up in crude. Even with maybe a pessimistic outlook for the global economy, we still see crude continuing to gain.
Yeah, could end up being 9 days in a row, the longest stretch for energy since 2019. And we've certainly started to see, maybe less so today, but overall some more appetite for energy stocks as well. For Matt Miller, I'm John Ehrlichman. This is Bloomberg.
largest and wealthiest consumer markets in the world. And there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
A surprise in the economic data leads to disappointment in the equity market. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Boston.
And I'm Katie Greifeld, kicking off to the closing bell here in the U.S. We're looking at a down day in markets like Romaine alluded to. We had some pretty hot data coming in the form of ISM services that's really taking the steam out of the equity market. The S&P 500 off by 0.9% right now. Big tech faring even worse. The NASDAQ 100 off by 1.1%. You see that sell-off continuing when you look at the bond market. 10-year Treasury yields currently up about 2 basis points, getting closer and closer to that 430 level. But all the while, you're continuing to see energy continue to rally here. Romaine, crude oil up 1.3%. If that holds, a 9th straight day of gains.
It'll be interesting to see how the price action sorts itself out over the next couple of hours. Remember that the softness that we're seeing right now in the equity space on this Wednesday, partly due to the firmness that we saw in the U.S. services sector in the month that just passed. The Institute for Supply Management released its services index for August, and it caught a lot of folks off guard. 13 services industries reported growth in August, led by real estate and food services. It's an increase in the index of almost 2 points to 54.5, and that topped all estimates in a Bloomberg survey of economists. It adds to a string of stronger than expected reports in everything from consumer spending to residential investment that may now force the Fed to as much as double their prediction for GDP growth in 2023. That's, of course, when they publish those updated outlooks at the meeting later this month. That prospect, supported by that hot ISM report, it's already shifted market bets on the Fed's next move. Swaps contracts showed wagers on the Fed hike now back up for November, rising to a 60% probability, and the policy-sensitive 2-year Treasury yield poked back above 5% here on the day. The data today also nudged the dollar higher once again. Surprise, the Bloomberg Dollar Spot Index, which yesterday posted its biggest one-day gain since mid-March. Today, Katie, came within 3 points of setting a new year-to-date high.
Can't keep a good dollar down, especially when it comes to some of the Asian currencies that it's paired against. You can see the Bloomberg Dollar Index in white here, and then in yellow and blue you have dollar yen and you have dollar yuan. And actually the dollar strength against both of these currencies, as you can see, the dollar trading at a multi-month high against both pairs, prompted some pushback from Asian officials both in China and Japan overnight. We'll see if that makes a dent. As you can see, though, this trend has been well established. Let's talk about what the dollar strength means for the equity market. This is a really interesting chart here. You have the S&P 500 in white, the Bloomberg Dollar Spot Index in blue, and it's a rough relationship, but as you can see, there's a little bit of an inverse correlation there. When the dollar weakens, that tends to be good for the S&P 500, and down here at the bottom, you have the dollar's RSI, its relative strength index. We are approaching overbought territory on the dollar. What that means for the S&P 500, Romaine, remains to be seen.
All right, thanks, Katie. We do want to get to some breaking news, getting the latest release of the Fed Beige Book, the anecdotal evidence from the 12 Federal Reserve districts. The main headline coming out of that report is that job growth was actually, quote, subdued across the U.S. in that survey period. The labor market imbalances, though, did persist, but hiring did slow. We're also learning that most of the districts did report to the Fed that price growth still slowed overall, though they did note that property insurance costs did rise sharply. We're going to dive a little bit deeper into that report and get you some more details, backward looking to be sure, but certainly a gauge on sentiment out there as we set ourselves up for a consequential Fed meeting within the next couple of weeks. Pleased to say that David Kelly, the Chief Global Strategist over at JP Morgan Asset Management, joins us right now here in Studio 2 in our headquarters in New York. David, great to have you here.
Very glad to be here.
Let's start, before we get to some of the other topics here, let's start with the Fed Beige Book, and more importantly, just some of the sentiment that we've seen contained in that report, and I guess how much you think it's in sync with the communication that we've been getting out of the Fed so far.
Well, it's called beige for a reason, because it's usually just a very much a consensus read of the economic data that's actually hitting the wires during the month. It's not like, I mean, it would be nice to think that all these Fed districts were leaving the office and carefully surveying the subway shop and the taxi drivers to find out what's going on, but they don't. They look at the big numbers. And so what we're seeing are two things really going on at the same time. We are seeing a slowdown in job growth momentum, but we're also seeing subdued inflation. And you know, I think looking at markets today, there's all this fear that, you know, with higher oil prices and the ISM services number looking high, that somehow we're going to have this big bounce in growth and inflation is not going to go away. It's going to go away. I mean, this is a I wouldn't call it a dead cat bounce, but it's an old cat bounce, and this cat's going to have less bounce in it going forward. And I think that the Fed would be very unwise to raise rates again just because of a short-term spike in enthusiasm in the service sector.
Well, the flip side of that, okay, let's say we do sort of buy into this idea that inflation is going away. What does that mean just in generally for economic growth? Is that going to be coupled with an economic slowdown or even a recession?
It may not be. I mean, that's really the whole surprise of this year is last year the Federal Reserve said they were going to be really aggressive at slowing down economic growth in order to kill inflation. Well, guess what? Inflation's dying, but they didn't manage to slow down economic growth. And it really tells you that a lot of the relationships that they've relied on over the years don't really work, and they are in somewhat uncharted territory here. I think there's still a window for a soft landing, but I think they should be very aware of the fact that there is a squeeze play going on consumers. You've now got these higher oil prices, higher gasoline prices. You've got a resumption of student loans. People are having to deal with these higher mortgage rates. And they're gradually pushing up their credit card balances, but there's a limit to that. So you're going to see consumer spending slow down going forward. All the numbers are not that strong, and the Fed would be very unwise to push it one more rate hike higher, because this thing works with a lag. We could be in some trouble next year.
So moving beyond the conversation of whether they move rates higher one more time or two more times or maybe not at all, how long would you expect them to be on hold? Because even though, like you said, they shouldn't base that decision off of one ISM services print, you do have oil coming back, like you said, and you still have a very robust consumer.
The real question is the labor market, because if you look at the 3-month moving average of payroll jobs, it's been coming down and down and down. If you gave a 6-year-old a crayon and asked them to continue that line, it's going to go negative sometime early next year at that rate. And at some stage, we're going to see one negative payroll report. We may see 2 negative payroll reports. The moment we see 2 negative payroll reports, all bets are off, because the Fed will realize, oops, I guess we did push the economy into recession. Sorry about that. But then they're going to have to just change their tune entirely. So I don't think it's really a matter of inflation being persistent. I think inflation is going to come down anyway, but I think the thing that's going to move them off the dime is if they really get scared that maybe they've overdone it.
Well, when that crayon line does extend into negative territory, of course, every Fed chair has some issue when it comes to communication, but when we start to get negative payrolls prints, and you think about the different audiences that Jerome Powell has to speak to, how difficult of a communication challenge will that be?
Very, because they always get it wrong. What they'll do is they'll give you a small dose of rate cuts and say, well, the economy is seeing a little bit of weakness here, but we have the tools to fix it all. But we're going to cut rates a little bit today. Oh, by the way, we may cut rates a little bit more down the road. Now, if you tell me that the Fed's just cut rates and they may cut rates down the road, are you going to borrow money today? No, you're going to wait.
Of course not.
Yeah.
Everybody's going to wait and see. It'll freeze the entire economy. The most dangerous time for the economy is when the Federal Reserve puts in a little bit of a rate cut and says there's more coming. So it's very dangerous at that point.
Well, that gets to the idea too. And by the way, I just say before we go any further, I listened to the podcast they put out. It's probably the most soothing financial podcast out there. I don't know if it's your voice or the music or whatever, but it's always informative, and it's a great start to my week. I am curious though. I mean, on that point that you were just making here, we've seen the recent Treasury sales, and we know there's going to be a huge supply coming down the pike later here. There has been an argument as to whether you embrace whatever it is, 4.5%, 5%, depending on where you are in the curve as an investor, whether you're willing to embrace those yields at face value or whether you wait for something more.
No, I think you should feel comfortable buying in right now, because you're actually getting a decent yield for once. The real, if we're right about inflation over the next year, not backward looking, but going forward, then these are good real yields.
Yeah.
And what's more, at some stage, this thing is going to go wrong. And when it does, you're going to get a one-time rally. So it's like you're going to get this bonus down the road at some stage. It's not going to be huge. It's not like a roaring equity market. But I think you're getting good income from fixed income right now, with a high probability that you're going to get a capital gain at some stage in the next year or two.
What is the correlations, though, right now, when you look at, say, what's going on with treasuries and the dollar? I guess you can throw commodities in there, and then overlay that with what we're seeing in the equity market, or maybe what we're not seeing in the equity market.
I think the correlations are very confused right now. I mean, one of the issues, of course, is that it used to be the oil prices and the dollar would have this inverse relationship, but of course we are now a net producer of oil, or close to net neutral, so it's not even clear what that relationship should be anymore. So that's one of the confusing points. And then, of course, we've gone through this period where treasuries didn't protect you as the equity market was getting shellacked by higher inflation. We may have a little bit more of that, but I'm pretty convinced that as inflation comes down, that negative correlation is going to reassert itself. So I think we are transitioning back to a more normal relationship, at least between fixed income and equities. And by the way, that's another reason to have fixed income in a portfolio. It can, I think, going forward, provide you the protection that it's clearly not given you over the last 2 years.
I want to talk more about the dollar. You mentioned the confused correlation still between energy and the dollar. And you think about, really, it feels like the dollar turned a corner in mid-July.
Yeah.
What changed? What is driving this current episode of dollar strength?
Well, I think there are two issues. One of them is that Europe is just turning out to be weaker than it should be. I mean, Europe seemed to get through its energy problem. The fear about Ukraine seemed to go away a little bit. And the numbers coming out of Germany and Europe in general just are not that strong. It's not a disaster, but there's no real economic bounce there. So that's one problem. And the second problem is the Japanese at some stage have got to realize that they've got to join the rest of the world with positive real interest rates, and they're not there right now. But European weakness and Japanese dovishness, those things are really supporting the dollar right now.
And when it comes to the dollar, to take this conversation cross-asset and past episodes of dollar strength, you start to hear phrases, the dollar is, a wrecking ball that's going to reverberate around the world. When you think about the potential ripple effects of a consistently stronger dollar here, what does this mean for EM, for other regions of the world?
Well, it's not your grandfather's EM anymore. I think EM has got much more to do with China than with what the dollar does, or even what the Fed does. Now, I think there are problems there. The Chinese keep on rolling out new measures to try to support the property market, to try to support consumers, but they're all small measures, and there's still this feeling that we have that maybe this is like Japan back in the late 1980s, where you've just got this real estate bubble, which in a population that loves to save, so when their biggest asset goes down, they just can't get their consumers to spend.
Yeah.
And I think that's a risk in China. But I don't think that the dollar and EM is going to be as important as China and EM.
All right, David, this was a great conversation. Love to have you back soon. David Kelly there, helping us kick you off to the close, the Chief Global Strategist over at JP Morgan Asset Management. Coming up, a lot of great conversations coming up, including with the incoming co-CEO of Oak Tree Capital, Armen Panosian. We're going to get his thoughts on what's going on in the private capital space, Katie.
Plus, U.S. carriers sounding the alarm about higher jet fuel costs. We're going to get into what this means for your next vacation.
And I know, Katie, you are a member of the ultra-exclusive clubs out there.
Am I?
I don't know. Soho House is looking to expand, and they want you, Katie Greifeld. Whether you're in rural upstate New York or out in Portland, they're broadening out from just New York and London. A lot more coming up here on the program. This is Bloomberg.
person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Thursday, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
Well, the U.S. dollar heading towards an 8th consecutive weekly gain, sending Asian currencies to multi-month lows and prompting authorities to push back with threats of intervention. Japan issuing its strongest warning in weeks, saying that the nation ready to take action amid speculative market moves. Meanwhile, in China, the PBOC escalating its defense with a record yuan daily fixing. Bloomberg's Abigail Doolittle has more, and an 8th consecutive weekly gain for the Bloomberg Dollar Index. Feels like this has kind of been a quiet rally. I didn't realize it was 8 weeks.
Yeah, it's pretty impressive, actually, given the fact that we do have the Bloomberg Dollar Index off of those July lows. And to your point, it has been a quiet rally in a way. You know, the bigger moves I think that we all noticed was off of the September last year, that peak, that decline, that then fueled this year's rally for stocks. And now this quiet rally, I think what it really reflects, and what you were just talking about relative to some of the Asian currencies, is the Fed is in control. I think a lot of people went into that July meeting thinking that the Fed was going to sit down, back down. They have not. They are still in motion. And today, some of the strong data suggests that they are still going to potentially tighten. Many folks thinking that in November they'll tighten. So this is strengthening the dollar. But what makes it so interesting is, so we have the dollar up, let's see, about 5% over the last, 8 weeks or so, which is really an incredible move if you think about it for a currency. But on the year, it's up just slightly. So the weakness that we're seeing for some of these other currencies, it's actually weakness for those currencies, suggesting that maybe there's weakness for those economies as opposed to so much dollar strength.
What I think is interesting, though, too, I mean, we were looking at, obviously, the CFTC data and a lot of other indicators about positioning here. And the kind of the takeaway, it wasn't so much that people really want to buy in the dollar, but it seemed like a lot of folks are just terrified of shorting it any further than they already have right
Well, that's an interesting point, and it reminds me of that old adage, that trading floor adage, buy the best block or buy the best house on a bad block. And right now, everybody's still nervous that maybe there's going to be some sort of a global economy or a global recession. When you think about China, somebody that I know who invests exclusively in China real estate, he's over there right now. He said it's so much worse than you can imagine, and that the Chinese government doesn't know what to happen. And he said the property market's not even the problem; it's the broader economy. If that spills over into the U.S. right now, he's saying it's exclusive to the hedge funds that are invested in some of those real estate, but that could really be a problem. I mean, that's the world's second largest economy. So I think that people are piling into the haven dollar. What's so interesting is, though, the yen on the year, I think it's down like 12%. I mean, it's down a crazy amount. So it doesn't all add up, but you have the Aussie and you have the Kiwi down, those growth currencies down. So overall, it's a haven picture. The yen, that central bank's not on board.
But it gets to also the point, I mean, I think David kind of hit at this, the differential between yields here in the U.S. and the rest of the world. I mean, even if you just look at German bunds, I mean, we're still, what are we, like something like 2 percentage point difference or something around there. And I mean, with
That's
Japan,
a great point.
And with Japan, we're like at 5 percentage
Yeah,
point
it feels like it's both a story about growth differentials, yield differentials, and also that haven bid. Just really quickly, Abigail, what does this mean for the U.S. equity market?
You know, I think that we're seeing it today. I mean, we're off session lows, but right now we're down about 0.9% on the S&P 500. The NASDAQ down more, down 1%. And we had the worst month. We almost had the worst month in the month of August as the dollar had that stealth rally. You know, simply you're taking money out of the system. Risk assets are going to react.
All right, Abigail, really appreciate the roundup on King Dollar, our own Abigail Doolittle. Now, coming up on the close, Southwest United and Alaska Air all cautioning of a rise in fuel prices this quarter. More on how the industry can navigate those high expenses. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
The unexpectedly high cost of jet fuel this quarter has some U.S. airlines warning of potential turbulence in expenses. George Ferguson joining us right now. He's Bloomberg Intelligence's senior airline analyst. He's out in our Princeton, New Jersey bureau. And George, let's start off here with the main headline, which is about fuel prices here. Why were these airlines, taken, off guard by it?
Sorry, getting caught off guard with it, you said?
Yeah, with the rise in fuel prices.
Well, I don't think they were so much caught off guard, but I think that, we all kind of went away for the summer, especially August, and we were focused on other things, and fuel prices just kept moving higher. I think consensus hadn't adjusted, and I think some of the airline executives got back after Labor Day and went, you know what? We need to make sure people understand that the consensus numbers for the airlines are wrong, and at this price of fuel, it's not going to be as good a third quarter as many expect. And look, there were a couple that have adjusted things today with announcements and 8Ks, but we expect all of the airlines will have to adjust.
Yeah, and to your point, maybe a re-rating of expectations there, maybe trying to set the bar lower. When it comes to these higher costs that they're dealing with on fuel, how much pricing power do they have left to cushion that, if you will?
Yeah, so we don't think a lot, right? So what we've been seeing is domestic fares have been nosing over. A couple weeks ago, we saw a CPI print that showed U.S. domestic fares were on the fall. And so, what we've seen is that the lower cost airlines that cater to budget flyers, they were already not going to have a very good third quarter. And the full service United, American, Delta looked like they were going to get a good third quarter, largely on their international flying. Now, I think a lot of those ticket prices are already baked in because if you're going to Europe, right, you buy it a couple of months out. But generally, it looks to us like, supply demand is starting to favor maybe, supply, there's just too much of it, and that fares are edging over. We were at super high fares, so it's really hard to see the airlines being able to come back and get the consumer to pay even more, especially again as we go into the shoulder months. We're going to get Q4 and Q1, where typically business travel would pick up for leisure. Business isn't back in the way it was in 2019, and so that's just another challenge here. We don't see a lot of pricing power.
Well, I am curious, do you think, George, we could see a return of kind of the fare wars that were really sort of dominant for so many years in the airline industry?
I'm smiling because I think absolutely, right? It's an industry that, look, if you own an airplane, you want to fly your capacity, right? You really resist putting it down. Airplanes cost a lot of money. And so even if the economy gets soft, and again, we think there's some of those lower end travelers that are having challenges, with their personal accounts, right? The inflation has taken a bite out of it. So if you don't knock down some capacity with less demand, you start getting soft pricing, and we think that's exactly what we're heading into.
And George, when we think about the two largest expenses for airlines, it tends to be fuel and it tends to be labor. We know that fuel costs are going up. What's the situation with labor right now when it comes to these airlines?
Not good, right? So all these airlines, the major ones, have just signed deals with their pilot unions. A lot of them have given 18 to 20% initial raises, owe them another 5 or 6% at the end of this year, and then we'll do 4 for the next 2 years. If inflation tamps down a bit, those could be raises that are a little bit above inflation, but the challenge here is those pay raises are already baked in for American, United, for Delta, for JetBlue. Southwest is still out there negotiating, but it'd be hard to see them get away without a major increase for labor. The airlines, I think, here have a bit of a double whammy: higher fuel prices, higher labor costs, and probably soft pricing.
All right, George, going to have to leave it there. George Ferguson of Bloomberg Intelligence, and to George's point, too, about the types of airlines really affected by this. You look at some of the big movers here: Hawaiian down 5%, JetBlue down 5%, Southwest down 3%, Allegiant down 2%. But meanwhile, American, United still kind of holding the line here. We go back to the broader markets here as we kick you off to the closing bells. Right across the screen here, Katie Greifeld with the NASDAQ, the big decliner on the day, down more than 1%.
And you take a look at the bond market, because that sell-off continuing, more so in the front end. That 2-year Treasury yield up by 7 basis points, selling off to a greater degree than the 10-year. You add that together, and that 2s10s curve is continuing to invert.
We look at some of those correlations, particularly when it comes to FX, when it comes to treasuries, when it comes to commodities, and of course the outsized effects that it's having on equities. We'll be back in a moment. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
This is Bloomberg Markets to close, a down day for equities, a down day for treasuries. The 2:30 here in New York. Let's get a quick check on what's going on with commodities. Our commodities close, and Abigail Doolittle.
So it's interesting, Romaine. We do have the Bloomberg Commodity Index down, but it's down slightly relative to stocks. These risk assets overall are not underperforming in the same way that stocks are. We're largely helped out by crude oil, up about 1% or so on the day. And of course, we've had this crude oil rally over the last couple of weeks. And today we do, of course, have OPEC's de facto leader raising prices for all grades by 20 cents, seeming to give a little bit of a bid here. Wheat up 1.7%. This as Putin refuses to revive the Black Sea grain deal that would allow Ukrainian wheat to go through the Black Sea. This could, of course, constrain supply, a bit of an opposite of what we've seen over the last few weeks. Let's see whether or not it lasts. Now, to the downside, we do have European natural gas down about 10%. This, of course, has to do with the LNG strike, potential strike in Australia by Chevron workers at 2 different plants being delayed by at least 1 day, giving investors hope that maybe, well, it depends on what side of that trade you're on, because some investors not doing so well right now, but thinking that supply, about 5% of supply, won't come off the market. And then finally, copper, Dr. Copper, a tell on the global economy. Well, Romaine, it's down 1.5%.
All right, our thanks there to Abigail Doolittle. A look at what's going on in the commodity space. Meanwhile, we want to turn to the private markets because activity in the private capital space is expected to accelerate over the next few months. In the second quarter alone, 34 new private credit funds were able to raise about $71 billion. That's more than double what the industry saw in the first quarter. It's an industry, of course, that has come so far, so fast, from niche player to kingmaker, in an area previously ruled by those big Wall Street banks. But as that industry matures, a new crop of leaders are stepping up to write the next chapter. Armin Panosian oversees the performing credit business at distressed debt pioneer Oaktree Capital. And starting next year, he will take the reins as co-CEO of the entire $179 billion business. Pleased to say Armin joins us right now here in our New York studios. Armin, great to have you here.
Good to be here.
Let's talk a little bit about, I guess, what type of activity we're seeing in the private debt space right now as we sit.
I would characterize it in 2 forms currently. Stepping in where the banks stepped away. The investment banks as well as the regional banks have stepped away from the market and providing capital to private equity sponsors and companies that need that capital that historically found it at the banks now are provided by private capital. And secondarily, we're beginning to see some stress in the market and the need for more creative rescue financing or opportunistic capital.
I am curious. I mean, Oaktree obviously, of course, made its name by sort of, I guess, coming in where people were sort of leaving, sort of filling that void, if you will. But when you're finding opportunities out there left by the banks, whether regional or big, is the quality still there?
The quality is quite strong, and I would say in some respects it's even better than it had been even 2 or 3 years ago. And the reason for that is that because the cost of borrowing is so high, the firms and sponsors that are buying these businesses are really focusing on the least cyclical businesses, the highest quality companies that they would buy in anticipation of a potential recession in 2024.
Well, can we get specific there? When you think about this pullback that we're seeing from the banks who would traditionally provide lending to those types of companies, what kind of industries, what kind of sectors and companies are you actually seeing opportunity in right now?
It's a variety of sectors. We are seeing a lot of activity in software, large software companies with a diversified end market exposure. We are seeing industrials, which generally speaking have hundreds, if not thousands, of customers, and a more regular maintenance and repair aspect to their revenue base rather than capital expenditures. Really looking for businesses that have a more depressed reaction to GDP movements.
And of course, Romain walked us through some of the size and scope, some of the magnitude of activity that we're seeing in the private credit space. And it's interesting when you compare that to private equity, because it seems like fundraising has slowed it down a bit in that space. Private credit appears to be immune. How much is that a function of what we saw in March and these banks pulling back?
Yeah, I think investors recognize that private credit offers some of the best risk-adjusted returns in the credit markets today, and especially relative to the past. And so we are seeing fund flows into private credit and a decline in interest in private equity at the moment, because there is concern around the velocity of return of capital from private equity funds to those LPs. I think that they're right. Borrowing or investing from our perspective in the double digits, in the low teens on a first lien basis to companies that are quite large and supported by very large checks from name brand private equity firms is a very attractive place to invest currently.
When we talk about just the growth in this industry, we know that at least for certain players in the industry, that's maybe led them I guess maybe to make some bets, or maybe somewhat ill-advised, at least in hindsight. I am curious, as we sort of enter this period where these opportunities started to crop up, how much room did Oaktree have to be able to make new investments?
Oaktree does have a considerable amount of dry powder across all of our strategies. And we have been patient over the course of the last several years when the markets were a little bit more open than we thought was appropriate. And we saw capital structures in 2018 or 19 reflective of an easy money environment. We found less opportunity at that point in time and preferred to go after less efficient areas of investing. But today, with the dislocation that we're seeing in the core of the private credit market, we are leaning in heavily into that space because it is dislocated.
Compared to previous sort of down economic cycles or down business cycles, I should say here, do you think the competition amongst asset managers and investors is greater now than what it was in the past?
It's certainly greater today than it was during the global financial crisis. Private credit as an asset class was only $250 billion prior to the global financial crisis. Today, it's $1.5 trillion. There certainly aren't more competitors. And as a result, there's a varying degree of issues and capabilities across that competitor base. But I think one thing is definitely true of the asset class overall, is that it has benefited from a pro-cyclical rise that has resulted in maybe some excessive risk-taking.
Well, on the point on competitors, of course, Oaktree, I believe Brookfield Asset Management owns about 60%. When you think about the competitive field, what benefits does that give you in terms of being attached to one of the largest players?
It gives us an insight into the asset classes where they have developed very deep sector expertise. They're one of the largest participants in renewables, infrastructure, real estate, and private equity. And we see a lot of benefit from being part of the organization because they're able to provide us both technical and fundamental information about the markets that they participate in.
And so we've talked about opportunities that you're seeing. What are you hearing from clients? What kind of demand are you seeing for different types of strategies?
Private credit is at the top of the list. I would say related but separate is asset-backed finance, where, again, thematically, it's the same basis or the same root, which is banks are stepping away from consumer lending, certain types of corporate lending, and there is a need for structured finance or structured credit that fills that gap. And the investor base switches from banks being the provider of that capital to retail or insurance or pension type of clients providing that capital.
This obviously is a function of regulation, or at least speculation of increased regulation, I should say. Is there any worry that the increase in regulation that we might see placed on some of the traditional banking system, that could eventually come into your world, given just how big it's gotten?
The regulators certainly have the ability to step in and regulate parts of the private credit markets. I think that how diffuse the private credit market is does not lend itself very easily to systematic regulation that can impact it. We are prepared. Oaktree is prepared to handle regulation if need be, but I wouldn't expect a tremendous amount of regulation in that space, as capital is needed by that borrower base.
Are you trying to raise capital right now, Oaktree?
We are. We are raising a fund targeting large sponsor-led private credit, targeting a $10 billion fundraise to support that opportunity set as it is dislocated and very attractive from a risk adjusted.
How has that been going? How has it been received?
It's been going well. There certainly is a denominator effect and a lack of liquidity in the market amongst limited partners who have seen a slowdown in private equity returns of capital to them. So the interest in the asset class is very high. The flows for Oaktree are reasonably high, but I would say, generally speaking, raising private assets is more challenging today than it was a year or two ago.
Just real quickly on that point, though, when we talk about the denominator effect and with that, are we talking about allocation limits? I mean, is it that the potential clients are already kind of up against whatever they can allocate to?
Yes. When the public markets sold off, and that was more acute earlier in the year, when the public markets had sold off, their allocation to private markets looked too high. And now that the public markets have rebounded, the denominator effect is becoming less of an issue, but the liquidity remains an issue.
Gotcha.
Liquidity remains an issue. And let's situate this conversation in the macroeconomic environment, because it seems like most of Wall Street, most of the investors that I talk to are pretty married to this higher for longer narrative. And we've heard pretty much the same from the Federal Reserve. When you look at your world of leveraged finance, of distressed debt, are you starting to see that filter through?
We are starting to see it filter through. I would expect rates to stay higher for longer as well, because even with or without a recession, there is going to be an elevated default experience. I think that the need for private capital is going to be quite high, and we are seeing the beginnings of the need for gap capital to help refinance maturities that are starting to become topical next year and the year after.
When it comes to defaults, we are starting to see some of that pick up, but we're still at historically low levels. And if you think about what is going to push defaults from here, do you see it more coming from a recessionary type environment or just from higher interest rates? What's the bigger risk?
I think for now it's higher interest rates, and higher interest rates can tip us into a recession. But the immediate impact is really in the tails of the portfolio, or the direct lending or just credit market portfolios out there, where the most aggressive 20 or 30% of capital structures put in place over the last 5 years are becoming challenged now, because they were expected to grow into their capital structures with growth in revenue, growth in EBITDA, and that just hasn't played through.
Is there a difference that you're finding in terms of what's already out there on the market, in the secondary market, between actual loans themselves versus debt issues, bonds?
Absolutely.
Yeah.
There is a divergence in performance. The bond market, the high yield bond market in particular, is the highest quality it's been in 10 years. Meanwhile, the loan market is the lowest quality it's been in 10 years.
Why?
Because the loan market was the preferred financing tool for private equity sponsors doing new LBOs over the course of the last 10 years, because they were floating rate, and at the time floating rates were low, and because loans do not have call protection generally. Whereas bonds do have call protection. If you were to refinance a bond, there would be a meaningful premium that would need to be paid out. As a result, only strategic or companies seeking capital for strategic needs finance themselves in the bond market, and therefore today we find that total debt to EBITDA of the average high yield bond issuer is lower than the first lien debt to EBITDA of the average loan issuer.
And Armin, when we spoke back in June, you were on Real Yield. We spent a lot of time talking about commercial real estate, and I feel like it's kind of dropped out of the zeitgeist in the past few months. But when it comes to commercial real estate, are you seeing opportunities there?
I think the commercial real estate opportunity for now is really focused on office space, and I think that the stress and distress in that opportunity set is only worsening. I don't think right now is the depth of the opportunity, but I do think it's coming. Oaktree as a firm does lean towards dislocation, and at some point I think real estate it will become a buy again. It's just not at the moment.
And overall, just Armin, final question here. You're relatively encouraged about economic conditions right now, at least from an investor perspective?
I'm relatively encouraged about economic conditions. I don't think that if we do have a recession, I don't think it'll be a deep recession. I was investing during the global financial crisis. This is nowhere near the level of the global financial crisis. However, I do think that that same level of comfort with the economic conditions results in the factors that would influence a higher for longer environment. There's no need to reduce rates, and therefore we will see defaults as a result of just high rates, even if a recession does not occur.
All right, Armen, I really appreciate you coming in and taking time for us. A great conversation here with Armen Panossian. He's Managing Director and Head of Performing Credit over at Oaktree, and starting in the first quarter, he will be the co-CEO of that firm. Stick with us. A lot more great conversations coming up right here on Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
All right, time now for our top calls. Some of the big movers on the back of analyst recommendations, and we start off with Chewy. Argus lifting the retailer to buy from hold. The company saying despite the high valuations of the company, the auto ship features as well as sales of non-discretionary items should actually help to improve some of the fundamentals. Nevertheless, Chewy shares unchanged here on the day. Next up, let's take a look at Block. UBS warning of a potential slowdown in profit growth for the company, downgrading the payments company to neutral from buy. Some factors leading to slower growth include easing consumer discretionary spending and a decline in monthly active users on Block's Cash App service. Shares down about 0.9% on the day. And finally, let's take a look at Olin. This is a big chemicals company. Think sort of water purification and epoxies being cut to neutral from buy over at Goldman Sachs. Some concerns out there about the manufacturer's pricing margin and business strategies, especially in the wake of the departure of the CEO. Shares of Olin down about 1% on the day. And those are some of our top calls. Stick with us. A lot more coverage coming up right here on Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Welcome back to Bloomberg Markets to Close. It's time now for our Wall Street Week daily segment. The host of Wall Street Week, David Weston, joining us as he does every day at this time. And David, of course, a lot of talk right now about economic conditions and, more importantly, the reaction function to it.
Yeah, exactly. And particularly in China. What's going on in China? Every single day we hear about something in China. What does that mean for Europe? What does it mean for the United States? So for some answers to those kinds of questions, we asked Stephanie Flanders, our very own Bloomberg Senior Executive Editor for Economics.
What has been the dominant narrative of the last few years, which is overlaying that slower picture, is the problem in the real estate market. The driver of Chinese economic growth to a large degree over the last 10 years has been the property sector, more and more money pouring into it, and of course more and more houses needed as China developed, became more industrialized, more urban. But way too much property was built. Debts have gone up way too high, and the policymakers have been trying to take the air out of that for some years, trying to do it in a way that they don't completely upend the economy, and that's been the ongoing challenge. And of course, it has produced this kind of drip feed of news about as one developer goes bust, another one question marks about whether or not they're going to make their bond payments. It's pretty hard to have a slow motion property crisis that doesn't turn into a full-on financial crisis for the whole economy.
Well, as you say, Stephanie, on the one hand, they want to take some of the air out. On the other hand, they don't want to do too much damage to the economy. I guess the question is, can they do that at the same time? There's already so much money borrowed against that property market. There's so much leverage in that system. Do they have a problem basically doing some of the big things that apparently the markets want to have done to bail it out? They want a bazooka, so to speak, but if they use a bazooka, they're just going to make the debt situation worse.
Yeah, and this is obviously something we've seen in other places. The problem with debt crisis, and maybe particularly the property crisis, is that the things that you might do to make the situation easier in the short run are only going to give you a longer term problem, further down the road. So if you throw more money at the problem, you allow more borrowing to build up, then that debt issue becomes ever larger. They definitely don't want to do that, although they have been forced to pressure banks to reduce mortgage rates, try and encourage more lending in the sector at the margin. They have cut interest rates, but that's primarily to sort of stop the rot, to stop it infecting the entire Chinese economy and limit the damage to consumer confidence and to spending. But they don't want to just put a floor under this sector, because there is, potentially 3 or 4 more years where you should see prices falling. That's the amount of excess stock that's built up. And, a price is going to have to be paid by developers, by the owners of houses who see the price of their assets fall, and certainly by the banks and state governments that have become rather dependent on these properties. They want to allow that to happen, but without completely tanking the economy. And I guess that's the question in everyone's minds this year, is like, whether can they do that?
Stephanie, I'm not sure that President Xi is inclined to go to school, as it were, on how the West has handled its economies. But we did have, of course, the debt crisis in Europe recently. Before that, the great financial crisis in the United States. Are there lessons that could apply to China that he could learn from if he wanted to? Or is it just a very different situation?
At some level, and you've seen a lot of these as well, David, at some level these crises always come down to the same thing, which is debt. And certainly that's common to all three of those, both, the global financial crisis in the US, the Eurozone crisis, and this current situation. I think there were elements in the Eurozone crisis of what we're seeing in China. If you look at places like Ireland or Spain, where enormous amounts of money had gone into, too much money had gone into real estate, leaving this big pile of property debt. How and when that was going to be socialized, how that debt on the private sector was going to be shifted onto the public sector balance sheet, was the question that we asked during the Eurozone crisis, and how much solidarity was there going to be among Eurozone members. Obviously, that aspect doesn't apply in the case of China, but I would say the sort of corrosive thing in the markets is that lack of certainty about who's going to bail out, where's the bailout going to come from, and is there a willingness to do it?
And it's uncertainty not just for you and me, other observers. There's uncertainty in the markets, and there's uncertainty on the part of the consumers as well. There's some indications that maybe there's something about losing of confidence. I won't say it's lost, but a losing of confidence, basically, in the fundamentals of the Chinese economy internally. How does President Xi recapture that if, in fact, he is in danger of losing some of that confidence?
Well, he's changing the narrative. Remember, it used to be about, or to some extent at least, it was about double-digit growth rates. We've already seen the expectations for growth in China be pushed down over the years, as it becomes a more mature economy, as its workforce peaks. We've had a shrinking workforce for quite a while. We're about to have a shrinking China population. Inevitably, that means a slowing growth trajectory. And I think the authorities have been, and President Xi's been quite good at sort of talking down expectations for long-term growth. But you're right, there is still, the stability and prosperity are the absolute center of the Communist Party's appeal to the country, and its continued sort of right to hold power in China rests on its extraordinary economic success.
That was our own Stephanie Flanders. She is the senior executive editor for economics here at Bloomberg. And I'll just mention one other thing. On Friday at 6 p.m. Eastern Time, we're going to have an extended discussion with Larry Culp on the 5th anniversary of his taking over GE. It's really quite a story of what they've done there.
Yeah, definitely tune in for that on Wall Street week, 6 p.m. Eastern Time from New York. Meanwhile, as we round out into the final hour of trading from our Studio 2 here at Bloomberg World Headquarters, stocks are off the lows of the day, but still deep in the red, and that's largely a function of the numbers that you see at the top of your screen. A 2-year yield back above 5%, the 10-year yield drifting now to 4.3 here, and everyone now looking at the Fed, which meets about 2 weeks from now. We'll be back in a moment. From New York, this is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point!
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
All right, let's get a view from the top here almost an hour ago until we get to the end of the trading day here on this, what is it, a Wednesday afternoon,
Wednesday.
Katie Greifeld? I want you to look into my eyes for 1 second right now, Katie Greifeld, because in all seriousness, we talk about this idea here of sort of what is moving the market, or more importantly, what the market is waiting on. Are they waiting for the Fed in 2 weeks? Are they waiting for something else? Because it's clear whatever they're seeing right now, they're not getting what they think.
That's the thing. I mean, the theme has come about in the past few weeks that we're moving past a Fed-driven market. We know they're going to hike, once more, and then they're going to be on hold for a while. But then again, you get that hot data this morning in the form of ISM services, and we're right back to trading on FedEx. That, okay, they're going to hike one more time sooner than expected.
Absolutely, and you take a look at where the market is right now, down for really for a second day, at least for the S&P and the other major indices. The Russell 2000 down 0.4%, but you look at the NASDAQ 100. Where's that magnificent 7, Katie?
It's retreating today. Instead, it looks like people are going marginally into the dollar, pushing the Bloomberg Dollar Index a little bit higher. We know that that's been one of the big themes, and of course, bonds continuing to sell off.
Well, if you're looking for a bright spot, flip up the board here. How about Chinese property developers, Katie?
Is that a bright spot?
I know you're big. Well, guess what? As a group, they were up 10% here on the day. There's actually a great Bloomberg Intelligence has a great index that tracks the main Chinese builders here. Actually rallied about 9.9% earlier here on the day on expectations here that we will start to see a little bit more help from authorities who are trying to sort of shore up the property sector there. Now, we should point out most of the names in this index, like was the Country Garden and a few others, they're effectively penny stocks. But most of those names were up like 60, 70% just today alone.
And of course, that is, like you said, based on that optimism that we're going to get more from Beijing. We'll see. We've been following the drip feed very closely. Let's talk about some of the U.S.
Do you think Xi Jinping watches this show?
I hope so. I would imagine. What time is it? I don't know. In any case, Apple. This actually is a China story as well. According to reporting from the Wall Street Journal, some Chinese government agencies have barred their staff from using the iPhone and other foreign-branded devices at work. It's unclear how wide these orders have been issued, but still, the stop sound.
Are we making too much of this? Because I feel like, I know that, there are certain facilities here in the U.S. where you can't take an iPhone or any smartphone for that matter, not just an Apple phone, because for things, particularly if you go into certain types of military facilities.
It's true, but then you think about this geopolitical dance that especially Apple's trying to do in diversifying its supply chain, but still obviously depending on China. Shares are down 4%. Let's talk about Dexcom. Quickly, Jeffrey said that GLP-1 obesity drugs appear to increase the uptake of type 2 diabetes continuous glucose monitors. That's citing a Dexcom investor presentation. Shares up almost 7%. Really quickly, Romaine, let's talk about Lockheed Martin. It pushed back the delivery timing of some of its F-35 jets to April 2024 from December.
And that's probably for more testing on those. They've, of course, been dealing with a lot of issues with those. But, of course, we know these planes, they take a long time to get out the door. Has they ever delivered a plane on time? I don't think so. All right, we are moving closer to the closing bell. Just about 1 hour away here. Our cross-platform coverage, counting you down to the close. That coverage starts right now.
Close, Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Tim Stenovic, Simone Foxman in today for Carol Massler. Welcome to our audiences across all of our Bloomberg platforms, television, radio, as well as originals. Tim Stenovic, take a look at the market for me and tell me what you see.
Oh, I see a lot of red. What do you see?
Pretty much the same, Tim. So we're on the same. I just wanted to make sure your Bloomberg terminal was working.
It's working.
Because yesterday it was a little off.
It was a little off. I had to reset some screens, do some commands. I got it all figured out. Don't worry about me. I have a question for you, Romaine.
Oh.
Where is the S&P 500 going to be at the end of the year?
Well, me personally, I don't know. But if you believe Wall Street strategists, it's going to be lower than where it is today.
Do you believe the Wall Street, the sell street, or the sell side rather of strategists, or do you believe, you know, the investment managers, the buy side? Who do you believe?
You know who I believe, Tim Stenovic? I believe in a higher power.
Wow.
I was wondering where you were going with that. Yeah. I got nothing on that for you, but we got a great Bloomberg
and I've been trying to get
story,
that interview,
Simone, that talks all about the different views that the same banks are actually taking when it comes to where they see the S&P 500 going. There's a lot of disagreement within the same houses this year.
Yeah, I mean, most visibly, we're looking at Morgan Stanley, where we have Mike Wilson saying stocks are going to be down by about 10%. But on the investment management side, at Morgan Stanley, Andrew Sliman saying stocks are going to rise as high as S&P rise as high as 5,000.
This year or on a 12-month basis?
I believe by the end of this year.
Yeah. Because, I mean, to your point, I mean, it's like, I don't know. I mean, when you look at the gains on a year-to-date basis, and then you have to ask yourself, I mean, what would materially add to those gains over the next 4 months, or 3 months, I should say, really, over the next 3 months?
I don't have a good answer, but it is kind of
Is something happening that I don't know?
Potentially. I don't know. Ask God. But in any case, I believe theoretically in Tom Brady. Apparently, Delta Airlines does as well. We're going to pivot here because of all the airline news that we're following today, higher jet fuel costs. Delta was also out with a piece of news that they're naming Tom Brady as a strategic advisor, a brand advocate. He's theoretically going to help develop training and, quote, teamwork tools for employees.
For what? Tom Brady?
Yeah, exactly.
Okay. Yeah. I don't know. Do we have time where I could just rant about
we
Tom
do.
Brady?
Absolutely.
I think you have about 90 seconds.
I'm sort of confused by this. I mean, I understand why this is good for Tom Brady because I'm sure he's getting a nice check out of this. I don't quite understand what Delta gets out of this other than, I don't know.
Hey, we're talking about it.
Okay.
That's what they get.
Yeah, but you're going to buy a ticket
question.
because Tom Brady's on board?
Do you think
you know what?
I know where you're going, Romaine.
Put Tom Brady down on the tarmac and get those planes into the gate, get my bag out onto the carousel. Can he do that?
I think
because they seem to be having trouble over there at Delta doing that.
I think you just sketched out the perfect marketing, the perfect ad.
But they need the team. I mean, isn't that the problem with some of the airline issues that we've seen at airports and stuff? It's not having all the team on board and enough people that you need. Maybe he'll help.
Well, maybe Tom Brady will recruit.
Well, that's
Where's
what
Gronk? Maybe Gronk can get out there and grab some bags.
Katie, do you think that the next time you're on a Delta flight, you're going to sit down and Tom Brady's going to be next to you?
I would imagine that he's going to be on the screen, right? The little video that they play beforehand.
Somehow I don't think he's flying commercial.
I don't think so.
So.
You know, we had this same conversation in our show meeting when we were trying to dissect this.
We've been talking about Tom Brady all day long.
It's an ongoing conversation.
I
mean, I'm pretty sure I saw Tim Tebow in the subway once, but frankly, what Tim and I were talking about earlier as well was, the price of airline fares is going down. Maybe you have more opportunities to sit next to Tom Brady because the airline's also looking at a bunch of nasty negative things potentially coming up, higher fuel costs, et cetera.
Oh, that is what I call a perfect tease because we're going to be talking to George Ferguson a little bit later all about the perils that airlines
I saw Aaron Rodgers driving by in an SUV.
Really?
No kidding.
Oh.
Yeah, it was very fast.
Okay. All right. Hey, I know we could talk about this for, the next hour.
We could.
But I'm being told we can't. I'm being told we can't. Don't go anywhere, though, because in less than an hour, we're going to be all back together. We're going to be live on TV, radio, and on YouTube for our Beyond the Bell coverage. We're going to take you through today's market close. We'll see you guys in just a bit.
All right, let's get back to our continuing coverage of what's going on in the markets here on Bloomberg Television. About 50 minutes until we get to these closing bells. Adrian Helfer joining us right now, Chief Investment Officer for Multi-Asset Strategies over at Westwood. Great to have you here on the program today. On an interesting day, too. I mean, we got some economic data this morning that seemed to show, I think, kind of what we've all known for quite some time, which is that the economy is still relatively hot, or maybe just call it warm, but it's certainly warm enough where there are a lot of people think that the Fed might actually have more in the tank.
Well said. I mean, at this point, it's either a soft landing or even a no landing, and that is the narrative. We keep talking about this idea that the Fed is going to, maybe they'll hike one more time. Maybe they do this now thing of rather than hike each time or even hike 50 basis points each time, that they will hike, pause, hike, pause. That's the kind of phase that we're in now, and this gives credence for the Fed to do that. They're observing inflation. They are looking at data dependency. That's exactly what we saw out of the Jackson Hole speech is data dependency, and it was a little bit more hawkish, even if the market appreciated on the back of it. Now we get this data that's ISM services that says, you know what, the economy is still cranking along. The Fed needs to take notice. There are other indicators that are good, but the Fed is probably on that path.
Why do you think the market, though, gets rattled by that at this stage? I mean, if we were still at 0% interest rates, I can understand. But we've gotten 5 percentage points, more than 5 percentage points of rate hikes. Even if the Fed does hike further, we're not getting another 5.25 or whatever on top of that here. Can the market not withstand another quarter point or another half point?
I think it's partly that, I'm prognosticating here that we've seen this great appreciation in 2023, in part because we see the end is coming. It's light at the end of the tunnel. And maybe now we're going, actually, the light at the end of the tunnel is just a little bit further out than we expected. We've already appreciated on the expectation the Fed is going to stop hiking rates. And here we are with elevated data and inflation that is still elevated above what the Fed would like. So until we really get there, the market is kind of concerned that they've moved too early.
When do we move into a post-Fed market? I mean, we were just having the conversation that even with maybe one rate hike left in this cycle, it feels like so much of market sentiment is dictated by the current thinking on what the Fed is going to do on that specific day. When do we move past that?
Probably when we actually get the data dependency that says the Fed is going to stop and they communicate that. And I don't know that that is going to come anytime soon. Even if we hit a pause, that's not a stop. That is the Fed doing what they did at Jackson Hole, which they said directly. They never said cut. And they're not going to, because the Fed's job is to cheerlead the economy. And for them to say they are going to cut rates immediately in the future, well, that wouldn't be their job of cheerleading. That would be saying that there's a problem in the mix. So until they say, okay, we're going to cut rates, that's when we start moving to a new paradigm.
And on the topic of cutting rates, of course, maybe they won't say that, but we are going to get the updated dot plot, I believe, in about 2 weeks' time. So we're going to get their fresh projections. What are you expecting there when you think about what's changed between June and right now?
I think the Fed chairman better go talk to his governors.
Yeah.
Because right now it looks like, the dot plot's saying the long-term dot's around 2.5%. That we're looking at the end of 2024 that is still calling for cuts by the Fed governors, and yet they're communicating that we're going to keep rates elevated until this 2% inflation barrier, with a little bit of an amorphous description of what that is. I think he better talk to his governors and say, the dot plot probably comes up. We really played down this R star, this neutral rate. The longer term is still probably unknown.
I am curious about whether you see any sort of canaries in the coal mine, particularly when it comes to the consumer. I mean, we looked at the services data today, and there was a lot to cheer, certainly, but there are a lot of people, they look at household credit card balances, they look at savings rates and things like that, and they say there's a limit that we're maybe coming up against here.
Well, the savings rate's a good one. Credit card balances as well, and they go in tandem. Because we've had savings rates that were elevated over the course of the COVID crisis. What that meant was we saw supply chain, we saw inability to spend as you're sitting home and maybe you're going on Amazon, but that bike's not going to arrive for 6 months. So your savings rates went up. We had $2 trillion of excess savings that were created over the course of that. And that's come down, and we're just hitting that point where there's no more excess savings. You're dipping into your savings pool in the future is where we're headed. At the same time that credit card rates are way elevated and have spiked recently. Back in 2020, your average credit card rate was around 16%. Now it's 21%. That's a meaningful difference. If your credit card balances are higher, then suddenly you have less savings in the bank. You're not changing your spending pattern. And so you're borrowing on a credit card that's 21% versus 16%. That's a concern.
Well, Adrian, when you put this all together and put it into the markets, where does this leave you on your portfolio allocation? Where do you see the opportunity right now?
Well, the opportunity is still for, we have elevated interest rates. We do like front-end cash flow. We like visibility on cash flow. We like to see actually more value quality orientation. We do see that there's potential for market appreciation from here. And when we look to where we are on PE ratios, we're looking more at median because of that magnificent 7 move, those 7 stocks that have been disoriented from the rest of the market. We do see some potential, but it's less than I see in credit and other areas where I think that there's good yield potential for investors.
All right, Adrian, really enjoyed this. Thanks for your time. That is Adrian Helfert. He is Chief Investment Officer for Multi-Asset Strategies over at Westwood. Now, coming up, we're counting you down to the closing bell with Julian Emanuel. He is Evercore ISI Chief Equity and Quantitative Strategist.
Plus a look at shares of Roku. The shares opened up higher by about 10%, and that was on the back of an announcement that it plans to cut its staffing by 10%.
And the ultra-exclusive members-only club Soho House is looking to expand across the nation with homes everywhere from rural upstate New York to Portland. All that and more coming up. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Thursday, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
All right, it's time now for our Muni moment. Negative headlines plaguing cities like San Francisco, and Muni investors are finding that demand is so robust that it isn't being reflected in spreads. Let's get some insights out of our next guest. Kim Friedrichs joining us right now, Managing Director of Fixed Income over at Kane Anderson Rudnick. And it was interesting, someone put this across my desk here, because we hear all this gloom and doom about San Francisco, and I guess you can throw New York, Chicago, and some other big municipalities in there. But you're saying that, well, maybe municipal investors don't seem to mind that? Why not?
You're just not seeing it. What you're basically seeing is that there's very little supply out there, and there is so much demand right now that we're seeing just, there's $5 billion have gone into muni ETFs just this year. And you're just seeing demand, particularly in high price, high tax states, just pushing demand so high that they're not concerned. So what you see is something like an LA MTA is pricing exactly where it should be, in line with a San Francisco BART, a San Francisco BATA. Everything's just in line. And we're seeing just, tight spreads, and they haven't moved. BART and BATA have both been downgraded due to what's happening in San Francisco, but we're not seeing that moving into spreads at all.
I am curious that when we talk about some of the issues themselves here, are investors sort of parsing the difference in those issues, meaning like something just sort of like a general obligation type debt versus something that's maybe very specific to, like, I don't know, a toll road or a specific project?
Well, I think there's some of that, and most of these transit issues or some of these different issues have a difference between what we call butts in seats versus sales tax revenues, that type of thing. But even sales tax revenues are being impacted in some places. So you have to look at it, but there's a lot of depths of revenue. Where can we go for different tax sources, that type of things, and what times coverage? Like how many levels of coverage do we have before we're going to get into real trouble paying for these bonds? But you are seeing downgrades. So the rating agencies are being concerned, but investors are looking at it and saying, I need bonds, and there just aren't that many bonds out there.
That's what I wanted to get to, whether sort of these dynamics that we're talking about are translating into ratings. But just crystallize that point for me. So the ratings agencies, they are acting here, they are downgrading, but the actual bond buyers maybe are brushing that off?
Exactly. It's a matter of supply and demand on some levels. I mean, there's just not enough supply, tremendous demand, and a lot of money going into ETFs, which simply, to be quite honest, just have to buy bonds. So they're just out there buying bonds, and they're not necessarily as concerned as maybe an individual investor might be. But go ahead.
No, you go on.
No, I think that's part of it. Individual investors might be being a little more picky. So people invested in SMAs might be seeing, a little more selection criteria there. But right now there's very little supply, particularly in high tax states where people are very, very, there's a huge amount of demand for tax-free income.
And Kim, we've been talking about low supply in the muni market for a while now, at least several months here. And you think about this big uptick that we're starting to see in corporate issuance. Is that a sign of things to come in the muni market, or would you expect supply to remain depressed here?
I don't really see supply starting to roll out in the muni market. We have, coffers got filled during the pandemic. What we're seeing is, rates are higher now. Debt got refinanced when rates were low. If I'm a city manager looking at my situation, I've kind of gotten my reserves back in place. I've lowered my debt costs. I'm not necessarily looking at needing to go out and do something right now in a higher cost environment, and I don't need to refinance my existing debt. So with the exception of a few select projects here and there, I'm not seeing this as a time we're going to see a huge amount of new issuance.
That's interesting. When we get maybe a little bit deeper into next year and maybe economic conditions change, and more importantly, the funding needs of some of these municipalities change, how much of a potential uptick could there potentially be?
Well, when things start to change, if interest rates start to change, if you see project needs can change dramatically. We can have natural disasters that cause them. We can have, just about anything can change in local situations that change those needs. But if you refinanced your debt to lower cost debt along the way, having needs to refinance are going to be few and far between, which has been a big driver for new issuance over, most of the last decade.
All right, Kim, really enjoyed this conversation. That is Kim Frederick. She is Managing Director for Fixed Income at Kayne Anderson Rudnick. From New York, this is Bloomberg.
always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Exclusive members-only clubs, Soho House. It's looking to expand its footprint across North America. CEO Andrew Carney wants to seize on potential members ditch New York and Los Angeles post-COVID. He sees opportunity in places like Portland, Charleston, and even rural upstate New York, Romaine.
Well, actually, I know about this one in rural upstate New York because my former co-host, Caroline
Because you're
Hyde.
a member?
No, I'm not a member, and I would never join a club that would have me as a member. But Caroline Hyde, the illustrious Caroline Hyde, I think I could say this without breaking confidence, I know has been hot on this for a while.
Really?
She talked, I think she was a member of the one in London. But I remember she kept talking about why they were building one in upstate New York somewhere, and I was like, why would they build one in the middle of nowhere in upstate New York? But I guess,
I mean, you've got to think about
go where the money is.
expansion, I guess. You got to think about your total addressable market, and upstate New York, it's a beautiful place.
Yeah, it's interesting, though, to see kind of just what he's done with this company. Because, I mean, I just call it a private club, I think kind of understates what it really is. And I mean, it's popular. I mean, we certainly have, a couple here in this area that are very popular. And, of course, they're in Chicago.
I've never been.
They're in LA. You're missing out, Katie.
Apparently.
I mean, I can't tell you what goes on there but.
It looks like people on laptops, on cell phones, eating fries. It looks great. I will say, to bring this to the markets where I live, it's interesting. Of course, shares have tanked since they IPO'd, but this year they're up about 50%. They're outperforming.
They're outperforming. That would be so hard, Katie. But I mean, look, maybe the expansion actually gets them there too. I mean, this is actually more. I mean, you talk about any time you have something like this that's sort of exclusive, there's always that concern. How do you scale up in a way that's going to maintain that exclusivity, but get you that additional revenue and get you those additional profits?
Exactly. Yeah, it's an issue for a lot of these clubs. It looks like Soho House taking it head on.
All right, a lot more coming up here on the big program. Stick with us. This is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and their work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is the countdown to the close. About 30 minutes left to go here in the trading day with stocks. Once again, Katie, on the back foot.
It is not pretty. The same goes if you take a look at the sector levels. You have many more sectors in the red than in the green right now. Up at top for a second day in a row, though, it's energy up about 0.3% as oil continues to climb higher. Utilities also pretty much unchanged, but still the color green there. You go down the list, again, more red than green. At the bottom, communication services, communication discretionary, and of course, big tech down 1.7%, Romaine, after some pretty good news on the economic data front.
Yeah, despite all that, but of course you see Tesla down about 3 to 4% and Nvidia down about 3% as well. In fact, most of the Magnificent Seven really taking it on the chin today, and that's a big part of the reason why you're seeing the broader market lower as well. Snap shares down about 7% here on the day. No real news, but there's been some speculation out there about some interesting new rules that could affect some of the social media companies. That's put pressure on Snap, Pins, as well as Alphabet, Google shares as well. Dexcom, which we talked about a little bit earlier in the program here, getting a nice bid here. In fact, that's the biggest gainer on a percent basis in the S&P 500 today. They make glucose monitors here. We won't go into the weeds as to why the shares are up, but some optimism here that all those new weight loss drugs won't necessarily cut into its business selling those glucose monitors. And keep an eye on GameStop and the rest of the meme stocks. Shares down about 3%. They actually report after the bell tonight. Remember, this is going to be the first report with Ryan Cohen officially fully at the helm all by his lonesome there. But we do want to go back to the economy. We did get some great economic data this morning when it came to the ISM services numbers here. Great in terms of the economy holding up, but there are a lot of cracks out there that show this is economy not quite as hot as maybe the services sector would seem to suggest. This is a look here at sales of trucks. These are the so-called Class 8 trucks. These are the biggest ones. Think the big freight liners you see on the highways here. The most recent data showed that about 15,400 of these vehicles were delivered in August. That's down on a year-over-year basis. And you can see the chart. This is a highly cyclical industry, of course, not just with the business cycle, but of course with the lifespan of these trucks. And while we are near the trough of this current cycle here, we aren't anywhere near getting back to the highs that would suggest an uptick in economic activity, at least when it comes to the freight and trucking space, Katie.
Well, let's keep this conversation going on the U.S. economy because, as Romaine mentioned, we've gotten a string of stronger than expected reports on everything from consumer spending to residential investment, rather. So solid, in fact, that the Federal Reserve will probably need to double their projection for growth in 2023 when they publish an updated outlook later this month at the September Fed meeting. Let's discuss that with Bloomberg U.S. economy reporter Steve Matthews. And Steve, of course, we get an updated dot plot this month. It feels like a lot has changed since we last saw those projections in June. What are we expecting?
Yeah, it's really interesting because, there's a lot of anticipation over the meeting, but everyone pretty much knows that the Fed is not going to raise rates this month. And the big questions are around the summary of economic projections, the projections for the unemployment rate, GDP, for inflation, and the dot plot. And one of the biggest moves that they're going to make, as you just mentioned, is they're going to have to move up their estimate on GDP. GDP came in the first half at around 2%. It's tracking, according to the Atlanta Fed's tracking, at 5.6% in the third quarter. Those tracking estimates will almost certainly come down, and some of the others are a bit lower. But as you point out, Katie, all of the economic data has come in strong. And so, they're going to have to look at moving GDP estimates to maybe 2% from 1% in June. It was 0.4% in March. And, there was an expectation we're going to get a real slump this year, maybe a recession, and all of that's gone out the window.
Yeah, it's wild to think about how far this economic discussion has come since as recently as January, really even as recently as March. When you think about what we're expecting, like you said, no one's really calling for a rate hike this month. And you think about how much of a surprise this growth has been among the FOMC members, among the officials. Are we expecting to see perhaps some dissenting coming at this meeting?
What will be interesting will be the dot plot. In June, they penciled in one additional hike beyond what we've gotten so far. And with inflation coming down, inflation has come down, remarkably enough, with the economy doing well. Inflation has come down from 9% to about 3%. So the question is, okay, do they still need to keep raising rates? And, the general expectation is they will probably end up having to pencil in one more rate hike. So, at least it would give them flexibility. And there's a mixed view on Wall Street on November, but, there's maybe 50-50 chance that you'll see another hike at the November meeting.
I am curious, though. I mean, while everybody starts to sort of take this victory lap on the idea that a soft landing might actually be in the cards, we've seen a lot of data points that seem to suggest that the consumer might be reaching their limit. We've seen some corporate reports out of corporate earnings that suggest the pricing power that some of these corporations had might be waning here. Is there any sense here that, well, maybe the best is actually behind us?
Yeah, there are a lot of people who make that case, including Bloomberg Economics. The economists that work for Bloomberg are predicting a recession as early as the fourth quarter. And there are headwinds out there, very significant headwinds. You have student loan repayments. That's going to affect tens of millions of people, and presumably they're going to have to cut their spending when they start having to repay student loans. You have the possibility of a government shutdown. And you also have credit contraction. I mean, we had in March 3 banking failures. You're still seeing some carryover from that with credit tightening, and you're having, commercial real estate having to refinance a lot of loans. So there's reason to believe that things are going to slow a good bit ahead from the current quarter.
And just real quickly, Steve, we only have a couple seconds left here. But when the Fed goes into the meeting, this one in September, and so basically I think it's 2 weeks from today, if my math is correct here.
Exactly.
I know the expectation is that they're not going to actually do anything in terms of moving rates here. But do you think the discussion is going to be more slanted towards whether to raise again or more slanted to cutting?
There's going to be a discussion on what to do in November. You need to raise one more time, or do you simply need to hold rates high for longer? And you have people like Austin Goolsbee and Raphael Bostic, two of the Fed presidents who don't want to go higher. Then you have a number of people who definitely want to keep that option on the table, such as Loretta Mester of Cleveland.
Yeah, absolutely here. And of course, we get a lot of Fed speak, including a sit-down.
So there's a debate.
There is a debate here. And in fact, that we heard from former Fed member Bullard earlier today. He's still speaking, by the way, Steve. And
exactly.
We hear from John Williams tomorrow. Steve Matthews, our man down in Atlanta here, covering everything about the Fed for us. A lot more coming up here on the program, Katie.
Including shares of Roku fluctuating. They were up as much as 14%, dropping a little bit now. That's after the company announced a slew of cost-cutting measures. We're talking about trimming staff, office space, and streaming content. It's our Stock of the Hour. Up next, this is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg.
Welcome back. Time now for our Stock of the Hour, a look at a slowdown in advertising sales that has been hitting media and tech companies within the last year. Now we're learning that Roku says it's turning to consolidation in order to meet its goals, learning that it's set to lay off about 10% of its staff here. The stock actually opened higher by about 10%, though. It's only up by about 2% right now. Lynn Doan joining us right now to talk a little bit more about the move behind this. And Lynn, this isn't the first time that they've cut their staffing this year.
That's right.
Yeah.
And thank you for having me, Romaine.
Yeah.
It is not the first time. A few months back, they decided that they were going to cut their staff by 6%. Now they're cutting by another 10%. Based on our estimates, that's about 300 workers or so. So they are facing a really broad pullback. They are very focused on cutting costs. They're focused on operating expenses and specifically on like limiting that growth in the workforce for the company.
Well, forgive me for my ignorance here, but when I see like, okay, 10% cut in jobs, and you look at what was at least at one point on the day, a 14% jump in the stock here, that seems like an off correlation.
Oh, that's classic.
Yeah. Okay.
No, I mean, Wall Street loves it when companies cut jobs. It's a big consequence for the workforce.
Yeah.
You can see real people lose their jobs over it, but it's seen as a plus for the market, which, you know, takes the signal from the company that it is taking their expenses seriously.
Yeah.
It wants to cut costs, is focused on improving its profits.
What is it expected to mean for the bottom line, though? Because, of course, Wall Street tends to reward companies when they come out with job cuts. That is just cold capitalism at work. But in the case of Roku, is this expected to actually make a difference?
That's right. They actually addressed that in the filing that they made today where they announced the layoffs. They also raised their guidance for the third quarter of the fiscal year. So their net revenue guidance is 7% higher on the high end, specifically linked to these job cuts, the office consolidation, the review of content that possibly will be taken off of the streaming services. So they expect that. They also expect a smaller loss in net EBITDA. So that is how that's going to directly improve their bottom line.
And I'm glad you brought up the streaming cuts, trimming some of the streaming content.
Right.
What's the general mood music out there about the future of the streaming platform?
The general look at the industry as a whole is a grim one.
Yeah.
I mean, it's an industry that has of late been very dependent on ad sales, right? They've leaned very heavily into that. They want the profits to be good in that sector. And as we've seen, and you've all reported before, in the past few quarters, ad sales have not been good. There's a broader pullback in ad spending across a lot of industries, and media tech have been hit. Now, things have looked a bit brighter. Some of the social media companies have been reporting more optimistic results in that space than we thought was possible at this time. And so maybe it's less grim. Maybe it's looking less grim. And some of Wall Street is thinking that, considering the guidance that they raised at Roku today.
Do you use a Roku? Do you have a Roku?
I do. Yeah. And I thought, that they were just those things that you plugged into the into your TVs, but they're really emphasizing that they are a software company as opposed to a hardware. They are a technology streaming platform.
Yeah. Us too.
Yeah. You have one too, Rami.
Lynn, great to talk to you. Look at our site. Lynn Duan, who helps lead our coverage, managing editor here for most of our tech coverage here. I'll look at Roku. The shares at one point were higher by about 14%. As we move closer to the closing bells here, the broader market still on the back foot. A conversation coming up with Julian Emanuel, Evercore ISI Chief Equity and Quantitative Strategist, with an S&P 500 off the lows of the day, but still down 0.7%. Yields elevated across the board with your 2-year at 5%.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question its industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
This is the countdown to the close. Romaine Bostic here, the baton being passed from Katie Greifeld to Scarlett Fu, as we do every day at this time, Scarlett. And we came into this morning, and we had some pretty interesting economic data. The ISM Services Index coming in well above basically all the expectations in a Bloomberg survey. And without looking at the market, I'm going to assume they're pretty happy with this, right?
Good news is bad news these days, right? I mean, it was the latest piece of economic data that beat analyst estimates. ISM Services now at a 6-month high, an unexpected increase, but prices paid was what really got people worried, right? Because a good economy means maybe a reawakening of inflation, which means the Fed is on vigilance for higher interest rates, higher for longer, and raises all kinds of questions. And what's surprising here is because the FANG index, the Magnificent Seven have been safe havens for so long. Today, they're really taking the brunt of the selling, off by 1.6%.
Can we just say, I know we keep trotting out the NYSE FANG index because no one's created the Magnificent Seven index. I don't know if Steve Soshnick is listening, but he needs to get on that and put a little trademark next to it and make some money.
I always like including that because it has the Magnificent Seven plus a couple of other names. But, you know, there is that report that Chinese government agencies won't allow government staff to use non-Chinese devices like iPhones at work, and certainly that does not help sentiment either.
Yeah, well, I mean, there's a couple bright spots on there. You see C3AI, which we're going to get their earnings after the bell.
At some point.
I don't know if there will be actual earnings, but you'll get a report there. GameStop also set to report as well. Similar story for them. And I guess your big outperformer there is Dexcom. I think that's the biggest gainer, right, in the S&P today.
Yeah, it is. It is. And of course, Roku, which you just mentioned as the stock of the hour, getting a boost on letting go 10% of its staff.
Well, let's get some more insights on the market direction and market sentiment, if you will. Julian Emanuel joining us right now. He's Evercore ISI's chief equity and quantitative strategist, joining us here in Studio 2 in New York. And Julian, great to see you once again.
Great to be here.
I do want to start with market sentiment. There was a lot of talk made about the latest AAII survey here, American Association of Individual Investors. I'm going to read these numbers to you, Julian. Bulls, 33.1%. That's pretty good. Neutrals, 32.4%. Bears, 34.5%. What am I to make of that?
To make of it is that nobody really has any conviction whatsoever. And for us, look, there's a number of things going on here. First, I want to go back to what you were saying about China. we should not be surprised that headlines are erupting the way they are. First of all, we all know that from an American perspective, there is likely to be more and more critical stress on China between now and next November. It is an election button, hot topic. And then from the other part of the perspective is from the Chinese perspective is that, there are clearly issues within the economy that are proving much more difficult to deal with than expected coming out of, COVID-0. And that is something that it's almost a sort of a deflection or a nationalistic sentiment. This is all going to continue to accelerate, and it is headline noise, but at the margin, in an environment where there's this little conviction, it affects stocks.
That headline noise, is that contagion risk, though?
I don't think so. I think it's just one of those things where there's a lot of posturing going on. There will be a lot of posturing going on. And frankly, when you think about this rally within the context of whether it's those big names in the FANG index or others, for the most part, it has been broadly multiple expansion driven. That's where you have a little bit of risk.
Okay, so let's get back to that AAII survey and the confusion that's out there, the lack of conviction. What exactly are people confused about? Because the data show the economy is doing better than expected, and the threat of a recession has gone way down.
But we don't know whether that's good or bad at this point. And here's the interesting thing, Scarlett, is that coming into the start of the year, when talking to our clients, their biggest concern was not whether we were going to get a recession in 2023, because that was actually being discounted at the time, inappropriately so as it turns out, but that the Fed would have to stay higher for longer. And here we are, and we're higher for longer, perhaps for longer. And with the rally we've seen, and again, let's step back and acknowledge that if this were December 31st, we would say, great year, fantastic, here comes 2024. But we are in the point of the year where there tends to be downside volatility. So we are more concerned, and we are far less certain about what the near term looks like.
Okay, so for those looking for the relief of rate cuts, if this idea that a recession is, not a given anymore, is the only way to get to rate cuts some kind of hard landing / recession? That's the path that has to be taken?
We think so. Look, Ed Hyman's call has been for inflation to be lower than expected for a year now. And the surprises have been coming in pretty consistently in that direction until recent weeks, when we got this rise in oil prices and we're awaiting new data. But when you look at it, actually the thing about the rise in oil prices and the rise in yields is looking at the past. 2007 is a perfect example. There was no sign that we were going to have a recession straight away. You saw rising yields, you saw rising oil prices, and instead of those being a vote that the economy was strong, they were actually the harbinger of the recession start. That's where all of this concern is sort of gravitating towards.
Well, then going back to the price action in the market, particularly on a day where you have the 2-year back at that 5% level, and what seems to be a pretty direct correlation between yields going higher and stocks going lower, do you anticipate that those correlations will maintain?
Well, again, this is one of these ones where it is until it isn't. From our point of view, our view is that in general, this is a correction, not a broader market top. But one of the things that would alert us to the fact that this may be a more significant top and that the recession is perhaps closer than people expect would be if stocks and bonds started moving in risk-off fashion, call it the way they did around March with Silicon Valley Bank. We haven't seen it yet, but we're watching for that.
We've got a lot of corporate bond issuance this week. Is that necessarily negative for Treasuries?
Oh yeah, no question about it. No question about it. But again, it's one of those things. We knew it was coming. It's coming. There's more to go. And I think when you look at it, it explains this sort of ratcheting up. But if you step back and look at the broader multi-month picture, both the 2-year and the 10-year are still within their trading ranges, but uncomfortably higher, given the fact that we now have 3.8% unemployment from Friday.
All right, Julian, always a great conversation with you. Great research and great insights out of Julian Emanuel over at Evercore ISI, helping us count you down to these closing bells. Just about 2.5 minutes to go, Scarlett. We're pretty much where we've been now for a good portion of the session, which is, well, yields higher on treasuries and stocks lower.
Higher for longer. That's going to be the mantra all month long that we repeat over and over again. And you look at the industry performances and a lot of red on the screen there.
Absolutely. Not getting any help from the Magnificent Seven, with Apple down almost 4% here on the day. Tesla down about 2. NVIDIA down about 3. We move closer to the closing bell. Stick with us. We're going to take you to the bell and beyond.
Beyond the bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bosick alongside Scarlett Fu. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with our friends Tim Stenovic and Simone Foxman in for a vacationing Carol Nasser. Our audiences across all of our Bloomberg platforms, welcome to the show here, Tim Stenovic. Once again, we're going to do a quick check on your Bloomberg terminal just to make sure that it's working here.
Everything's
I see red across the screen.
Yeah, I see red across the screen as well. I want to thank you for fixing it yesterday after the program, Romaine.
Absolutely. That's what I do.
You totally got
when
it
the lights go down
during the commercial
and
break,
everyone goes home, I just stay behind. It's like
a man
like the
wears
Velveteen
many hats
Rabbit,
here.
just running around the department store.
Look, I think the tone was set early in the day when we got the economic data. There's not much economic data coming this week, but when those ISM services numbers came in hotter than even the analysts at the top end expected, Simone, the concern was, of course, the Fed is going to have more work to do, or at least stay higher for longer.
Yeah, certainly that the choice that seemed clear to markets at the end of last week isn't going to necessarily be as clear as it might have been. We're looking at 5-year yields back above, 2-year yields back above 5%.
Yeah, and you pause at that 5 number because it's the one that we've all been watching for, especially as you get a lot of corporate bond issuances. We were just talking with Julian Emanuel of Evercore ISI, and he was saying undoubtedly the flood of corporate bonds coming out is negative for treasuries as investors sell treasuries to make room for all this corporate credit coming on. And that kind of dictates where equities go next. For today, it's clearly to the downside.
Yeah, and I was looking at the correlations. I mean, the correlations between treasury yields, the negative inverse correlation, actually probably the deepest that it's been for a good portion of the year here, too. So that's one of the reasons why you're seeing it. But interesting, Julian Emanuel was saying how that could actually reverse itself as we get deeper into the rest of the year here. Let's take a look at the equity markets right now, down for a second day with the Dow Jones Industrial Average slipping by about 200 points, or about 0.6%. S&P 500 down about 31 points, or 0.7%, while the NASDAQ composite is going to close out the day lower by about 1%. And the Russell 2000, which yesterday was the big laggard, on a relative basis is your outperformer, though still in the red, down by 0.3%.
Yeah, peeling back the layers of the S&P 500, 207 stocks moving higher today, 296 stocks, Scarlett, moving lower on the day.
All right, let's take a look at the sector performances here. And when we split the S&P 500 up into 24 groups, on the downside, you have tech, hardware, and equipment. That's really Apple dragging things lower. Auto and components off by 1.6%. That's Tesla. And semiconductor companies, NVIDIA, dragging that group down 1.5%. On the upside, no group has gained more than 0.4%. Consumer durable and apparel gaining 0.4%. Insurance and food and staples doing a little bit better.
All right, let's take a look at some of the gainers. Didn't have to look too hard to find some green. Actually, a lot when it comes to medicine here. Dexcom Inc. Up 6.5% on the day today. It's a medical device company that makes continuous glucose monitoring systems for people who have diabetes. This is interesting. An analyst from Jefferies comes out and said that the GLP-1 obesity drugs, we're talking Ozempic, Wegovy, and more, those appear to increase the uptake of type 2 diabetes continuous glucose monitors. That's according to a presentation from the company. Shares of the diabetes device makers have been pressured over concerns that these GLP-1 drugs will impact growth for the industry. Another story tied to these anti-obesity drugs in moving stocks today is Zimro Biomet Holdings, up 4.1%, also among the gainers in the S&P 500. This is a medical equipment maker, and the company CEO, Ivan Tornos, said that he sees rising demand for these weight loss drugs as a tailwind for the company. Here's why. He says, you've got a large percentage of patients here in the U.S. that are actually too obese to get some of these implants that the companies makes. They don't have the right BMI threshold. So if they take these GLP-1 drugs, then it'll be a tailwind for the company. And then Roku shares rising on the day today, up by almost 3%. It surged as much as 14% early in the day, gave up some of those gains. The company did say in a filing early this morning that it was planning to cut about 300 employees. That's roughly 10% of their workforce. It's going to consolidate office space. It's going to reduce its content portfolio. Basically, just try to save money. They're going to limit new hires as well. The company did warn last year that it expects a tough economy to pressure consumers and advertiser spending. And then remember back in March, it said it would cut about 200 employees, 6% of its workforce, as part of a restructuring. So a couple of restructurings there this year.
Yeah, well, it's easy to turn some of the negative news in the markets into some big declines in some of our specific names. AMC today, that was a big loser, down almost 37% after filing plans to sell up to 40 million shares of common stock. You may remember there was a lengthy court battle here, but a judge in Delaware sided with the company last month, and so the company is going ahead with those plans to sell those shares in an effort to raise money to improve liquidity, refinance. But in the filing noted, and maybe this is some of the negativity too, that the stock is highly speculative and involves risk. Overstock shares also down today, now ending down about 23%. This after the company gave a performance update. Remember, it had purchased some of those IP rights to Bed Bath & Beyond, especially bedbathandbeyond.com, and so done a relaunch. It's seen more customers and seen the number of orders increase, but its margins are maybe on the decline. So analysts trying to figure out what's going on there. Also, Lockheed Martin shares falling there about close to 5%, 4.75%. The company's needing to delay the delivery time of its most advanced F-35 jet. It was originally scheduled for December, now April 2024. And finally, Apple. There was that Wall Street Journal report out. This has been dragging on shares all day. The Chinese government agencies have banned staff from using iPhones, also other foreign branded devices. Admittedly, foreign branded devices have long been discouraged, but there was the biggest intraday drop here since August 4th.
When we talk about some of the moves, at least in the broader market here, of course, a lot of that was driven by the uptick that we saw in yields. Most of that occurring on the shorter end of the curve, 6 basis points higher on your 2-year and your 5-year yield, about 3 basis points on the 10-year. Meanwhile, your 20 and 30-year yields actually dipped slightly here. But the big rise that we saw on the shorter end of the curve, of course, the more policy-sensitive end of the curve was obviously linked directly to that ISM services report that we got earlier today. It came in hot, certainly on the headline number, and the prices paid number also caused a lot of concerns. Enough concerns, Scarlet Fu, that we actually did see the swaps market start to price back in expectations for a Fed rate hike this in November, about a 60% probability of that. Just yesterday, we were at barely a 50-50 chance of that, a coin flip.
Yeah, we also just got GameStop earnings out. I'd love to respond to that ISM number, but let's just take a look at the GameStop numbers right now. Second quarter net
profitable?
Sales beat estimates. No, adjusted loss per share of 3 cents. Analysts were looking for a 14-cent loss, so that's better than anticipated.
Yeah, better than anticipated, Scarlett. Thank you. You're so short and sweet there. Shares a little higher here in after hours trading here. And of course, this is interesting that GameStop is saying that it won't be holding a conference call today.
There it is.
That's kind of interesting, too, the communication coming out. If you remember the last couple of quarters, their conference call was, well, let's just say brief. And of course, we know this is now a quarter where this is the quarter where the CEO's gone. This is basically Ryan Cohen's ship right now to steer. And whether we're going to get some guidance on how he's going to steer it beyond what's in the press release, that remains to be seen, guys.
There's not much in this press release.
I know.
It's
I've already
literally
read it. Yeah, it's just like a pamphlet.
Yeah, there's. You know, it's so rare, Romaine, that you have a press release come out with zero commentary from the company's CEO or the CFO. There's not one quote in this at all.
Can I just say the boilerplate is longer than the numbers they've provided.
Yeah, that's a really good point.
I mean, going into this, though, Wedbush analysts had said they thought that the results would be, quote unquote, fine. I mean, how much were we looking for here? I guess that's the question mark. Maybe while we're seeing the shares kind of fluctuate as they are.
Yeah, well, everyone's kind of scratching their heads, and we're not going to get a conference call to dig into everything. But Romaine, you were talking earlier about the ISM services number and how hot they were. There was another data point today, I guess, the Fed's beige book. What was your takeaway from that? The way I read it was we're spending like drunken sailors this summer, high on concerts and everything else, Taylor Swift, Beyonce.
Yeah.
And now what? The rubber hits the road because everyone's paying back their student loans, and you got to tighten your belt. Is that the takeaway here?
Well, I thought it was interesting. I mean, you did hear in that report there was a lot of anecdotal comments comments about job growth actually moderating. There was a lot of anecdotal evidence here, though also that, well, a lot of those labor market imbalances still persist here. And the idea that price growth was also slowing as well. But it gets to the idea, I mean, just to link it back to the ISM, is I don't know if you can really pick a direction for the economy based on any of these data points, whether they're hard data or the anecdotal data in the beige book here. This is kind of still, I think, an economy that is kind of what you want to make of it right now. Now, whether that's going to sort of come back and bite you in the behind down the road remains to be seen.
Yeah, I mean, I think back to what happens when those student loan payments restart and consumers, pull back on their spending as a result of having to pay that money each month. My big takeaway from the beige book was that things are actually looking pretty good in terms of what the Fed is doing. I mean, what the Fed has done is making its way into the economy. I think the big outlier today was that ISM services number.
Yeah, it'll be interesting to see when we get, I mean, I know we get CPI next Wednesday, right, a week from today, and then 2 weeks till we get the Fed meeting where they're going to give their economic projections. That might give the market a little bit more clarity in terms of at least the way the Fed views the economy and then, of course, what the Fed does.
What if the totality of the data also confuses the Fed the way that it confuses the market?
Then they're overpaid.
All right. And don't worry, we'll be covering it. And you guys don't worry, because we're going to be back tomorrow at the same time, at the same place. That is going to do it for Beyond the Bell this afternoon. Our cross-platform coverage of the market close on Bloomberg TV and radio, Bloomberg Originals, and YouTube. Meanwhile, catch us.